Welcome students, my name is Sergey and I'll be your instructor for the stock market trading class. Now this course itself is going to teach you a lot of information including how to make money and trade with the stock market itself. This is the biggest casino in the world and of course you want to learn the basics about it, how to get started with it and go all the way until you get to the professional level. So this course itself has been designed step by step of the way how to go about with actual video tutorials. This is not just talking head videos talking about all kinds of stuff. This course itself, every single lecture is going to be reading charts, figuring out concepts, knowing about advanced things that only I know about the stock market itself, and I learned about this myself. Now, how do I know this knowledge? I read thousands of different books, I studied different charts, I did a lot of newbie mistakes, and of course I learned it the hard way, which you don't have to. Take this course itself, shortcut a lot of time and effort that it took me to learn about this, and you definitely are not going to lose as much money as I did when I just got started learning about the stock market itself with actual money. In fact, I don't recommend you to play with your own money. I recommend you to play with virtual money, and I'll show you how to do this in this course as well. So sign up for this course and see you on the inside. Thank you so much for enrolling in this course, and I'm more than glad that you are one of my students. Now, one thing I do suggest for you is to get started is to find a brokerage that's going to work for you. Right now, you don't have to have a minimum amount that you get started trading with, but I do suggest for you to put at least $100 to get started. Now, you don't need to make a lot of tradings. It is all about just putting the money up front, trying to figure out the whole system, placing a few trades, and actually investing. It is much better for you to be an actual investor than an active trader. You're going to lose a lot more money if you're trading because the risk-reward ratio is much higher. The more you risk, the more likely you're going to win, and the more likely you're actually going to lose as well. With that said in mind, let's take a look at the different kind of trading brokerage that are available right now. Ali Invest is a brand new one. This one is super low cost. It's only $5 per trade, and it does have a special trade bonus depending on how much money you put right inside of it. It has low commission, a few free tools, and research. Merrill Edge, this specific one been here for a very long time. $0 to get started. It is $7 per trade. Ameritrade, I actually really like Ameritrade myself. I think it is one of the best platforms out there. Now this one has $0 that you have to put up front, and this one gives you 500 free trades and up to $600 with a qualifying deposit, which is going to be quite substantial if you want to get all the way to $600 cash given to you. It is only $7 per trade. E-Trade, this is actually my favorite one out of all of them. I just like the user interface and the fast execution in this one, but the price for it is quite steep. You have to have at least $500 invested. Charles Schwab, this one used to be a VIP platform, and now you can get in with $0. $100 referral aboard for first-time clients. That's kind of actually cool, and it is only $5 per trade. There is the Fidelity investment, this specific one also $0, and Robinhood. Robinhood is specifically favored among millennials. The reason why, they actually give you a partial ability of getting ownership of an actual stock every single time you refer somebody and they actually open an account. The great thing about Robinhood that you get a chance to own free stocks. So every single time you share this link and somebody actually clicks on it and uses it to open a Robinhood account, and you get 1 out of 150 chances of getting the more expensive stock such as Apple and Microsoft, and chances of getting the cheaper stock such as GE and Snapchat. So to get in, all you have to do, invite your friends, get free stocks, and track your referrals. It is as easy as that. This is great because you can get up to $500 in stocks just for sharing links. So make sure to check out all the different kind of online stock brokerage and find the one that works best for you. So I want to talk about how much money can you potentially make if you're an active trader on E-Trade. And I want to show you that I am an active trader and some of my recent activity in the past 90 days. Now let's go into E-Trade. And what I want to actually show you is my actual account. Now, I'm not going to be showing you the actual numbers, I hit it, but the actual stats of how much money I was able to make with E-Trade every single year for the past few years. And of course, show you how much money I made and I lost. So with that being said, you'll be able to learn everything that I do myself, and I show you what I do, how it worked, what things didn't, and how I gradually improved my performance, and you potentially can do it as well, because becoming an active trader takes time. So first of all, I'm going to be showing you the performance from the year 2016 to the year 2019 in my E-Trade account. The first year that I am going to be showing you is 2016. In this specific year, I actually made $288. It is not much, but you can see here a few things that I learned from this. One, over trading cost you money because I actually lost $1,251 all in commission fees. And that actually took a hefty amount of my money, because if you look at this right here, you can see that I almost made $2,000. But when you subtract the commission fees, I only made $298, which actually means that overtrading can definitely hurt your actual account. Next thing, for the year 2017, you can see the following. I didn't actually make too much trades. In fact, whatever position I was in, mostly I made very few trades, which actually helped me gain a lot of money overall. Now, my worst year ever was the one I lost $23,000, and $5,000 of it was just commission fees, which I'm not actually going to be showing you over here, but this is something for you to keep in mind, that if you want to learn how to trade and become very good at this game, you might actually suffer a lot of losses unless you educate yourself first and play with paper money, which I suggest for you to do first. And don't go ahead and think you know everything, because you just don't. There is so much to learn and so much information to know in the stock market. For the next year, 2018, you can see I made almost nearly no trades whatsoever. Again, I actually became very disciplined in keeping and staying in a winning position. And this actually made me make a lot of money. The best year I had, some of the best years, I was making a lot of money, but at the same exact time I was over trading. And sometimes I was making a lot with options too. So with options you can make a lot, you can lose a lot, but you have to be careful with over trading. This one specifically, I was doing very well up to a point until I took a major loss at GE, which I lost a whopping $7,000 and $500 on a very bad investment. So I bought it at 14, it dropped all the way to 10. Thankfully, I got out before it dropped all the way to 6. Interestingly enough, it got right back to 10 once again. But that wasn't enough, I would have still had a loss. So what I did, I gambled even more next year into a Snapchat trade. But at the same time, I was more than certain and sure that this stock is gonna do it. It's gonna go up. And I made my research on it and I was totally right. And I was averaging in as nobody was buying the technology stocks. All of them dropped and people were just selling like crazy. It was the perfect time to go all in, which I actually did, and I made a whooping almost $10,000 of cash with my trades for the year 2019. Thinkorswim, this is the ultimate program for you to test out before you're actually gonna risk any of your own cash in the stock market. This is something I highly suggest for somebody who is just beginning in the stock market, or somebody who already invested and they want to make even more money. The reason why you want to try paper trading is quite simple. Some of the concepts I'll be teaching you in this particular class, you can actually try them out with Thinkorswim and see if they are going to be working for you. Other things you can try if you really want to do, like let's say for example day trading, you can test it out with Thinkorswim and you are not going to lose any of your own money here, because all you're really doing is you're learning a lot of things and you're not really putting any of your money on the line. Now on the other hand, the good thing when you actually have real money on the line is that you have emotions that come into play, and this is something you're not going to have that's going to come into play when you are actually investing in the stock market. And it's a really good thing to learn to control your emotions in the stock market, because that's going to make the big difference between if you're going to make it and make big bucks in the stock market, or if you're going to be panicking when something is going to go against you and then make the wrong kind of decision, which is to actually sell when the market just fell for a very short time, versus well, you should be actually buying into the stock market itself. Getting educated is very, very important when it comes to the stock market. Consider creating a paper account and then see how good you do. And after that, then start to invest in the stock market itself. So using the Bitcoin interface, you get to see some of the most popular stocks that people are watching for. Apple, Twitter, Tesla, Netflix, Facebook, Microsoft, and so on. So there is a huge list here, and in the top movers, you're going to see some of the hottest stocks that are trading right now. And after you look at them, there is a few things you can do here. One, you can find the ones that are under $15, and then the next thing you want to look at, if this is small cap, large cap, mid cap, and the analyst rating for it. This is a very simple interface when it comes to Robinhood. It is straight to the point, and it tells you what you want to actually do. So those are the top movers right here, and you can see right here that those are the bad top movers. They're going down. You definitely don't want to get into something that's going down. Instead, you want to get into something that's going up, such as this one, Capital Product. From some unknown reason, it went up $8 in a day. Potentially, this could be a bubble. And if you look at the chart, this is big bubble right here. Had a big move yesterday from some unknown reason, and today as well. So this is not something I would go into. Instead, I'm going to be looking at something now that goes from 15 to $50 and see which is the top mover in here for the day. And as I'm looking, I see a few interesting stocks out there, and this one gets my attention. Then I look at the 1 year chart, and this has a little better chart than the previous one. So this one went up, but it looks like it might have already got all the way up where the height was actually is already. So I'm not going to play that one. Instead, let's take a look at something else over here that we can play. So 15 to 50 is expensive, 50 to 100 is even more expensive, but maybe this has a better chart, and I don't see anything I want to play that is in the top movers section. Well, what I'm going to be doing instead is checking out on Snapchat, one of my favorite stocks out there. This one is going for $75. Of course, if you got in when everybody was selling it and nobody wanted to own it, it was only going in for $5. Right now, it's much more expensive, double the price, only at $10 a piece. If you're interested in buying this stock, a few things you can do. One, you can add it to your watch list. Next thing you can do is press on review the order, and you can enter the number of shares you want to get. Since I don't have any funds in this specific stock account, I can't actually do this. Next thing you can actually do here is press on tags, such as 100 most popular, 25 stocks, most popular under 25, and social media stocks. Let's press on 100 most popular. This will give me a possibility to know which are the most owned stocks out there. And because of that, you can't really go wrong. So let's take a look at all the different stocks out there and see which one we want to actually buy. So this specific one, Weatherford, is going for 68 cents, and this has a very ugly chart. I really dislike it. Let's go and look at another one, Yamaha Gold. This one is only $2.60. It is in the penny stock range, and I don't like stocks that are trading in the penny stock range. They are very, very speculative, and you can potentially lose 100% of your money because often they go bankrupt. There's different kind of stocks here too, such as Dropbox. This one is $20 a share. One thing I want to tell you is that any stock that goes under 5 becomes otherwise known as a penny stocks. Most of the good stocks are trading at $10 and above. So just because it's cheap doesn't mean it's not going to get any more cheaper. So you have to be super careful with that. Another thing you can do here is once you go ahead and look at the stock you actually like, you can find more information here, such as the CEO, headquarters, when it was founded, average volume, if it has a dividend yield, the amount of employees, and news about this specific company. And then of course you can see the interesting part, which is the price most people paid for it on Robinhood. So most people got in at $27. And then you see the analyst rating for it as well. And lastly, you can see the earning for this company, how much it actually was estimated and how much it actually made. And then of course you're going to see the same exact people, what other stocks they bought as well, just to give you an idea. So let's explore the Robinhood interface. And in itself right now I don't have any money in here because it just opened this account. And there is a lot of things you can do here, one of which you can even trade Bitcoin. That's right, people who are really into Bitcoin, you can go ahead and get cryptocurrencies. So you can buy one right here, and it is pretty expensive actually. This specific one cost a lot of money, 4,000 bucks. Robinhood crypto availability. So right now they're gonna let you know if it is available in your state. And then if you want to go ahead and trade them, press on cryptocurrencies. And you can see all the different cryptocurrencies that are available. So the cheapest ones is the one that you actually get right here. There are 17 different kind of cryptocurrencies that are trading right now. The big Bitcoin is a lot more expensive, but there is different kind of ones that are available over here to trade. Some of them are penny stocks, such as this one right here. It is 31 cents. Other ones are more expensive, such as 60 bucks, 167 for this one. Ethereum itself is 137 bucks. When you press on it, you can actually go ahead and see how it actually looks like. So in the past 3 months, you can tell right now it kind of stabilized at 138 bucks. If you look at the 5-year chart, you can see what actually happened to this specific stock. And this cryptocurrency went to a whooping $1,231. So if you were lucky enough to get it when it was super cheap, you could have actually bought it at 11 and made a lot of bucks when it went all the way to 1,000 something. Right now it's only at $138, and would it actually go up again? No one actually knows this question. If cryptocurrencies is going to pick up in the future, you definitely would want to get ahead with some of the more expensive cryptocurrencies such as Ethereum. The more cheaper ones are otherwise known as penny stocks, and they're still the same identical risk as any penny stock out there. Let's go ahead and just press on just any penny stock out there, which is Omis. This is also a cryptocurrency. This one suffered a spectacular fall from grace. So this used to be 15 bucks and change. 5-year chart. You can see that this one hit the most, actually to $23. But right now it is only a buck something, and even potentially cheaper. Let's go and look at some other stocks here. There is something super penny stock wise. Stellar right here. This one is 11 cents right now, and at one point it used to be 46 cents. I don't really recommend for you to get any cryptocurrencies out there. They are super speculative, and there is no way of knowing what price they will go into. This is the biggest one out there, which is the Bitcoin itself, and it is going for a lot of money. It used to go for a whooping almost $20,000 at its height. A lot of people got in when this thing was super cheap, and they used to get in for like 450 or even cheaper, but this chart doesn't say it all. This is just a 5-year chart. It used to be even cheaper, like a buck or two when it just got started. People thought it was totally worthless, and it went up in value exponentially. So there was many different kind of Bitcoins out there, and among all, there was the Bitcoin Gold. This is quite interesting here too. None of those Bitcoins you can actually trade right now. Robinhood is not allowing me to trade any of those. So you can just add this to your watch list, so you can watch for it in case you do want to trade it under a different kind of a Bitcoin wallet. So this just lets you monitor them and have every single one of them right here next to you, so you can see how did they do and everything else in between, but you can't actually trade the Bitcoin themselves. But still, this is good because you get the actual chart, you get to see every one of them, and you get to see what happened to them when it was the height of the mania. and everybody was buying it, and everybody thought it's going to go straight to the moon, and then it crashed right back to the planet itself. So this is it. This is all I have to say about Bitcoin itself. And if you want to get into Bitcoin, well, I don't know if this is the right time for you to get in or not. I don't make any recommendations on Bitcoin, but Robinhood is not a great place for you to trade Bitcoin. But it is a great place for you to monitor Bitcoin stocks because you have all of them on the watch list and you can see the performances and the price of each and every one of the 17 most popular cryptocurrencies out there. E-Trade is the premier platform that you should be actually using in order for you to place trades and everything else in between. One of the things that it has in it that really shines is the research department. So just by itself, the research is first class. And over here, you can find a lot of things and information you can't get anywhere else, including huge charts. They give you a lot of details with technical analysis and technical indicators, plus company events, frequencies, chart tools, chart types, and scale. If you want to go full-time into trading, this gives you all the things you need, all the tools that you want. So on different kind of charts, you can see the Dow Jones Industrial Average. You can also use a tool otherwise known as the Stock Screener. With the Stock Screener, you can go ahead and custom order exactly the type of stock that you're looking for by going through a bunch of different criteria that's going to match exactly what you want in a stock, the performance that you are looking for. So let's say we want something that has 5-star rating for it from the Morningstar, plus it is actually a big stock, not actually small cap or micro cap. After you go ahead and press on 5-star and press on exactly what you want, press on view results, and we get exactly the stocks that we are looking for in the criteria that we like. A few other things that it lets you see is inside activity, when somebody buys or sells. And in Snap you can see a lot of insiders are dumping and selling this specific stock. And a few other things here that you can actually do here. There is the fundamentals, where you can go ahead and read more about the financial strength, evaluation, profitability, and shareholder equality. And then you can press on earnings. That's going to give us a lot more information as well, including PE trends, analyst trends, revenue, and the cash flow. Whether it is positive or negative, you can see how much money this company actually makes. And the best part about it, you can track individual stocks and see how great they went over time and over the years. Such as, for example, Starbucks, which went up over 1,000% ever since I was tracking it at $6 a piece. On the other hand, some stocks go actually down, such as this one, which is CHK, which went down all the way a whooping 85% ever since I started tracking it for $21. So that actually sums it up for you and why I like E-Trade. Hello and welcome back to our class. In this section we'll go about how to day trade or swing trade stocks, what to look for, what to do, and how to do it well. Now between the two, day trade and swing trade, you have to pick which one is better for you. For some people, day trading is what they like to do. If you have a lot of money, day trading is more profitable because what happens is you find a good stock, you play it, and you exit the same exact day. You're more likely to actually gain on a very small amount of a movement. And if the movement goes your way, that means you already made the money and you just exit it. Versus swing traders, what they actually do, they buy a stock and they hold it for a few days, maybe a few weeks. And then once they reach the target, they exit it. So you don't have to have that much money to make profit with swing traders. Now with swing trading, although you don't need to have that much money here, you are taking advantage of a situation where the stock is going your way, which means it has to go up. By it going up for a few days or a few weeks, you're able to get a lot of gain. For you to do this correctly, you have to find a pattern that's going to be working for you. Now, if you take the wrong kind of pattern and you play it, you might not be able to make a good amount of cash because now it is working against you. You don't want to go into a stock and it keeps on going down. Let me show you an example here. Now, here is a stock which you don't want to play. Now, although it is cheap, it is at $3.09 right now. It fell down for a reason. There was some kind of a bad news here. Now, if you take a look at the bottom here, there's a bunch of different stories, and it looks like it missed on its quarterly report. There was a big loss here, and that's why it keeps on falling down. One thing I want to make sure when something like this happens, you want to see if there is any inside selling. And here we have somebody who is selling a bunch of the stock at $5 a share. There was a bunch of insiders who are buying it at $5 something. They think it is worth more than $5, although one of the guys doesn't think so. Sometimes it is usually a good indication if the stock is good or bad, if there is a lot of inside buying. But this is more for a long term. If you want to do a very short term and buy a stock, there's a few things you have to look for, and a good chart is something that I highly recommend for you to find, and this is not one of them. You don't want to buy something that is that cheap, because most likely it's going to get cheaper. Anybody else who bought this stock when they think it was going cheap, like in June, kept on losing money because it keeps on going down. And that is a very bad chart. So you want to stay away from stocks that will keep on going down. Although it is tempting to buy something on sale, in the stock market, stocks that you buy on sale usually are not good stocks, especially those that are called penny stocks. A penny stock is any stock that is under $10. Most of those stocks, they're cheap for a reason. They're bad stocks, and they will keep on losing money for you throughout the year if you do hold them for a long time. That's why penny stocks, it takes a whole other perspective for you to learn how to play them, to make money on them, and it is very risky here. So one of the things that I like to look for is to go to MarketWatch itself. And here is the only thing that I look for is the futures. So I press on futures, and here we have a bunch of different futures. One of them is the S&P 500 and the Dow Jones Industrial Average, including the NASDAQ. Now, we want to see futures go positive. So for the next day, you want to see the market actually going into a positive category. And one of the things about the market being positive is that if you know the market itself is uptrending, it is going up, and we are looking at the mini Dow here, which actually shows you the futures for the day, and also shows you the direction of the market itself. Let's take a look at the whole year here. Here is a yearly chart of the stock market itself, and we can see the 52-week low is at 15,000. The 52-week high is at 18,000. So we are really approaching almost the upper end of the market here. So it's approaching almost multi-year high right now, which means it might actually have a lot more upside for the next week or two. And also it means that if it is so close to the multi-year high, if it keeps on going up, it gives you an opportunity to swing trade a few stocks. Versus if this kept on going down, that means it's in a correction mode. So we had a correction sometime during September. It was very short-lived, and then it starts to move back up again. Now, as you can see in June right there was another very small sharp correction, and then it jumped all the way up again. And you can see in the start of the year, there was a pretty big correction that went in for about a month or two. And this one was pretty steep, and then it reached what looks like a double bottom here. And if you start buying stocks around this area, you could have actually profited. So what you really want to do and what you're really looking for is the market direction. The market direction has to go your way before you buy a stock. If you're playing with commodities, which is different than just playing with just the general stocks, what you want to look for is very simple. Let me show you. So if you're playing with gold, you're going to look for gold going up. Same thing with oil. If you're playing with oil stocks, you want to look for oil to actually go up before you buy the stocks themselves, and then you take advantage of the direction that they're going. So think about in terms of a river. If you go into a river and you put your boat in there, it usually goes only one way. Now, if it starts to go the wrong way, that means something is going wrong. So if you are gonna go on a boat and you know the direction of the river only goes one way, which usually it does, what some people do is they either go just sit there and let the river move you, versus other people that want to go and starts to swim against the river. Now that's totally not recommended. It's like betting, buying a stock that's going down and then thinking it's going to go up just because you keep on putting more money into it. That's the classic newbie's mistake. And another mistake is if the stock market is going down and you keep on putting money into the stocks, all kinds of them, but the stock market has not reached the bottom yet, it means you haven't, and you don't know when it's going to reach the bottom. So you keep on putting money there, you keep on losing money, then you panic and you just panic sell. And usually when you panic sell, it is when the stock market starts to go up again. Because most of the big money, they know when the market reaches the bottom. We don't really know that. What we do know is once everybody starts to go and the stock market starts to go in the right direction, that's when you can put the money on the table and start to play the game. If you already distinguish that the stock market is going in your direction, we are in a bull market, not a bear market, it means you can swing or day trade stocks. And now what you have to do is to take a look at which symbol you want to play with and which one you want to swing. The one thing I like to do is to look at how many advancers versus decliners. Usually in a bull market, you see a lot more advancers versus decliners. And here is some stocks that are making multi-year new highs versus new lows. So you can see there's 84% here that are making new highs versus new lows, which shows that we are in a bull market. Same thing, which kind of stocks are over the 50-day moving average? Most of them are. And which ones are over the 200-day average, which means most of them are actually are. So that means we are in a bull market. We have a bunch more probability for the stock market to go a lot higher before it goes into a correction mode. Now, most people, you won't know when a correction mode actually starts. And it usually just happens. There is a reason for it, but a lot of times it comes in mostly as a surprise. And then everything starts to drop. So there'll be a small drop and then they will start to have a lot more drops. And then, of course, we have bigger drops, which everybody is afraid. And then everybody starts to sell and you lose a lot of money. So what you want to do, you want to play it when it just starts to trend. The stock market is going the right direction. And then when you're playing it, you want to get out. You don't want to stay there too long, because as a swing trader, the longer you stay, the more likely you're taking on unnecessary risk. So here are different kind of stocks here, and there's two different categories. The one on the left side is the good one. The one on the right side is not the good one. Those are the stocks that are making multi-year lows. They are trending for the wrong reason. They are the top losers. They're losing money because something went wrong with the stock itself. And a lot of times that's not a good time for you to go and buy it. Versus here are some stocks that are making new highs, 52-week new high, or just they're gaining for some kind of a reason. One thing that you want to always look for when you are looking at the ticker symbols is to find stocks that just started to actually trend here. So this one, for example, Twitter here, just jumped up. Look at the volume, insane high volume that actually made it jump. This is day one of it jumping into a very high volume, which means either you could have bought it this day or you can actually buy it the next day and play it for the next few days. So here is something that I want to show you, and usually I don't like playing a stock that usually got hold for a reason, and it fell down so substantially down. But I want to show you something that is the exception to the rule here, and here is the reason why. So this stock went almost all the way up to 850 before some really bad news came out about a certain drug, and it looks like it didn't get approved. So the next day the stock fell down all the way to $1 a share. That was like the worst drop ever. But here is the key here. This stock didn't go bankrupt. Instead, this stock actually meant that they have an issue, but they could address it. So the first day after this actually happened, it was way overreaction for this particular stock. It means that its value was not $1, it was a lot more than $1. Now, people who are shorting this particular stock, as you can see, there's 24% of people who are totally shorting and are betting this stock is going to go way, way lower. They got a bunch of money. If it went all the way down from 8 to 1, those people made a huge amount of cash, which means that for them to cash out, they have to cover the short. So they can't just go and not take profits at $1. They have to take profits, because otherwise they're not going to get anything out of it. So most of the people who were shorting this stock took profits the same exact day it fell this way. So people who went in and bought this stock on the day that it fell made a huge amount of cash, because now everybody who was shorting it was actually going and covering the short. When they were covering the short, what's going to happen is a small short squeeze actually developed, and the stock popped from $1 all the way to $2.26, which means that if you actually bought it the day it fell, you could have made double your cash in just a few days. So this is an exception to the rule. You have to look at the news and you have to see what is going on here and why exactly did it fall down. Is it going bankrupt? Is there something really wrong with the company? Or is it something like this? There's a pharmaceutical issue. The stock itself, some kind of results didn't get approved. Yes, it was one of the best products they actually had that was going for this stock, but at the same exact time, this stock is not worth almost nothing. It's not worth $1, and short sellers have to cover. So for the next few days, you were actually safe to take a ride buying it at $1 and cashing out at $2.26, as long as you knew your risk level and you didn't put all your money into it, and you knew that once you get enough money, you can go and cash out. One of the moves that I like to see better is to see some kind of a smaller move up, and to see it to be a top gainer. You want to have some good news for the stock, and it is going forward. So here is one that has some kind of a good news here. So it jumped all the way right there. Sometimes what happens is if it jumps too high, for example this one, it jumped all the way to around 1.5, and during the day it kept on going down until it reached 1.3. So the next day what's going to happen is it will continue to move down every single day for a bit of time. Look at this humongous gap here that we have that goes from $1.10 all the way to 20 cents. So anybody who was shorting this stock lost a humongous amount of cash. So they're trying to actually go and cover the short. Most of the people who made money are just cashing out and taking out their profit, which means that the stock will start to go low unless there is some kind of news that's going to make the stock go higher. So most likely it's going to go around $1, maybe even 90 cents in the next few days, which means this is why I don't play those type of stocks, especially penny stocks. It's very unlikely that you make much money on them, and plus it is a humongous amount of gamble. So you want to look for stock over $10 usually to play this game, because you're not risking this much. You know the stock is not going to disappear the next day, and plus, like Twitter, we know that this stock is going to be here for a while. So there is a reason why it actually jumped to 22.62, and what's going to happen in the next few days, you might get a base to the bottom. What's going to happen is that, as you can see, look at the volume, insane amount of volume in a year. It never actually had this much volume to it, which means there is some huge big kind of news out there that made a lot of people who were not really sure about the stock start to buy the stock. So let's take a look at the news itself. As you can see, there is some kind of a buyout rumor for the stock itself. Now, I don't really like when there is some kind of a buyout rumor, because I'm not sure here if there is actual somebody interested in buying the stock. Usually when somebody says they're thinking about buying versus they're actually buying, it's just a speculation. And when we have a speculation, it means it either can be bought or nothing could happen. Most likely they're just thinking about and nothing actually happens, and that's not good. So if nothing is actually going to happen, that means this stock will keep on going a bit low until it gets around 19 bucks or so. Look at this humongous gap here. So it's going to start to fill up the gap itself. Once it actually goes about and fill up the gap, it's going to get almost to 18 bucks, but it's not going to hit it. It's going to probably go around 19.5 in the next few days. Then if you want, you can buy it once it reaches the gap fill, and after you wait a few days, it will head up again, because new rumors are gonna definitely come about if somebody is gonna buy Twitter or something. Something always happens in the news, and that's what moves stocks up or down, especially after a big rumor like this that came out that Twitter might be actually get bought off. So that's one of the reasons why the stock is high up and how you can play it. But the big stocks that you can really swing trade are usually the penny stocks, and those are definitely things that you can play sometimes. Now, let's take a look at this stock, for example. This is NATO. Now, the company is having a lot of issues because of the low oil prices, but this stock has a huge potential to exponentially go up if oil hits over 60 bucks. Now, the reason for that is very simple, because oil itself is the price that has something to do with this company, and this company will actually stay intact if oil does reach that level. That is the break-even price. If oil doesn't reach this level, they're in big trouble, and they could go all the way to zero in the next few months, and they have to restructure, which means like bankruptcy, and you lose all your money that you put into the stock itself, which means this is why those kind of stocks are super risky. At the same time, the direction of oil starts to go up again, this stock has a huge potential to go up, and here is why. Very simple reason. First off, take a look at the short float here. It is 14%. Now, let me show you what happened here before. Now, this stock has a history of having explosive moves up. Let me show you an example. In March, it went in from $1.80 all the way to a whooping $4.25. Here's another move right here, from $3.18 all the way up to $8. There is a reason why this stock can go so high and again so low, because after it went up so much, it went from all the way from $8 to $3.50 in a very short period of time too. The reason for that is quite simple. The reason why it goes up so much is because of this. Take a look at the short float here. 14% are shorting something that is a penny stock. This is a very dangerous penny stock to actually short. If you're shorting a penny stock that has only 24 million shares, it means you're playing with total fire. The stock itself, the float is so small, and because it is so small, it is so easy for anybody with big money to just come in there and totally destroy your short positions. On the other hand, it is a risky stock as is, because most people are betting this guy is not going to make it if the oil prices keep on staying low, which is true. At the same time, it's just a dangerous stock to short because the float size is so small that any move with substantial money will move it up a lot. So if somebody puts in a few million bucks, and because it is so small, it's definitely going to show. It's definitely going to go up a lot in a very, very short period of time, which means anybody who is shorting it can see their account get destroyed in a matter of hours or even days, which is why people who are shorting stocks like this, like penny stocks, are very, very playing with fire. It's very likely that they can lose their entire account by shorting those type of stocks. You should never short a penny stock. And shorting is dangerous enough, but shorting a stock that's about $1 is just a very, very bad move. Here is just another one. This is like the worst stock to short. It doesn't matter if the stock is ever going to go to zero or not. You have to understand one thing about playing with a stock. Any stock can go to zero. Now, if you're shorting a stock, the upside target for it is just about any number. So whoever is investing in $1.40, let's say you invest $500 in it, the most you can lose is 500. Now, if you put $500 in your shorting and $1.4 stock, your losses are actually unlimited. You can actually be held to have like $5,000, $7,000, or $8,000 of losses if the stock goes to 10 or 20 bucks, if it ever happens. The chances are pretty slim, but it can happen. So that's why shorting penny stocks is a very, very bad idea unless you're playing with options. This stock doesn't have a very big short float. It doesn't have a lot of people who are betting against this stock for a good reason. They don't want to bet on something that has only 10 million shares, which means that with a 10 million share stock, it's so easy to manipulate it. And you can see what happened in June here when something happened here and it went in one day all the way from 1.5 to 220, and then it went all the way down to what it was before. But then again, whoever was shorting it that day probably learned a very expensive lesson. Here is another thing that happened here in April. In April, as you can see, it was around 80 cents. And then 2 months later, it is at 220. This is why you don't short penny stocks. Now, you could win money on those. You can lose a lot more money as well. As you can see, this was at 2.4, and then it went all the way down to 80 cents before it went all the way up to almost the same amount as it started. Confirmed double bottoms, which means after they reach the double bottom, usually they go up. So if you see a bunch of double bottoms, you buy them when they reach the bottom, they would start to go up again, and you start to sell it. As long as they stay within that area, you can profit on those small moves of them hitting the bottom and actually bouncing off of it and going a bit up. So here is an example of one that I actually like here. Just the chart itself. I'm not even talking about the stock here. So this one hit the bottom right there at 10.15. I wouldn't play it on the first bottom. It's not a confirmed bottom unless it hit the second bottom right here, and it hit a third bottom. So you can be sure that it's gonna go hit the bottom and then trade up. After it trade up, so you actually bought it at around 10.15, you got rid of it at 12, and it went down again. Sometimes it goes right through the bottom itself, goes a little bit lower, and this one went around 9 something. You could have bought it around here, and it went up again. So you could just play the small differences of moving from a double bottom and then bouncing off of it. That's one way for you to do this. In this section, we'll be covering how to trade a stock using swing trading and resistance and everything else in it. So here is a stock that I actually think is one of the best stocks out there in the stock market for you to actually day trade or even to swing trade. And I'll explain to you exactly why. Now, Apple stock, it has two different kind of protections for you. One is a dividend protection. Two, it has an aggressive buyback. What happens is if the stock goes really low, the buyback goes in and starts to buy the stock itself. So this actually works all the time. It doesn't just happen when the stock goes under a certain amount, but it happens more aggressively when it does. So you have some kind of a bottom to this stock. That's one of the bottoms that keeps it from dropping too low, which means that every time you see the stock of Apple going down for some kind of a reason, the dividend itself of the Apple stock, which is around 2.something%, offers the floor, and the second floor that happens is the stock buyback, which means all you have to look for is for the stock to bounce on two different support levels, which means like a double bottom. And here, as you can see, the stock itself went very, very high a few months ago. In May, around that time, And then what happened, there was some kind of a mess up here, and it went down a lot. It went down around 20 points or so. And as you can see, there is a big volume here, and that's a selling volume. And here is a gap, the gap fill. And usually in the stock market, there is a rule that all gaps have to be filled eventually. So eventually this gap actually had to get filled, and it did. A few months later, as you can see, it jumped up right over the gap itself and it filled it, which is not really good because it didn't fill it all the way. And it actually means there should be another gap down in the future that's gonna fill it to the downside actually. But other than that, as you can see, what happened here is that there was some very, very bullish news after this bearish news, and the volume speaks for itself. So then it jumped all the way to 116. Now, what you could potentially do here is study a chart like this and potentially buy Apple when it bounces off a double bottom. So here is one bottom right there, and here is a second bottom, which makes it a double bottom. Sometimes there is triple bottoms, sometimes there is only one bottom and it just bounces off in a V shape. In this one, there's a W shape here, and you could have just bought it after it bounced off the second area here of the double bottom. And if you bought it around, let's say 94 or 95 here, and you waited a little bit longer, it went all the way to 114, and then you could have just sold it and you made around 20 points gain, which is pretty good. It's not that much of a gain, but then again, every single gain, if you scrape a bunch of stocks and you keep on doing the same thing, a lot of them, and you keep on seeing them bounce off a bottom, you can even do it with one stock. You don't need to get to like hundreds of different stocks and just keep on testing it. You can just go into Apple, which is a very, very safe stock because it is in the Dow Jones Industrial Average. It is a Dow component. It is in the S&P 500. This stock is making billions of dollars every single quarter. It is one of the best stocks for you to actually go in and swing trade it, because you know there is a limited downside protection for this stock and there is an ability for it to go a lot higher. So this is the kind of stock that I like to trade. It is, and it will give you pretty decent profit at a pretty low risk entry into it. For example, what I mean by low risk, it means that, let's say for example, that you get in here at $100 and then it goes low to 92. All you have to do now, you just wait until the stock eventually goes up again and you can sell it. And plus, since it has dividend protection, it also means that you will get a dividend if you do stay around for a few months. So it is one of those stocks that it is safe for you to stay for a few months, because not only you get dividend, you can even go long term here just in case. And that's the stock you want to look for. You want to look at something that has potential for you to go long term in case the market itself is not that great. Because sometimes you will go into a trade and you'll find out that you went in at the wrong time and it goes against you. And it's good to know that you can stay in this trade for a lot longer than you should stay in it. So if you only plan to stay a week and it went against you and you stayed in it for about a month or two, and then you made the money that you were looking to actually make, it's still good because you know you bought into a solid company. That's why I highly suggest for you to research the company before you actually buy and day trade it just in case. Because you definitely don't want to buy into a stock that could any day go to zero or to go bankrupt, because then you lose 100% of the investment you put in it, which comes to a different topic, which is called risk management. Okay, so we are ready right now to go about and try to play with paper money. So now you want to find out when should you buy or sell a stock and when exactly should you pick a stock to swing trade. So we are going into a chart here, and here is a company that's right now in the news, the Wells Fargo company. There was some scandals going on, and of course the stock itself went from almost $60 all the way to 44. So I took the chart, I went all the way to the 1 month, and it shows the performance of this stock from the year 2005 all the way to present day. Now there is a few things that are going on here, and it actually shows you. First off, here is the humongous recession we had a few years back, and right there, that's when the stock itself took a humongous dive, and it went almost to $8. Now this is something that happens around once in a lifetime, where you have a stock go down this much when the whole system was actually going down. It's not just one stock, everything was selling out. So you could actually buy almost anything and it would bounce back up. Now the stock itself, what you really have to do, you want to figure out when should you get into the stock itself and when should you actually get out. This is called swing trading. And with swing trading itself, you're looking for an opportunity. The opportunity is when should you get in and buy the stock itself and when you should go about and sell it. Now here is a way that you figure this out. And I'm showing you bottoms and also a top. So you can see that in the past few months, and this is just 3 months, here is a bottom right there, here is another potential bottom, and here is a top. So what you want to do is you want to try to buy a stock when it hits a bottom, and then you want to sell it when it hits around a top. Now this is not something easy to do, so I'm going to be showing you another actual graph here just to try to show you what you can figure out from this. So we are going now to a more sophisticated chart here, which is FinWiz, and we are typing the same exact thing here. So over here it's much more easier to see. This is a yearly chart of Wells Fargo company. In the yearly chart you can see multi-year lows, and we can see something very interesting here. There is 3 potential bottoms that actually happened. There was one in February, one in July, and one in October. Those are bottoms because the stock itself bounces off those bottoms and goes back up. Now you don't want to buy when the stock goes all the way down because you don't know how low it continues to go. You want to have a confirmation of the stock and when it starts to move back up. Now the good thing that you have to watch in the news itself, you want to watch when bad news is moving the stock up. So what happened was there was a lot of bad news that was finally coming in, and the stock, instead of going more down, it actually went up. That's good. So you want to see something like that, and that means that people are buying it, but there was bad news, which means that maybe the bottom actually been reached. Sometimes people are waiting for a double bottom. This stock had what you could say was a triple bottom within a whole year. So now what we are waiting for is the stock itself to go back up. And when it's going to go back up, you want to swing trade it from around 44 range all the way to around 50. So that is the way you take about and you try to swing trade a stock. So now we're going to go back to the previous chart right here, where I'm going to be showing you the same exact thing. Wells Fargo company, going back in there, and now we are going to show you the position that I actually took, and right there. So here is where I decided to take the position, and my target is around $50 range over here. This is the triple top. The triple top is right there. That's a triple top, and this is a potential bottom right there. Now there is a reason why this stock keeps on bouncing off this bottom. Let me show you exactly what I mean, why this particular stock is doing it. Now other stocks may not have the same exact bottom, but this one does. So 2 things that are keeping this stock bouncing off this bottom are very simple. One is the low PE level. It is 10 PE. The whole stock market right now is valued at 16, so that makes it pretty cheap. Other banking stocks are actually going around 16, 12, or a few of them are a little bit close to 10 PE. Now if interest rates are gonna go up, this stock is gonna go up itself as well, because then banks are gonna make more money. Second thing that keeps this stock going up all the time when it hits a certain rate of 3.47%, which is much better than any bank gives you right now, which is next to 0. So that's one of the things that keeps the stock bouncing off a bottom right there, but it seems to have bounced back 2 more times previously. Now, in this particular case, it went a little more down than it usually did, and it always does. It always a little bit tricks people who are trading stocks themselves. In this section, we'll examine a call option. A call option gives you an ability to own the right to buy an asset for a certain amount of time, and it's limited amount of time. That could be as long as a week, a month, or a year, or maybe even a few years. Then, when this option does expire, you either get in the money and you get the cash, whatever the cash you get for the movement of the stock, or you might lose 100% of all your investment in it. So a call option is basically a gamble, and the gamble here for you is to gamble that the stock is going to go a lot higher when it does expire. Another thing that you have to keep in mind is when time goes, the more time actually passes, the more the option itself decays, which means it goes down in value. And the longer you own a stock option, the premium that you paid for it, and the premium actually means that you paid a right to own the particular option at a certain price. Now, different times of the day, different times of the month, and different times of the owning cycle will get you a lot different price with the premium. So sometimes whoever is writing the call option is going to charge a lot higher premium, and if you happen to buy it at that certain time, you might actually lose a lot more money, because by the time this option does expire, either you will get the money or you won't. So it sounds like a little complicated process. Let's just simplify it for you. Just listen to the video that's going to try to explain it to you in most simple words.
Call options are a financial contract that allows an investor to speculate in stocks that he doesn't own. Ken believes shares of Ed's Carpets are going to rise in price. He doesn't own any shares, so he talks to Bob. Bob has 100 shares of Ed's Carpets and thinks they're fairly priced at $20, or maybe even due for a fall. Bob agrees to enter a contract to sell his shares to Ken for $22 in a month. The fee that Ken pays Bob for the option, called the premium, is $200, or the $2 per share difference multiplied by 100 shares. If the price of Ed's Carpet shoots up to $30 in a month, Ken can exercise the option. This means he buys Bob's 100 shares from him for $22 each for a total of $2,200 and sells them for $3,000. His profit is $800 minus the $200 paid for the option, $600. If the price stays lower than $22, then Ken loses the $200 he paid for the option. There's no point in him paying $22 for Bob's shares when he can buy them cheaper in the market. Like many derivatives, call options offer investors a way to leverage their capital for greater investment returns.
And another thing you have to understand is if it actually goes against you, you might lose 100% of your option investment as well. So options are a very risky way to make or lose a lot of money in the stock market. So let's go ahead and get started with trading. And in this video, I'm going to be showing you how you can go ahead and buy a call. A call is just betting that the stock market is going to appreciate and going to go up. Therefore, you want to always buy something that's going to go much higher instead of much lower. And potentially to make money here, we are betting that the stock market is going to appreciate. And since we are doing that, the best kind of stock for us to buy is called a SPY. SPY is actually otherwise known as the S&P 500. It's actually the sum of the whole index of the 500 best companies in the stock market. So if you're betting on the entire stock market, betting on the SPY going up is the way for you to go. So the first thing you want to do here is to figure out the strike price you want to play. And here is the stock price I want, which is trading near $300 is going to be what I'm looking for. Now, if you have a lot of money, you can actually bet in the money. So betting in the money is going to be around 280 because it is trading right now at 281. If it's going to go a bit low, you might have to go ahead and buy it at 250. And the lower you actually bet on a call, the more likely you're going to hit it in the money, which means you're going to win in case it's going to appreciate and go up. If you want to save money, you want to go ahead and buy something that's going to happen in the future, such as it getting to $300. If it ever hits 300, you're going to win. And it's all about time appreciation as well. So if you're betting in the future, you got to go into the future months, such as this is April 17. It's going to be a bunch of days for it to expire. The more in the future you're going to be betting, the more money it's going to cost you to place this bet. Now, if we want to totally play this, totally safe, but let's say we are betting it to get to 300, we got to go ahead and find exactly the date we think the stock market is going to hit the top. So let's say, for example, we want to go ahead and hit the May 19th. So press on that. Now we are looking at strike price, which is going to be a call to put ratio. We are actually looking just for the call, and the strike has to be 6, and it's going to be near 300. Next thing I'm going to be doing is trying to buy one of those strike prices, and we can see the bets that is going on for each and every one of those. For example, this one is only 1 cent. So let's press on that one. And this one is betting that it's going to hit $300 in March 29th, which is the next few days. And because it's so unlikely for this to hit this amount, this is why it is trading at a super cheap price at only 1 cent. To be more likely for us to win, we have to go ahead and hit something much more likely for this to happen, such as the May 19th. On May 19th, it's already, the price is much higher, which is 22 cents here per bid. Now, if you want to go in the money and make sure you already win, we're going to go to 281 instead, and this is why it's so much more expensive. And we're going to be buying this specific position. So what we're getting here is 10 quantities, and the expiration date is going to be May 19th with the stock price of 281. Let's press on buy and make an order. So it's going to be a limit order. The stock price is going to be 6.3 as they requested, and the bid is 6.32. We got to go and put exactly the bid, otherwise we're not going to hit and win this. Otherwise we're going to actually lose. It's going to be automated, and duration is going to be right now. And let's go ahead and see. So this is going to cost us over $7,000 for us to place this bid into here. We are making sure everything is correct. We want to do a buy, not a sell. Make sure you're not playing it the wrong way. If you're buying calls, you don't want to sell a call. You want to buy a call. There's a huge difference between the two. Selling a call is actually doing the reverse opposite bet. And you're actually betting it's not going to hit this amount, and you're selling it to somebody else to buy. So you're going to get the money up front. And because of that, you can see the amount I will receive is going to be $7,000. And I'm going to keep this entire $7,000 if I'm selling this call. But if this goes against me, my potential losses are potentially much, much higher. In fact, they could be potentially unlimited too, because it can go any way it actually wants. So what I'm doing here is buying the call for almost $7,000, and if I'm actually right and I win, what's going to happen is if it strikes any dollar amount above the amount that I bought, and the higher it actually strikes, like let's say 300, the more money I'm going to be exponentially winning for this strike price. Since I got 11 contracts of this, it's going to increase by 10x for every single dollar that's going to go up. So I can make a serious amount of money by investing only $7,000. Let's press on preview. So the total amount that I'm going to be spending to buy this is going to be a whooping $7,000, and my buying power is going to be super reduced here. So my resulting cash buying power is going to fall down to $93,000, and the margin power is going to go low if I decide to buy this. So this was just an example of buying a call. Option trading basics. A put is a right of a contract to actually sell a particular amount of security within a set amount of time. Now, the buyer of this particular option is actually betting that the stock is going to be dropping below the option contract before the expiration date, and the difference between the drop and the price of the option itself that you bought is actually the amount of payoff that you'll be actually getting. Now, the payoff itself depends on a few very complicated factors, which include the time that you bought this. So the longer that it takes for the stock to get where you want it to get, the more of a time decay actually happens, and this decay takes away the value of the amount of money that you actually might be getting at the time that you will get the contract delivered to you. It does sound like a very complicated thing, but it's not. But it will take a long time for somebody who is just beginning and is learning in the stock market to understand what a put actually is and understand the value of actually playing with puts and how you can make a humongous amount of cash potentially playing in the stock market just using options and not owning any stock whatsoever. So a put itself is the ability to own a stock for a set amount of period of time, which could be as short as a day if you want to day trade it, a few weeks if you want to swing trade it, or even a few years if you want to invest in the stock itself using something that you're betting that the stock is going to go down in a few years down the road. So you are actually getting a substantial amount of reward if the stock goes to bankruptcy or to zero if you do buy a bunch of puts and betting against that particular stock. Now, on the other hand, the amount of money that you can lose by stock option is everything you put in it. So if you put a humongous amount of money just buying a put and the put expires worthlessly, you lose everything that you put your money into it. On the other hand, if the put itself does make you money, it is going to pay off substantially because one put actually equals to 100 shares of one stock. So you're actually buying a humongous amount of an option, which is your option to own a stock for a very short period of time, and that fluctuation within its price is how much money you will make or lose when this option expires. So if it expires worthlessly, you lose everything. If it expires and you actually are going to make money, you're actually set to make a huge amount of money. Sometimes it's a very small amount. It all depends on the time period before the expiration date and the decay as well. So there's a lot of factors that involve in this, and this actually sums up, and as short as I can, what exactly is a put is, and not to get very technical about it. So the next thing I'm going to be doing is betting on puts, and specifically what I'm going to be talking about is betting that the entire stock market is going to fall down. And since I'm betting on that, I have to find a company that's going to fall with the entire market. One such company that I know is called IRBT. This company is doing great right now, but it's not going to do so great when the whole entire market is going to collapse. So if I'm thinking that this company is not going to go, so if I know or I think that this company is not going to do so well, my next job is to figure out when it is the right time to short the company, otherwise known as betting against the stock. So how do you bet against the stock? Well, first of all, there's a few things you want to keep in mind. First of all, the entire stock market should actually go down. Second of all, let's look at the charts here. You can see that this specific stock goes up every single time the entire market goes up, and then it falls down dramatically when the entire market falls down as well. So this makes it the perfect company for us to short. And since we are shorting using puts, we are actually safe because the only amount of money we are actually prepared to lose is going to be the amount of money we are putting into the option. If you're shorting with your own money and you're playing like that, it is much entirely more dangerous. You can lose everything plus things that you don't even have in your account. So this is the safer way to short stocks using puts. And now what I'm going to be doing next is selecting the price that I'm looking for this to fall into. So a good price would be around 80 bucks a share. And this should be in the future. So let's move to duration. And I think the stock market is going to start falling down in around September or November in the next 231 days. So let's go ahead and play it safe. Press on 231 days in November 18th. And next thing I'm going to be doing is just to picking one of the prices for us to buy from. So we are going to be actually buying the put. So let's press on this and change it to a put. The strike price is going to be the correct one, which is going to be around 80. Let's move it to the correct range here. The expiration date is going to be fast in the future, November 19th. The quantity of it is going to be 10 different pieces of it. So that's the correct thing for us to do. After you make sure that you actually put the right price and everything else, the trading for it is 5.7. So make sure we are switching this to 5.7. And people are actually bidding just 5.7. The middle range of the bid is 6.2 and the asking range is 6.7. So there is no way we are going to get this just placing the same bid as everybody else is doing. Most likely we'll get in only if we put 6.2 over here. Make sure we put the limit price so nobody tries to rip us off here. So if we put the market price, we might actually get stuck at buying this at 6.7. Let me just show you what I mean. So press on preview and you can see it went all the way to 6.7 and tried to hit the highest amount here for us. And it shows that this bet, if I did actually put it in, would cost me a whopping 6,700 bucks. Now, on the other hand, this thing is going to be a huge money maker for me. Because if I'm right and it does hit this amount, it actually means that this money is going to get multiplied by 10x. So we are potentially looking at something in the neighborhood of $67,000, but this is not counting the decay, because over time the actual amount that we are going to be getting here might decay a bit. So we are not sure. This is actually the max that we potentially could get with this specific play. So we are spending 6,000 bucks to potentially make something around the neighborhood of $67,000 if we are right. If we are wrong, the whole entire amount is going to go directly to zero and I'm going to get zero. Now it is time for us to get started with trading. Before we get trading, we gotta pick the stocks you want to actually trade with. So what I do, I go to finwiz.com and over here I'm looking for active movers. Those are some of the best stocks for us to go and play with. What you want to do is to find a stock that has a big move up and down, but it is a big company. You don't want to go and trade penny stocks with options. The reason for that is quite simple. A penny stock has a very low float volume, and therefore the options themselves are not liquid enough for you to get rid of, especially if you're going to be trading a bunch of them at the same time. So this is not good for you to pick something like this. It's very unlikely you make anything out of it unless it goes exponentially up or down in one single day. And even that, it's going to be very hard for you to get rid of. So what I'm looking for is a stock. For example, Tesla is a big stock. Why is this one of the favorite stocks to trade? Well, it's quite simple. First of all, when you're looking at this, you want to see the move in a day, which is the true average range. Well, this one moves around 10 points a day, which is quite good. And this is just the average. Now, potentially if it goes way more than 10 points, it's even better. So you want to have a stock that is and doesn't have a very small market cap. So a big market cap is good, plus a big price swing during the day, a bigger price swing during the month, is going to be exactly what you're looking for, such as this one. Look at this, 380 going all the way down to 310 within a very short period of time. And also it goes the other way around too, but it takes a little longer for it to climb up. Still, it gives us an opportunity to actually profit with the options, especially if we get the monthly options, which expire pretty quick. So you want to go and move those things as fast as you can up and down. Another thing that you have to do is pick other stocks. So for example, here is another one. This is Apple. This is a big stock that you can go and trade. This one also has substantial moves up and down. So you want to go into the monthly. So in a year, this is the trading range. It's actually at the higher end of its trading range. Next thing, we're looking at the weekly chart and try to find like a pattern. Eventually, what you're really trying to do is very simple. You want to profit and you want to pick tops and bottoms. And tops and bottoms are pretty hard to pick. But over here we have something that looks like very much like a triple top forming over here, and then it's going down. So something like this, when it starts to go down, you have an opportunity to profit when it goes back up again. So that's what you're trying to do. With Tesla, it's going to be a little bit more simple. So over here, $345 right now. Seemingly, this is the top of the training range. When you have a top of a training range, you want to actually time the bottom. So by timing the bottom, how do you do it? Well, market sold off right now in one day. Next day, it's probably going to go back up again, which actually usually happens after a big day like this of a sell-off. So you want to pick a big stock that you will be using. So let's go and pick one. So we have Google right here too, Facebook. Those are some huge companies that are very, very liquid, and you can definitely profit with them. If you're looking for something small that you can profit and those are not very liquid, well, here's one right here. It's called GoPro. This company been a huge loser in the past few months. So in this one, you're actually betting this company eventually will turn itself around. So after it been on the bottom for quite some time, look at this, it got sold off all the way to $5, and now it is $5.47, and potentially it could go back to $5 again. So we have like a 47-cent range. Maybe it's going to go under that as well. It can happen. We don't know what's going to happen in the future. All we're trying to do is try to bet where it's going to go eventually. And by placing the correct bet, we're going to be making money. If we place the wrong bet, we are going to lose. And since we only want to capitalize on a very small time frame of it moving up or down, and we want to sell off as fast as we can, we want to make sure that we get in at exactly the right time. In fact, the best trades I ever had was those that I did within one single day, when something in the news actually hit and I just bought something and then grabbed it when it went all the way down or all the way up exponentially. Then you just buy an option and you sell it pretty quick. You don't want to hang in there for too long, because the price only stays very good and you get a good paycheck in a very short period of time. After that, you actually are going to start losing. Maybe or maybe not, but most of the time, the longer you hang in to an option, the less likely you're going to make something, because 90% of all options expire worthless. So all we are doing is trading and playing with time, and we're just profiting in the journey, and that's it. You're not doing anything else or anything more than that. Let's get into our account. I have 0 positions at the moment because I'm not actually actively doing this anymore. But if I was gonna do this, here is what I will be actually doing. Plus, I like to wait for a really good opportunity. I want to hit the ball, like a home run. I don't want to go about and play just little games that's gonna eventually just, you lose commission, you lose time, and make money. My favorite is actually swing trading. That's what I like to do. I love swing trading. It is swing trading. And that is the fastest way to make money over pretty short period of time, but not too short. See, if everything is very, very short period of time, you're gonna play it fast in, fast out, quick, and that's how you make your money or lose a lot. So you either win a lot or lose a lot by making quick decisions. If you're very good at it, you can make a huge amount of money. If you make a mistake, it's gonna cost you a humongous amount of cash. But that's where the big money is at. If you put a lot in and you play the game pretty good, you'll be making a lot. And you also can lose a lot at the same exact time. It's all about how good of a player are you. At the same exact time, when you play swing trading, you have a longer time period. If you're willing to hold this for a few months, and even longer if you have to, eventually you will come on top if you do get the correct play. Now, if you're playing long-term, totally investing, this is not for you. Of course, this whole video is not for investing. It's more like swing trading, and especially for options trading, which is we are covering right now. So let's go into something to play right now. So GoPro. Now, unfortunately, this is a penny stock right here, and it's gonna have an earning coming out in 2 days. Now, it totally sold off right before the earning. So I actually expect this thing to either stay where it is to kill off all the option people who are betting it go up or down substantially, or of course it's gonna go higher. And the reason why they usually go higher after earnings is that all people made the bets and they're gonna try to short cover it. And during earning calls, a lot of people lose money because they just panic. The stock goes exponentially up or down, and then after hours, lip of hours, that's what it is. I try not to touch this at all, unless of course you're the one who is selling the stuff in after hours. Anyways, let's get into the options. That's my favorite place. So this is a penny stock option that you can play here, and you can kind of figure out what it is, thinking what's going to happen with the earnings on February 2nd right here. And you can tell that most people are placing the bet that this is going to go flat at $5 right here. The biggest open interest is at 5. Second biggest open interest is $5.50. Everything else is kind of out of the money calls over here. So the ones who are thinking it's going to go bankrupt, there's a very small amount, but there is 160 people who are betting on this. Nevertheless, there's always somebody who's betting on something like this. On the other hand, somebody else is betting at $7 here, and those are out of the money options. Those are puts. So puts are betting against the stock. Calls are betting for the stock, and those calls right here, we don't have that many people betting on that, and the most expensive ones are going for $3.15. So the calls over here are trying to capitalize on all the way from 0 all the way to 100 over here. So those are the most expensive ones. On the other hand, with this one right here with the puts, where people are betting against the stock, the price here is not that great. So we have the price, which is the asking price right next to the price of the actual item itself, and it always puts it in here, and you can see it from both sides. So the calls right here, the most expensive $3.15, the puts are $1.67. Well, somebody betting on $7 and under, so you definitely can't go wrong by betting $7 and under. So anything that goes 7 and under, the guy who buys the $7 put is gonna win. The cheapest put here is $4 and under, and almost nobody is buying that one. So almost nobody thinks it's going to go there. So if it does go there, it's very unlikely, but if it does, this guy is going to really become rich if he buys enough of them. Most likely he's going to come out with losing 100% of his investment in this, because those things are not investing. You can't invest in options. You're just going along the journey. So we have different months here. So February 2nd, February 9th, the more you go up in the future, the more expensive every one of those options is going to cost you. In fact, the higher up you go, and you can go a few years in the future too if you wanted to, this we are just going a few months, those option prices are going exponentially higher, along with the calls and the puts. And the ones that are the most valuable ones are the ones who are going to cost a lot more for you. And the ones that are least likely to happen are going to cost nearly nothing. Right now the volume is nearly dead because this is after hours. You can't really do much with this. So we have to move to something a little bit more active that might be active on after hours, such as Apple. So this one is also coming up with earnings, and they got really sold off before the earnings, which is good. Now you could bet for the stock to go up, which some people are doing. But then again, what happens if it totally goes below the actual price? So you're going to lose a lot of money. So what people actually do is usually before the earnings, they will place a bet, either out of the money, one way or another. So let's check out what are the options telling us. So we have the February 2nd, which is the weekly option, probably one of the cheapest ones out there. Unfortunately, this is like the day of the earnings that it is coming out. So your better bet is probably the February 9th option. And of course they're going to try to pin the price of this option in a way that it's going to hurt most option people who are holding this. So in other words, if you're buying the most popular one that everybody is trying to grab, you're very unlikely to hit it off. So you have to go a little bit off to the side with this one, because the computers always play against you, and they are a lot smarter than most humans. Just the way they play the game, they want to make most money, and those are programs that just play on like everything. They play on every single cent that goes in and out. The price is like perfect in some ways, if you really want to think about it this way, because the computer, there's lots of people who are having computerized trading, where they go in there, and those are mega corporations, not like small people who are retailing, who are trying to do this at your house. They're actually having those mega computers that are doing all those big trades for them by a special program that reads everything. It reads the whole way of those patterns and everything else, and plays against everyone else. And this is why it's so hard for you to predict where it's going to go. So if you're going for something super short, it's going to be pretty hard for you to actually win this, but it's going to actually be a lot more expensive to go in the future. So let's take a look at something here. So we have a bunch of bids here for, and let's say that we are going to go and bid against Apple. Bidding against, which is going to be buying a put. So buying a put, we have a few choices for us to pick from. So we have the strike price. So we're trying to find out what the strike price is going to be, and those are in the money. And if you press on this, it shows you the in the money ones, and all the in the money are the blue ones. The white ones are out of the money and very unlikely to actually hit it off. So here is the put right here, and we have the different prices that we have here. So the best ones, of course, would be $175, which means that if it goes 175 and below, anything below that, and if it goes all the way to like 50, you make 100% of the money on it. Of course, this is the most expensive put out there, because you're actually taking a lot of the price value, which is above the actual sticker price of the site. Of course, you can go way higher if you wanted to, but it's going to cost you even more money. On the other hand, the 160 strike price, which is under this price that's going right now, which means there is only 6 points difference. If it never actually goes under that price, you're not going to make anything whatsoever. You're going to lose 100% of your investment in those options if you pick the wrong one. Therefore, what some people actually like to do is to go a little bit in the future and buy those puts instead, but the price exponentially goes higher. So the more higher up you go in the future, the more likely you're going to be paying a lot more price for those options. But the secret here is not that. What we are trying to do is instead just play the game and play the difference. And my favorite stock to play this game is of course Tesla. This one is more liquid, more likely that it's going to have a drastic move up and down. You want to actually play it a little bit before its earning call, because that's when it's going to exponentially drop or go up around that specific month, so you can get a very good price for this. So what you do is you have to go in. So what you do, you have to go in FinViz, type in Tesla, and you want to find out when its earning is actually coming out. Sometimes it's going to say somewhere over here in the news. At other times, what you have to do is to go into the company website. Just press on Tesla Inc. right here, and then try to find out when its earning is actually coming out. So in this one, you're going all the way in the bottom, and sometimes it's pretty hard to find it. In this one, they really don't want you to go in that much of investing. It's more like they want you to go in and buy the actual product. So it's really hidden somewhere in here. You have to go in there, and here we go. Press on investing, and over here you get investing information. So one thing you want to do is to take a look at as much information as you can about the investing, which upcoming events are coming, when is the earning, which is February 7th. Here we go, we found the earning call, and plus we can read about previous earnings here as well, which I totally recommend for you to do in order to figure out where this stock is actually heading. And by downloading and reading the previous quarter and the one before that, you will get a good feel where is it gonna head in the future. So that's one thing I do suggest for you to do. So the previous earning right here, November 1st, you can read the whole thing here. Just press on this and it tells you everything about the earning. You can even listen to it if you want to. It's super boring. Most of them are boring, not interesting. It's like maybe 2 hours, maybe longer. I have no idea how long this one is, but it's going to make you a lot of money by listening and figuring out where it's going to go in the future. Then, and plus, you're going to figure out if new product is going to get released. Maybe they're going to hint about something. Maybe you're going to say something about something, and you're going to be a little bit ahead of the game. So that's where you get the official information from. So after you do this, next step for you to do is to play the correct option. So February 9th would be the option we want to play, and that's because the earning is coming out around that time. And we already looked in here. February 7th is the earning, which means that February 9th is 2 days after, and that's the play that we want to play. So next thing we want to figure out what we want to play here, the call or the put. So what do we want to bet? And do we want to bet against the company or for the company? Against would be buying puts, for the company would be buying calls. So let's say, for example, they totally messed up, and in this quarter they didn't hit the results, everything is delayed and stuff like that, and maybe in the earnings, which is going to come up in a week or so, it's going to go and drop like 70 points in a day. So you want to go and buy something. So we have different strike prices for us to pick from. Strike price of the strike price of 337 and 352. But those are expensive. Look at this, 16 bucks to bid for this one, $9 for just one piece of that one. let's just press on one of them. So this specific strike price right here that we have here, and we can only look for what we want, which is what we want to actually buy. And those are the symbols. And we are trying to do the correct price for us to play with. So let's go and pick the one we want to actually trade. I'll press on trade right here. This one has the most open interest to it. And it gets us to the put right here, the actual put that we want to grab. So now we have a bunch of menu that we can pick what we want to get, and we are buying to open. So we have to buy to open. You don't want to buy anything else here. Buy to close is to close the option once you already have it. So to grab it, we are selecting one. We're selecting the date that we want, which is going to be February 9th. We're selecting the price that we want to bet. And the bigger the price, the higher up that we go. For example, if we want to bet the biggest bet out there, which is 450 all the way down to 0, it's exponentially expensive. Look, there's $103 for just one piece. And this one piece is going to cost me $10,000. That's how expensive that one piece actually is. On the other hand, if you play in the money, which is 345, let's go into 345 right here. Over here, the price for that is only, let's see, it's about $12. So the limit price would be 12.8. Big difference, huge difference, from 10,000 to 1,000 bucks. But if you really want to make some decent money on those things, by paying 1,000 bucks for this, you're not going to make this much money. But I mean, you will, but you potentially can lose 1,000 bucks in this whole thing too. Let's say, for example, it drops to 290. This is out of the money. Very unlikely to happen, but if it does, why don't you just go and play this instead? So let's play it to 290. 290 right here. It's going to be super cheap. Look at this. 0.81 right there. 86 bucks. Look how exponentially cheaper something like this is. So instead of buying one, you can buy 10. Well, you can even buy 100 if you wanted to, but that's like 8,000 bucks. Huge bet that this company goes under 290 in 1 week period of time. And this is too much of a gamble for me. But look at this, 86 bucks. This thing drops below 290 in the next week. Is it possible? Can it happen? Yeah, well, it can. We don't know this. Now, you can buy just one put betting for this company to drop this much. On the other hand, if you want to spread another one of your bets in here as well, why don't you just bet the other way around? And let's say this company hits the home run with this, and this stock goes up 100 points in a day. Well, I mean, not a day, but a few days. Very unlikely, but let's say it goes over 400. It's more likely for it to go over 400 in a few days than it's going to go any other way around. In fact, with the way Wall Street actually works, it's very likely to hit as close to 400, but never actually touch 400 itself. And this bet is just exponentially cheap. Look at this, almost nothing. There is the chances of this actually happening, they don't think it's pretty high, so the price is super cheap. But on the other hand, if it does touch this, you will see the price going from all the way from 1 cent all the way to 10 bucks or even higher. And therefore, if you bought one, you are not going to make this much. You bought 10, you're going to make more. 100, you might actually make substantial amount of money. And I will show you exactly what I mean here. If this actually does happen, this is like a super gamble that you're making here too. So this is how much we spent here. But the amount of money that we can potentially make here, if this bid actually happens with this strike price, well, it's 100 times that. And since we have 100 of those pieces in here, and it goes up by 10, this is some whooping amount of cash that potentially it can actually do. 56 here, maybe 15,000 bucks potential if it actually goes through, if this actually happens, in the very, very unlikely chances that it does. This 156 bucks can turn to an exponential amount of money. Of course, most likely this is going to just become zero. Most of the time those out of the money calls disappear. Now what you're trying to do instead is just play the game, which is if the price goes up, and it might go up for the next few hours, the next few days, right before the earnings, sometimes it goes up and down. If it goes a lot higher, and this bid right here from 1 cent goes to 2 cents, 10 cents, the price of it goes all the way to around 1,000 if this thing goes out of this range. And therefore, you'll be making some substantial amount of cash here. And you can just get out of it before the option actually expires. So that's how you play this game. You're buying this, you're playing it for a very short amount of time, and you get out of it as soon as you hit a good profit. If you stay for too long, you're gonna lose everything, because most likely it will never touch those out of the money strikes. And you're really trying to play the out of the money strikes whenever you can. The better ones are more advanced in the future. This is the February 2nd one, which is a few days from now, very unlikely to happen. February 9th would be more of the strike price I'll be actually playing if I wanted to play the earnings right here. February 16th, I'm not too sure about that one. This is a lot higher up in the future. So February 9th, you have a lot shorter period of time here, and then you're picking the price to play, which is 395 bucks here. And this one cost us 86 cents to play the game. There we go, 86 cents. Look at this, a whooping 8,000 bucks. Well, you know why? Because I got 100 of those. For $1, it's only 91 bucks to play this game, to play the call. So the call here with the strike price of 395. Now you can also buy the put, and with the put itself, you want to increase this exponentially higher, and there is more likely for you to get profit the higher you go, but of course the price is going to go up as well. So there you have it. Those are the ways that you can play this game and make some substantial money in the process. And of course you can lose everything as well. So what I suggest for you to do when you're just starting out playing this game, stimulate the cash, and before you go and play with real cash, if you are playing with real ones, don't get too greedy. Keep the options that you're playing very, very cheap. So if you're playing, if you're gonna go and play this, play one option and try to play cheaper games. So 50 bucks and under, until you figure this out. It's gonna take you a while before you get very, very good at this. And the more up in the future that you play, the more expensive it is and the less fluid those options actually are. So in the future, if you're getting those, betting the company is going to go substantially higher or substantially lower, the more option that you're getting over there, less likely somebody is going to play those options. It's going to be so much harder for you to sell that option when you want to get rid of it. Therefore, you want to have the most liquid options that are available, which are the most recent ones in a very recent stock that everybody is playing, such as Tesla. So I want to show you how you can play with options and get some money. And today we have a very nice opportunity over here. In a 1-year chart, you can see that this stock, which is Tesla, is trading very close to its 52-week average low, which is 244. Unfortunately, it almost never gets to the low price. Sometimes it does, sometimes it doesn't. So you have to take your opportunity when you have it. So over here, a few things you can do here is, first of all, you can set the alert to let you know when it reaches very close to 52-day low, and press on set alert over here, so I know exactly when it gets to it. Next thing what we are doing is looking at the extended chart, and we want to make sure that we are trading at as close to the 52-week low as we possibly can. Take a look at the 3-year chart over here. There is a potential, very slight potential, that it could go all the way to 192. So that's going to be the bottom point for a put if we decide to play it that way. And of course, there's going to be a top as well, which is around the $400 mark. Now, if you look at the 3-year chart, you can also see potential double bottom over here. Well, it's very close to the same exact range, which was around 240 once again. And here is the second one. So either we get into this trade right now, or we have to wait at least another $30. And this is very hard decision to make, because sometimes you might actually miss it, and missing an opportunity is actually going to cost you some profit. So let's go ahead and play it as if we are not going to miss this opportunity, and let's go ahead and buy and trade some stocks. And we are going to go into the option trade. We are not actually going to buy the actual stock itself. We are going to play the option instead. So over here, what you have to do is to go into the options, press on options, and type in the symbol we want to play, which is going to be TES 5. And now what we're trying to do is to find buy open, the actual price, and the quantity we want, which is going to be just 1. And here we are looking for the expiration. This is the most important part of this. We want to go ahead and play this the correct way. And the correct way to play this is to go ahead in the future. So when is the best time potentially where the stock market is going to reach the top is going to be what we want to play into. So April is going to be one of those potential points right before the holiday season, but that doesn't give us enough time over here. With Easter coming over here, I think there is a potential for the stock market to have a double top. And because of that, Easter is not enough time period for us, which is about less than a month. You don't want to play the weekly, because the weekly is just too dangerous, and often you're not going to make money with that. Instead, we have to play 2 months in advance. It at least going to give us more opportunity for the stock price to actually happen. So next thing we're going to go and do is look for the strike price. So most people are going to actually play, it's going to be 400. They think it's going to get to that. So over here, what we are looking at the options and how many people are playing the different prices and how much people are playing it as well. So as we're looking at the calls, we can see which ones are playing for the May one. And the 40x shows you how many people are actually buying that specific one. So 62 people are buying that one. If you keep going down, you can see that as the price goes down, the less people are actually playing it. But as the price goes a lot higher, you're going to see a lot more people who are playing that specific field. But some of them are not getting played at all. And in this one, you can see the bid for that one. There was only like 5 people actually trying to bid right now for the strike price of 380. And as you could keep going up here, the higher up you go, the less people are actually bidding on that one. Interestingly enough, lots of people are playing the 415 one because it's a cheap lottery ticket. So what you want to do is look for something like, let's say for example, the cheap lottery ticket is actually this one. A lot of people are seemingly playing that specific one. So we want to go into that one. So as we go into that one, it's actually 415, the strike price we have to play, and we're going to be buying that one at 415. Now what we are doing is we're buying the call. So our bet here is if the stock market is going to go up, and if it's going to close very close to $400 range, we are going to go and win on the upside of this trade. Of course, you want to buy something that will never happen. So 415 will be something that might never happen. If you're playing in the money, something very potential such as 380, the price of it goes exponentially higher, which is $1 for each one of those contracts. If you're going much higher, like 425, it's only 33 cents. But guess what's going to happen if it ever gets to 400? If it goes to 400, this one is going to become $1 and you're more likely to make money with this trade. And plus, it doesn't even have to get even close to 425. All it has to do is go up, and the value of your bid is going to go up as well. People are going to start bidding it because they're going to take and buy protection. So over here, we have 33 cents here, and the asking price is 42, and the last trade was 55. So if you want to get it right now, by entering something like 55, you might actually get it. And it only cost us $60 to play this lottery ticket right here. So this is buying the call, which is playing on the upside. Now you want to play on the downside as well. So let's say, for example, this is going to go down. So let's go ahead and buy the put for this. And the next thing we are going to be doing is buying to open, which is the same exact thing here, but the strike price is going to be different here. So right now it is trading very close to 275, and if you're buying that one and everything under it, $6 for this trade, which is $630, which is very expensive, and you definitely don't want to play something this expensive. So instead we are going to be playing the 195 piece right here, which is super cheap, extremely cheap. It's very unlikely Tesla will go broke, but let's say if something happens and Tesla really drops, the stock market drops, anything happens. Well, one thing is that if you're playing in March, there is not enough time for this to actually happen. Instead, the market top might happen around April or May, which is still not enough time for us to play. Instead, we have to go all the way up to September. So what we've seen is with the inversion of the yield curve, it is very likely we might have an actual recession happening and coming. And since we might have a recession, or even much longer in the future, playing on a put is going to be very beneficial for us. Unfortunately, everybody else is playing the same exact game here. So 150 is going to cost us $7 for September. And if we go even more in the future, price of it even goes much higher. But it is a smart thing for you to play with. So 9.8 is going to be pretty expensive play here, betting on the demise of Tesla, which is going to cost us a whooping $1,000 over here. So instead, I suggest for you to go and play a shorter time period such as June, which is only going to cost us $2.84. So that's not too bad. It's 289. Now, if you want to play this game and bet on the stock market crashing, you definitely can play on the SPY. So what is the SPY? The SPY itself is the S&P 500, and it is the cumulative sum of all the different biggest companies in the world right now. And they're all trading in the stock market. So if you want to bet on the stock market totally dropping, you can see something that looks like a very classic top here, where we have the highest amount reached around September. Now we have something that looks like a second top that is being formed. And double top, it's not good. So if the stock market is going to drop, it might go all the way to 220 or even lower in the year 2020 or something close to it. And you definitely want to make money if it ever goes down. So what we're going to do here is go ahead and bet some options on the SPY. So opening up the options field over here, we can go ahead and see this is an Apple option actually, and I wanted to go into something else, which is going to be the SPY. So let's go and play that one. Option field is going to be SPY itself. Press on go. And here it is. So we have even better field over here, and we can see the trading for the weekly for it too. Specifically, what we are looking for is not the weekly, is actually the monthly of April, but we want it a little bit farther down the road, which is going to be May. And May is historically known as not a good month for the stock market, like sell in May and go away. I don't know if you heard it before. So May itself, we have a bunch of different people trading different things over here, and we are specifically looking for a strike price of around 200 something. So let's go and look at $200 stock price, and there it is. So the bid is 10 cents for this trade. So let's go and press on the trade. And now what we are doing here is playing the put on this. So pretty much what I'm going to be doing is playing and putting a put on the SPY, which is betting against the entire stock market for the month of May. And this one is not going to be market. Don't ever put a market order on this. You're going to get screwed so bad. People are just going to sell you at any specific price. So put a limit for that at 11 cents, which is what it's trading for. And you can bet on the entire stock market for as cheap as 11 cents for now. Now, why is it so cheap? The reason why nobody ever thinks that it's going to drop so bad in such a short period of time, which is 2 months. If you want to make sure that you're going to be in the money, you might as well just bet on the entire thing, which is right in the money, which is 279 bucks. It is a more expensive bid here, but at the same time, you're more likely to actually win in case the stock market goes down. But it's going to cost you so much more money. So 546 limit over here for this price. It looks like the asking price is 549. Let's not worry about a few cents over here. And overall, $500.50 is going to be what we can actually play this on, betting on the whole stock market falling for that month. Now you want to actually put a reverse trade just in case you're wrong. So a reverse trade would be putting the call in, which is betting the stock market is going to go up. Instead, the stock price for that is going to be a whooping 300. When you get to the $3,000 mark, which is everybody is not really sure it's going to hit, but I think it might actually. There's always a chance that it could do exactly opposite of what you're thinking about. And this one, to get a call for this one is super cheap actually. So this is a very good lottery ticket here. In fact, this is the cheapest lottery ticket I ever seen. For 23 bucks. You're actually betting that in May, the stock market is not going to go down, it's going to go whooping up. And you can make exponential amount of money playing this. Instead of buying one contract, let's just go ahead and go for 10. 10 contracts is going to cost us 190, but since it's options you're playing with, your potential winning here is 10 times whatever amount that you're playing on it. So it could be 1,900 bucks that you're winning on a $190 trade. And if you want to make even more money, you got to play it even bigger. Around $1,800, putting it on a lottery play like this might actually get you almost 20 grand. So this is thinking about and playing it big. And of course, you got to put two different kind of plays at the same exact time, just in case something goes wrong. So this way you win either way. Since I'm not a financial advisor, I can't really tell you what kind of stocks to actually buy or sell. The only thing I can do is to educate you and tell you what kind of things you need to know in the stock market that help me make a wise decision in it. Now, it's really up to you to find a financial advisor that's going to work for you. So before you actually do this, I highly suggest for you to go about and find an individual that you can work with. And if you want, just find a company that actually invests money as well. So those are 3 different methods that you have. One is to go about it yourself and invest money without a brokerage, or you can find a company that specializes in investing in the stock market, or you can even get an individual who does that. The most important thing and the most important advice I have for you is to just check the history and see what kind of things this particular person actually did, if he has a certification, license, how long he's been in this business, what kind of violations or complaints there is about him. And brokerage check will actually tell you if this brokerage or the person who is selling stock, if he's registered, it can tell you what kind of disclosures actually happened here. And it can tell you about his experience and what kind of stuff a brokerage can or cannot do. Lastly, the brokerage check, it cannot tell you if your money is going to be well managed. And it also cannot tell you things about other financial industries as well. So you can go to the site, you can learn a lot of things about it, but I think it's a very good idea for you to find out everything you can about whoever is managing your money.
Hey, my name's Riley, and Michael and I are super excited to start teaching you this strategy. First off, this course is going to be building on itself, so make sure to watch it in order because if you skip around, things might get confusing. Now, another thing is with this course, you also are going to get a psychology course, and what this course talks about is the strategy and how to execute the strategy and how reading the charts and everything works. And the psychology course is going to dive into the emotions of trading and how emotions affect your trading. I'm a super firm believer that it's not the strategy that keeps a lot of people from becoming profitable. It's actually the emotions of trading and how your emotions affect your trading on a daily basis. And so we're going to dive into what that is, how to fix that, and how to spot it and deal with it so you can actually start to become profitable when trading. Now let's actually get into what we are trading. We are trading futures and specifically the S&P 500 futures, the E-minis, right? And so why do we trade these? And so first off, these don't trade like normal stocks. If you're really new to futures and don't really understand them, I would definitely do some Googling and get some basic research and learning out of what they are. But so first off is normal stocks, they don't trade like normal futures, right? A one increment move here is not a $1 value increase like a normal stock, right? This is called 1 point when it comes to futures, and 1 point is worth $50. And that's what we look to scalp here in this strategy. We look for 1 point trades, and that's how much we're in the market for. We just go up for that 1 point and then we're out, right? And so these points, they actually break into what's called a tick. And the tick is the smallest amount of movement that the market will move at a time. And one tick is worth $12.50, and it's essentially a fourth of 1 point. So here we have that 1 point, and then there will be 3 other increments between there. This will be the 0.5, the 0.75, and the 0.25 here, right? And so that's how the market breaks down, and that's how it moves. And so another reason why we trade the ES futures compared to any other futures out there is because this is one of the most liquid markets out there. And so what this does is because we're scalping, we want to be in the market quickly and out of the market quickly. And so you need a lot of volume to be able to do that, right? And so that's why we trade in a very highly liquid market. And as well, we want to be able to scale up our contracts. We want to start with 1 contract, but we want to potentially scale up to 10 or higher than 10, right? And this market allows us to easily do that. Now, the last thing as well is we trade a 2000 tick chart. And so normally, most people are used to hearing about a 1 minute chart, a 5 minute chart, a daily chart, right? And all those mean is that a candlestick here is for a 5 minute chart, that represents 5 minutes of what the market did, right? Now, in our instance, a 2000 tick chart, don't confuse this tick with this tick. Okay, generally when I say a tick, I do mean the price movement, but in this case, a tick chart measures a number of trades. And so for our instance, for a 2000 tick chart, that means each candle shows what happened over the last 2000 trades in the market. And so what this does is instead of having a candle show up every 5 minutes, right? You have a candle show up every time 2000 trades is created. And so this can cause the market to move very slow if there's not many trades happening, or very fast if there's a lot of trades happening. And so that is how we trade. And why we use that is because it's a really good time frame for scalping that we have learned. And also it allows us, compared to a time frame chart, it allows us to see that volatility and movement in the chart, essentially just watching how fast the candles are printed, right? And so what are some expectations and goals of this strategy? So we're not trying to make really big returns or huge percentage returns, right? We don't even look at percentage returns on what we're trading. We are looking at actual dollar value, and we're looking for a daily income. We're trying to look at consistency over the long period. And so how we do that is we look to just get 3 to 4 trades a day. And what this allows us to is it gets us a good amount of trades to have a consistent income, but also we don't want to go further than that because it causes us to take too many trades that will make us have a lower win rate. And with this strategy, we want a really high win rate. And so to set your expectations up for the strategy and when you could become profitable is it will take longer than you want. It took me over a year of simulated trading to get to a point where I felt comfortable actually trading with real money. You need to start out trading on a simulator with this strategy because you will most likely be losing money right away with it. There's no reason to risk real money with the strategy when you still have so much to learn. So what those kind of win rates look like is you're probably going to start out with a 50% win rate. And I started out with that, right? I would take a trade, I would win, and then sometimes I'd take a trade and I'd lose, right? And because we're scalping, we're usually risking more to make less. And so because of that, we need a high win rate to become profitable, right? And so if you have a low win rate, you're going to be losing money. And so that's where the beginner area is. That's kind of when you are still losing money, or you don't have a high enough win rate to become profitable, right? But as you learn, you will start to become profitable once you get into the intermediate level. And so the learning stages of trading will kind of look like a stair-step pattern. You'll learn a ton, you'll kind of hit a plateau. It'll seem like, okay, now I'm ready to trade, right? And then all of a sudden you'll break through another barrier. And so it'll kind of stair-step up like this. And so one thing will happen is at some point there will be a line up here where once you get past this amount of learning, this is where you'll actually become profitable. And that's what we want to get you to. We want to get you in this profitable area. And learning curve for trading will always be like this. Even once you're profitable, you will always be learning more and more about trading. And so keep that in mind. Whenever you feel like you know everything, you probably are only just getting started with how much you can still learn and how much you can improve. And so that's why you can get higher than 80 plus win rate, because there is so much to master and there's so many little fine details that can improve your trading. So now let's look at some numbers. So let's say you're taking 4 trades a day and you are trading 1 contract. You should start out with 1 contract because to keep our risk low. And so once you start hitting that intermediate win rate of 70%, you are starting to become profitable. Now, just with 1 contract, it's not that much, right? But as you get better and better, you start to see the numbers start to get a lot higher and you start to actually get a really decent income and a supplemental income once you start to get to 75, that higher level of that intermediate win rate. And so other than increasing our win rate, how do we increase our profit? We actually want to increase our contract size. We want to make this a higher number to increase our profits. Because the biggest thing with this strategy is we want a high win rate. And if we start to trade more to try and increase our profits, our win rate is going to go down. And so to increase our profits, we want to actually increase our number of contracts so that it will keep our win rate as high as possible. So let's say we switch to 4 contracts now, and you can see the numbers start to explode. Even with that intermediate win rate, you are potentially making 6 figures a year with 4 contracts. And so if you only have a 70 or 75% win rate, don't harp on yourself and be annoyed that you're not getting an 80 or 90% win rate. You really don't need that kind of win rate to be profitable with this strategy. You only need a 75 to 80% win rate. And then once you start increasing your contracts, the money will start increasing. And so that is the biggest thing. When you're starting out, don't think about number of trades, think about win rate. The biggest thing we want is the higher the win rate, the better we are going to do. Now, in terms of brokerages, we suggest using NinjaTrader. They have really small fees and pretty low margin requirement per contract. Now, if you can't use NinjaTrader, try and get a broker that has low margin requirement and low fees, because those are pretty big things to scalping. Now, in terms of other brokers out there, if you're outside of the US, I can't really speak on what's gonna work for you. There will be people in the Facebook groups that might be able to help with that. And in terms of like brokerages like Toss, their margin requirements will be in the thousands. And so you won't be able to have a small account and it will make it harder for you to start trading more and more contracts because you will start to have a very large account size. Now with NinjaTrader, you can start with a really small account. And so we suggest when you actually end up switching to real live trading, start with one contract and start with about $1,500. There isn't much reason to risk more than this because we don't want to put too much money at risk right away, right? Maybe you'll put this money in and then you will realize that you're actually not ready to live trade and you'll lose that money and you'll have to go back to sim trading. And that's part of the process. That will happen sometimes. And so in case you jump into live trading early, we want to risk as little as possible in case we need to jump back into sim trading and then sim trade for maybe a couple more months, and then you're ready to live trade. And so that's why start off with a small account and one contract. Now, in terms of when can you trade this strategy? So in normal market conditions, volume has a pattern throughout the day, with the highest volume being in the morning, the lowest volume being in the middle of the day, and then the medium amount of volume being towards the end of the day. And so this happens because in the morning, that's when all the day traders and everyone's starting to trade, and most people trade in the morning. And then come 9 a.m., that is midday on the East Coast. And so that is when a lot of the big banks and hedge funds, they're going for lunch and taking a break. And that's kind of when just volume kind of settles down for a while. And so the chart will be moving a lot slower. And so come after that, when they come back from lunch and you start to get towards the end of the day, time will start to pick up and the volume will start to go faster and faster. And so with this strategy, you can trade any time of the day. But just keep in mind, when the market is in kind of its normal movement, these are how these sections of the day are broken up. Now, when the market is selling off, this can just get thrown out the window. Any time of the day, there will be a ton of volume when the market is going crazy. And you can go and look at a chart for maybe an hour or two any time of the day and get 3 to 4 trades very quickly and be done for the day. And you won't have to maybe wake up very early and trade that morning hour session if you don't want to. Or you can come in at the end of the day and kind of trade later in the day as well and still get your trades. Now, one big warning thing is don't trade the last hour or half an hour of the day, because that's when big investment firms will make large bets and they can make the market become very volatile and sporadic. And so you want to be aware of that because that can change what happens in the market. And when we're trading, we are looking for predictable, methodical movement. And come the end of the day, that can sometimes change. And so we want to avoid that because that will affect our trading. And so with that, we're actually going to wrap up this section and dive into the strategy part of the course. So now how do we go forwards and turn this into a profitable strategy and actually make this work? And so first off, I want to set your expectations right. Start out paper trading and understand that it could take you a year or more of paper trading to become consistently profitable. When I first started out, I was losing way more than I was winning, about 50% win rate. And with the strategy, that you're losing money, and that is okay. It takes a long time to get something like this down, especially if you're new to trading. There is going to be a lot of hurdles and a lot of plateaus that you're going to hit. And then out of nowhere, you're going to break through that plateau and you're going to say, oh, wow, I just got a lot better. And that's going to happen a lot of times. Your learning is going to have kind of a stair-step pattern. And at some point is going to be where you're actually profitable. And so you have to get up to that level first before you can even think about live trading. And so once you start to hit that profitable level, you want to see consistent profits over at least 1 to 2 months, because sometimes you could get lucky. You could be consistently profitable for a week. That's not enough time to say, okay, you are good at this and you can actually risk real money and start making an income from this. Sometimes maybe a week works really well. And then the next week you just have a day where you just blow up your account, right? Because the market does have different conditions. And so sometimes the conditions will be really good and then they'll switch up and you won't be used to that market condition and trading in that market condition. And so you'll start losing money because you haven't learned how to trade in that market condition. And that kind of goes back to our trading in a choppy trend. Maybe you're used to trading in when it's very directional, but as soon as it starts to chop, you just start losing a ton of money. So you need to learn how to trade in that sideways trend. And that, I would say, is definitely the harder version of trading compared to trading in a directional market. And also in terms of conditions, if you're tired or emotionally stressed out, don't trade. There's sometimes days where I skip trading because I didn't sleep well, I have something on my mind, or I'm just not feeling good about it. It is okay to skip days. The biggest thing is, again, to make money consistently. And if there's something that is losing you money or potentially going to lose you money, maybe you shouldn't trade that day. Now, in terms of scaling our account, don't just scale up as your account goes up in money. So with NinjaTrader, we can trade one ES contract for every $500 of margin. Now, it will not take very long if you're consistently profitable to get $500 in your account to make another contract. And so that is really exciting. You could scale up insanely quick. But the thing is, the amount of money that is on the line as soon as you move up a contract, like let's say if you're trading one contract and you want to move to two, you are doubling your max loss and you're doubling also your max profit. And so that can mess with you emotionally. There are so many emotions that go into trading, and doubling your contracts like that or increasing your contracts will cause a ripple effect in your emotions to amplify every emotion you have because you're now trading more than you're used to. And so you only need to do that when you're actually ready. So let's say if you're starting off with a $1,500 account and you're trading one contract, maybe only trade when you get up to $5,000 or something. Maybe that's the only time when you want to switch to two contracts. You don't need to be scaling up very quickly. If you're making good money with one contract or two contracts, there's no reason to scale up until you are really, really ready. If you're still learning and making mistakes, it is okay to stay where you are at. And so the biggest thing I just want to reiterate again is start out paper trading. And don't expect to have this be a winning strategy in a week or two. It takes a lot of time to master something. There will be times where you'll have a week or two where it'll go really well, and then all of a sudden you'll have a week where you blow up your account because you accidentally took too many trades or something happened. You have to be able to control all those swings so that over time you can be profitable. So let's look at candlesticks now. It's super basic. What candlesticks are is they represent what the price does over a certain time or a certain whatever that candlestick chart tells us. Now, we look at a tick chart, so our candles tell us what happened over the last 2,000 trades. For this candle right here, the market opened up here at whatever this price would be and then closed at this price. And so that's what the body of the candle tells you. And the green part tells you that it opened down here and closed up here. And then we have the high and the low. That tells us where the high and the low was of that trading range in that certain candle. And the same goes for the other side, or a red candle, except the open is up here and the close is down here. And the wicks tell us where the highs and lows are. Now, this is a super basic concept that most people already know, but one thing that people don't really think about is each of these candles have their own trend in them. So if we think about it, this candle here represents what happened over 2,000 trades. And so what does that mean? That means that if you broke down and if you printed each of those trades, it would show you a trend or almost a chart. And so what we can gather from these candlesticks is a mini trend. Each of these candles represents a trend on a mini time frame, right? And so think about if you blew up to a larger time frame, the candles we look at, they represent the trend on that time frame. And so if we look at this candle right here, right? What does this tell us? This tells us that the candle opened here. The price might have sold off all the way to the low here that we can see. And then it went up to the highs, topped out, and then closed here. And so that is a trend in its own. And so this is what we want to be aware of when we are looking at each candlestick, right? And so if we go on to this one right here, this candle in here, this is called a doji. And so this is just a really neutral candle, and the price hasn't really gone anywhere over the time frame, right? It opened here, maybe it traded up, maybe it traded down first, it made some kind of high, traded all the way down, and then ended up closing at the same price that it opened. And so for our purposes, that kind of shows a sideways trend. And we don't like trading in a sideways trend. We want to know where the trend is. And so this next candle over here, this is a really clear-cut example of this candle just opened here. And during that, the price pretty much sold off. The price could have been in a more movement like this, but it opened at the highs and closed at the lows. And so that represents a really strong downtrend. And so going forwards, these are things we want to be thinking about when we are looking at candles. And so as we've started to narrow down on how we enter in trades, right? Think about our first thing we looked at was, where is the overall trend of the market, right? We want to know if the overall trend is up. And so now when we enter a trade, we want to know that we have that overall upwards trend, but we also want to have a candlestick that is telling us that same story. And so we want everything to be in alignment. And so that's what we are looking at here. And so if we go on to this next slide, this is what we call the signal bar. And so this is the bar that we enter off of, or that signals our trade for us to get in. And so if we just take a quick look at this chart, right? Here's a high. We move down, right? Here, make one leg up and then make another leg down. So right here we have a two-legged pullback from a move up. And we're just gonna, for the sake of this trade, we're gonna assume that we are in an overall uptrend. And so now that we have our two-legged pullback, this is where we want to buy in. We want to buy in before we make that next move higher. And so that's what this bar right here is telling us, because if we go back to how we count legs, a new leg higher is when it breaks above the high of our leg down. And so this bar right here, when it broke above here, that's a new leg. And so we want to be in the market when it does that. And so that is how we enter a trade. And so that's why this is called the signal bar. And this is the bar that puts us in the market. And so here for this two-legged pullback we have right here, right? This is the signal bar. And this is what tells us to get in. This is the final confirmation. We want this bar here to be a bullish bar if we are looking for a long trade. We want the trend of this signal bar here to be in alignment with the overall trend. Now with these signal bars, we want them to be in alignment with the direction of our trade, right? So if we have a new high here, here's one leg down, a pullback, and then a second leg down. So this is a two-legged pullback. And so what we want is we want our signal bar to be bullish, because this is a long trade. We're looking for it to go to the long side. And so we want to make sure that this signal bar that we have is green and a bullish signal bar. So here we have that leg down, right? And so the moment it breaks above the bar, that's when we want to be in the trade, or that's when it signals the finish of that second leg pullback, and it's going to start continuing up. And so here you can see it breaks above here. And so this, because it breaks above here and this is the finish of that leg, that means this candlestick right here is our signal bar. And you can see that if we're looking for a long trade here, this signal bar is really bearish and it's not a bullish signal bar. And so this is not a trade that we would take, because this signal bar is red. And even though this bar right next to it was green, this is not a trade we would take, because the trade would have been right when it broke above this. It wasn't when we wanted to get in. Now, even though this bar here next to it was really green, because it had already broken above this bar here, this was designated the signal bar because it broke above that. And so we can't change that. And so we have to skip this trade. And we will definitely get into this more as we get into actually executing trades and how we execute in those. Now, if we look at, here is a really strong list of what bullish candles look like. And so kind of from the left side to the right side at this top area, this is basically the strongest bull candle to more weaker bullish candle. But these are pretty much, this top row is all really solid signal bars. If you have any of these as your signal bars, that is a really good possible entry. And then down here at the bottom, these two right here are still really solid signal bars. But once we start to get into where the little story of the signal bar is choppy like this, and then especially a doji here, it starts to get choppy and it doesn't align with what we're looking for. And then of course, once these signal bars start to look red, for a long trade, we would not want those. And then if we were taking a short trade, any of these green bullish bars would be a really bad signal bar because they would be against what we're looking for. And so here's two other cases here. Sometimes when you have a really small signal bar, let's say you had a really big red bearish bar right here, the market just sold off really hard. If you have a little green bar here that technically signaled you into a long, sometimes it's actually not good to take that trade because this will just be a little bit of a pullback before a big sell-off. So that's definitely something to keep in mind. If you have a tiny signal bar next to a huge red bar, sometimes it's worth skipping on that trade. And then as well, this bar right here, this is still a bullish bar. Even though the candlestick is actually red, think of the story that this tells, right? The candle opened here, it sold off, and then it recovered here and closed. And that is still showing us a bottoming pattern. If we're looking for, the overall market to do this and then go like this is still a good bottoming pattern. And so this is still a bullish signal bar that we are okay using for a long trade. Now, if we move over to bearish candles, it's pretty much the same thing, just flipped. And so all these are really strong signal bars for a short trade. They're really bad signal bars for a long trade. And the same with these two right here. And then once you kind of get into these, things are a little iffy. You really don't want to be taking these as a signal bar because they are just choppy and, again, they're against the trend. The same thing with a bullish candle, right, this is against if we're looking for a short trade, any type of these candles are against the trend we're looking for. And then of course, here's that example of that really small bar. If there was a really big run up and then you had a tiny little move here, if you tried to take a short on that, sometimes that's not a good signal bar because the market might just be pulling back a tiny bit because it just had a very large move up. Now, that's kind of an advanced concept, but I did want to just slip that in there. Now, and then of course we have this. This is a good bearish bar because again, it's showing you that the stock opened here, tried to move higher, and then sold off. And so that is still a good reversal candle. And so this is good to think about for every candle you think about, but the majority of this is for thinking about when we're looking at the signal bar. And we will definitely get into that a lot more when we actually look at entering trades and executing trades. So now let's look at some basic strategy concepts. What this strategy is mainly based off of is the idea of the market rule of two. And now what this is it just means that the market likes to do things in twos. And so a really simple example of that is the market here makes an extreme. It attempts to break through that resistance line once, and it breaks through that resistance line on the second attempt. And so that's kind of the idea of the market rule of two. Of course, this doesn't happen all the time, but the idea is that the market likes to do things in twos. And so that is what a lot of these strategies are based off of, is the market rule of two and the market moving in pairs like this. And the second attempt to do something is usually where we are getting into a trade. So we have three basic strategies we look at. These are a two-legged pullback, a higher low, and a failed two-legged pullback. Now we're going to dive into each of these, but essentially, if we don't see these, we don't take a trade. Now there are a ton of things on our checklist that we're looking for, but these are kind of a really big part of our strategy. And so what you can do here is what is great about this strategy is these can work either to the long side or the short side. So we don't care which direction the market goes. We can trade the market in an upwards trend or a downwards trend, or even in a sideways trend. These are just those trades on the flip side. You have our two-legged pullback that goes down in a downwards trend, a lower high, which is the opposite of a higher low in an uptrend, and then a failed two-legged pullback. And a failed two-legged pullback is essentially a two-legged pullback, but it's essentially a trap. And we'll definitely dive more into that and what that means. But the biggest thing is if we don't see these setups, we do not take a trade. Now, if we look at our first example, a two-legged pullback, this is kind of, I'm sure if you've been in the Facebook group or watched any of our videos, we mention the two-legged pullback all the time. This is a trade that is super consistent and it follows that market rule of two. And so this is what we're just looking at here. This is just saying we're in an uptrend. And then what happens for this two-legged pullback is here is one pullback and then here is the second pullback. And so the idea of this trade is that the market moves up, has a pullback, it makes one attempt higher, has a second pullback, and then when the idea is that if it makes a second attempt higher here, it's going to resume the trend, or at least go in the direction of the overall trend long enough for us to make our scalp that we're looking for. When we see a pattern like this, we are looking to enter essentially right here when it switches back into that uptrend. And so again, we have that move up, that with the trend. Here we have a long trade. This is an upwards trend. We have that first pullback, and then we have a move with the trend, and then a second pullback. So here is that. And so this high right here does not break this high. Essentially, it is the market makes a high and makes two legs lower and then continues and possibly breaks that previous high. So if we flip to a couple more examples here, this low right here, this can change. The low that we enter on can either be, it can be a double bottom like this, it can be lower, and it can be higher up here. That still is a two-legged pullback. We still will have that high, that first leg down, and then that second leg down. And then this is where we are looking to enter the trade, and then it continues with the direction of the overall trend. And so this is, again, why we want to know where the overall trend is, because we want to be taking these trades with the overall trend. Now let's look at this to the short side. A two-legged pullback works to the long side, but here is also a short side example, or what I mean by short is a bearish example. We're looking to bet that the market is going down. This is a downwards trend. So here we have the overall trend is down. The market moves down. It makes a new low. We have one pullback here and then a second pullback here. And then again, this is where we look to enter. We look to, going back to that market rule of two, that second attempt to continue with the trend. That is when we look to get into a trade, because we are betting that is with the trend, it is going to create movement in that direction enough for us to get our 1 point scalp, right? We're not looking to predict that it's going to make a massive move to the downside. We just need a little move here to get our 1 point scalp, and that's all this setup is for. That's all we're trying to do with this strategy. And so just like the last example, this two-legged pullback can look a lot of different ways. And so once we look at more live examples, you will start to see that it's not always going to be super clear like this, but the concept and strategy still works the same. Now let's look at a bullish trade to the long side, trade to the upside, a higher low. And so this looks like a lot like a two-legged pullback. A higher low works really well after a two-legged pullback trade has already worked. So here's our up move, here's our new extreme or a new high, here's that first pullback, here's that second pullback, and then if we were trading, here's that trade we would have taken. We would have taken a two-legged pullback to the long side and hopefully gotten a scalp out right here. So the market then decides to make another move down here. And then the idea here is if the market moves up and looks like this is going to be a higher low than this one. And so what that shows us, it confirms the overall trend again, because this essentially, you can start to draw a trend channel off of this. And so that's what we're looking for, is this is a confirmation that is continuing with the previous trend. And so this is an area where we look to take a trade. We are assuming that it is going to go with the trend and it's going to make a move higher like this, enough for us to get that scalp out. And so again, just to show you what that looks like without any drawing on it, this is that higher low we are looking for. Now, let's flip this to the other side, to the downtrend side. Here is the same thing, just in a downtrend. We have that new low, that first pullback, that second pullback. Here's that area where we would have taken that trade to the short side. We would have got our little scalp out here. And then the market decides to have a little bit of a pullback here. And this is again where we look to have a lower high right here, because this right here, if it decides to turn down, is a lower high. Now, we don't know that this is going to turn down. This could decide to just go up, right? But what we're assuming here is if the market decides to start pushing down this way, then we jump in a trade right here because it is starting to confirm that lower high. And then when we jump in our trade and the market continues to go down, we then get our scalp out. And that's how this trade works. We don't know that the market is going to, make this move down after this two-legged pullback. We don't know it's going to make this move down after this lower high. We can only guess. We don't know that that's going to happen. And so what we do, and a lot of what trading is when you're actually live trading, is having a visual of what the market is going to do or what the market would look like to have a trade you wanted. So an example like that is if we just looked at this two-legged pullback here, right? And we don't see any of this. And we're looking to take a trade here. We don't know that the market is going to go down, but with the assumption that the market's going to go down, this is an area that we want to get into the trade. And so it's kind of like looking into the future without knowing the future. We just want to be like, okay, we see this setup here. We want to take this trade to the short side. And we're just going to assume that this is going to happen. And so that's the same with something like a lower high here. We see this happening. And so we're going to assume that if it does make a lower high here, that this is going to happen. And so we want to trade that. And so I'm sure a lot of this is kind of an overload, but it will start to make sense with either rewatching these videos or just as we go along with the course. Now, let's look at a failed two-legged pullback to the short side. So this is a trade setup that is definitely a little more complicated and advanced. It is technically a trap, and don't worry if this is just over your head right away. The main thing is that this is here and you can always come back to this when you want to learn this. So the idea of the failed two-legged pullback is it always goes with the overall trend. So what we have here, right, is an overall trend of the downside. We have a new low and the market decides to start pulling back to the upside, right? And so what this is this is still a little mini trend to the upside. And so we have a new high here. And what we have after that high is a two-legged pullback. Here's one leg down from that high, and then here is a second leg down from that high. Just like that first example we were looking at, this is just a smaller version of that. We still have that uptrend, and then a first pullback, a second pullback, and then here is where you would enter that if it was in an overall uptrend. But the idea here is that our overall trend is to the downside. We don't want to take a trade to the upside because that's counter trend. But some people are not going to do that. Some people are going to say, I have an uptrend here. I have a two-legged pullback. I'm going to take this trade to the long side because maybe the overall trend is bottoming and I'm going to buy the bottom and the market's going to shoot up and I'm going to make a great trade. And so that can happen. That is totally possible, right? But the idea is that is unlikely, and we want to be taking trades with the trend. And so the whole idea here is the market does make a tiny attempt higher, and those people will start buying, and then the market will start to fail. And that two-legged pullback will not make that scalp, and it will start to reverse on those people, and it will start to look bearish here. And so this is where we want to be entering a trade to the short side because it'll start to sell off here and continue with the overall trend. And so that is the basic idea of how a two-legged pullback works. Is again, you always want to be trading with the trend. So even if you see something like this two-legged pullback right here, because the overall trend is down, you do not want to take this to the long side. Some people will do that and trade counter trend, and the market will then reverse on them. And this is where we want to enter because that is the smarter trade setup and that is the higher probability setup. Now, let's look at this on the flip side to the upwards side of the trend, right? And so here, just the exact same thing. And so here, this is pretty much the exact same thing. It'll look a little different, but essentially this is how it works, right? Is we have a uptrend, we have a new extreme, that is okay. The market decides to start pulling back. We have essentially a little mini downtrend, right? And then so if we're thinking about a two-legged pullback to the short side, we have a new low, we have a first leg pullback, and then a second leg in that pullback. And so in terms of a two-legged pullback to the short side, this would be a great spot to short. And so some people will do that again. But because our overall trend is to the upside, that's a counter trend trade, and we don't want to do that. And so this will start to potentially reverse. And so if we see this reversing and continuing with the overall trend, we look to take a trade to the long side, and that is where we can get a scalp out of the market and complete one of our trades. And so this is essentially the overview of what these setups are. Now, we are going to actually get into how to count a leg on an actual chart because I know there's a lot of confusion on that. And so we're going to actually take a quick shift and talk about that first, and then we will start piecing together this strategy. So being able to identify the overall trend is going to be the bedrock of our trading strategy. We always want to be trading with the trend. And that is because trading with the trend is going to increase our overall win rate. And that is a huge part of our scalping strategy. We want to have a very high win ratio. Counter trend trading is very ill-advised. There are trades that are possible, but whenever you're counter trend trading, you are going to be losing that little edge that the trend gives you. And so always trade with the trend. Now, there are three major types of trends. We're going to have an upwards trend, a sideways trend, and a downwards trend. Now, the way we identify these is looking at the highs and lows that are made in the trend, right? And so an upwards trend is going to be making higher highs and higher lows. Every time it reverses in either direction, the high is going to be higher than a previous high, and the low is going to be higher than a previous low. And so it's making a stair step pattern upwards. On the flip side, that is a downwards trend is going to be making lower highs and lower lows in a stair step downwards pattern. And so these are the two directional trends. And then a sideways trend, the highs are going to be relatively similar and the lows are going to be relatively similar as well, kind of being in that choppy pattern. Now, a sideways trend is a lot harder to trade than a directional trend. And so whenever you're in a sideways trend, be aware of that and be extra cautious. Generally, the better trades will be in an upwards trend or a downwards trend. Now, when we're actually identifying trends, they're not always going to be as easy as one of these drawings, right? They're going to be on candlesticks. And so what we want to be watching is for those highs and lows. And so even if a low is slightly bit lower or a high is a slightly bit lower, generally if you see that lower low and lower high, it still is going to mean that it is in a downtrend, even if it's not as clear all the time. But whenever you are not clear about a trend, that is okay. And that just means that maybe you want to take a step back and get a better picture of things. So let's actually look at a chart here and look at some real examples of these trends. So here on the left side, you can see we have an upwards trend. And so this is pretty prominent by the fact that it's making higher highs and higher lows, right? Overall, the trend is up until we get about here when it starts to essentially become choppy, right? The highs and lows are all over the place. You can't really see if it has a direction. Now, one key note here too is look at the EMA here. We're going to talk more about the EMA later, but the EMA is still generally a pretty good way to see the trend. And now, of course, on this side, we have a downwards trend, and that's just denoted by looking at how the highs and the lows are changing as well, right? And so with this strategy, we don't have to predict when it's going to make these shifts right here, right? When it makes a shift from an upwards trend to a sideways trend to a downwards trend. We don't have to do that. When we are unsure of the trend or when it's making a shift like this, we can wait for the price action or the market to show us what is going on. So when the market shifts like this, we can wait until about here to really say, okay, we're in a downtrend now. And you can start being like, okay, now I can take trades to the short side because we're in a downtrend. And so don't feel pressured to trying to be predicting the trend a bunch and having to know exactly when it's shifting or where it's going. That it is okay to be patient and let the market show you what is going on. Now, this is generally the size of trend we're going to be looking at, but there are always trends on lower time frames and higher time frames. And so what I mean by that is if we actually just zoom out on this chart, you can see that there are broader trends as well going on, right? And so if I zoom out to this is a couple days, you can see we are in kind of an overall downtrend. And so that is something to be aware of, but that doesn't really affect our trading because we're trading on such a small scale and such a short time frame. We don't have to worry about that overall trend as much. Generally, what we only care about is the trend during the current day and over the last couple hours or maybe even half an hour, depending on how quickly the market is moving. And so here, this is essentially the current day so far, right? Here is about midnight, and then here's about the market open. And so this is the current trading session all through here, right? And so here you can see that overall, the market so far is in a pretty big, it's in an uptrend, right? But during these smaller trends here, here's an uptrend, here's a little downtrend, here's an uptrend, right? And then here's that downtrend. You can trade all those directions. You don't have to stick only to the one direction over the day as long as there is a good enough trend established in that direction for you to make a trade. Generally, the idea is we want to be identifying the underlying trend that is happening, and we want to be trading in that direction. Now, let's jump into actually drawing trend lines and channels so we can help identify these trends. So now how do we go forwards and turn this into a profitable strategy and actually make this work? And so first off, I want to set your expectations right. Start out paper trading and understand that it could take you a year or more of paper trading to become consistently profitable. When I first started out, I was losing way more than I was winning, about 50% win rate. And with the strategy, that you're losing money. And that is okay. It takes a long time to get something like this down, especially if you're new to trading. There is going to be a lot of hurdles and a lot of plateaus that you're going to hit. And then out of nowhere, you're going to break through that plateau and you're going to say, oh, wow, I just got a lot better. And that's going to happen a lot of times. Your learning is going to have kind of a stair-step pattern. And at some point is going to be where you're actually profitable. And so you have to get up to that level first before you can even think about live trading. And so once you start to hit that profitable level, you want to see consistent profits over at least 1 to 2 months, because sometimes you could get lucky. You could be consistently profitable for a week. That's not enough time to say, okay, you are good at this and you can actually risk real money and start making an income from this. Sometimes maybe a week works really well. And then the next week you just have a day where you just blow up your account, right? Because the market does have different conditions. And so sometimes the conditions will be really good and then they'll switch up and you won't be used to that market condition and trading in that market condition. And so you'll start losing money because you haven't learned how to trade in that market condition. And that kind of goes back to our trading in a choppy trend. Maybe you're used to trading in when it's very directional, but as soon as it starts to chop, you just start losing a ton of money. So you need to learn how to trade in that sideways trend. And that, I would say, is definitely the harder version of trading compared to trading in a directional market. And also in terms of conditions, if you're tired or emotionally stressed out, don't trade. There's sometimes days where I skip trading because I didn't sleep well, I have something on my mind, or I'm just not feeling good about it. It is okay to skip days. The biggest thing is, again, to make money consistently. And if there's something that is losing you money or potentially going to lose you money, maybe you shouldn't trade that day. Now, in terms of scaling our account, don't just scale up as your account goes up in money. So with NinjaTrader, we can trade 1 ES contract for every $500 of margin. Now, it will not take very long if you're consistently profitable to get $500 in your account to make another contract. And so that is really exciting. You could scale up insanely quick. But the thing is, the amount of money that is on the line as soon as you move up a contract, like let's say if you're trading 1 contract and you want to move to 2, you are doubling your max loss and you're doubling also your max profit. And so that can mess with you emotionally. There are so many emotions that go into trading, and doubling your contracts like that or increasing your contracts will cause a ripple effect in your emotions to amplify every emotion you have, because you're now trading more than you're used to. And so you only need to do that when you're actually ready. So let's say if you're starting off with a $1,500 account and you're trading 1 contract, maybe only trade when you get up to $5,000 or something. Maybe that's the only time when you want to switch to 2 contracts. You don't need to be scaling up very quickly. If you're making good money with 1 contract or 2 contracts, there's no reason to scale up until you are really, really ready. If you're still learning and making mistakes, it is okay to stay where you are at. And so the biggest thing I just want to reiterate again is start out paper trading. And don't expect to have this be a winning strategy in a week or 2. It takes a lot of time to master something. There will be times where you'll have a week or 2 where it'll go really well. And then all of a sudden you'll have a week where you blow up your account because you accidentally took too many trades or something happened. You have to be able to control all those swings so that over time, you can be profitable. So let's look at candlesticks now. It's super basic. What candlesticks are is they represent what the price does over a certain time or a certain whatever that candlestick chart tells us. Now we look at a tick chart, so our candles tell us what happened over the last 2,000 trades. For this candle right here, the market opened up here at whatever this price would be, and then closed at this price. And so that's what the body of the candle tells you. And the green part tells you that it opened down here and closed up here. And then we have the high and the low. That tells us where the high and the low was of that trading range in that certain candle. And the same goes for the other side, or a red candle, except the open is up here and the close is down here. And the wicks tell us where the highs and lows are. Now, this is a super basic concept that most people already know, but one thing that people don't really think about is each of these candles have their own trend in them. So if we think about it, this candle here represents what happened over 2,000 trades. And so what does that mean? That means that if you broke down and if you printed each of those trades, it would show you a trend or almost a chart. And so what we can gather from these candlesticks is a mini trend. Each of these candles represents a trend on a mini time frame, right? And so think about if you blew up to a larger time frame, the candles we look at, they represent the trend on that time frame. And so if we look at this candle right here, right? What does this tell us? This tells us that the candle opened here. The price might have sold off all the way to the low here that we can see. And then it went up to the highs, topped out, and then closed here. And so that is a trend in its own. And so this is what we want to be aware of when we are looking at each candlestick, right? And so if we go onto this one right here, this candle in here, this is called a doji. And so this is just a really neutral candle, and the price hasn't really gone anywhere over the time frame, right? It opened here, maybe it traded up, maybe it traded down first, it made some kind of high, traded all the way down, and then ended up closing at the same price that it opened. And so for our purposes, that kind of shows a sideways trend. And we don't like trading in a sideways trend. We want to know where the trend is. And so this next candle over here, this is a really clear-cut example of this candle just opened here, and during that, the price pretty much sold off. The price could have been in a more movement like this, but it opened at the highs and closed at the lows. And so that represents a really strong downtrend. And so going forwards, these are things we want to be thinking about when we are looking at candles. And so as we've started to narrow down on how we enter in trades, right? Think about our first thing we looked at was, where is the overall trend of the market, right? We want to know if the overall trend is up. And so now when we enter a trade, we want to know that we have that overall upwards trend, but we also want to have a candlestick that is telling us that same story. And so we want everything to be in alignment. And so that's what we are looking at here. And so if we go on to this next slide, this is what we call the signal bar. And so this is the bar that we enter off of, or that signals our trade for us to get in. And so if we just take a quick look at this chart, right? Here's a high. We move down, right? Here, make one leg up and then make another leg down. So right here we have a two-legged pullback from a move up. And we're just gonna, for the sake of this trade, we're gonna assume that we are in an overall uptrend. And so now that we have our two-legged pullback, this is where we wanna buy in. We wanna buy in before we make that next move higher. And so that's what this bar right here is telling us. Because if we go back to how we count legs, a new leg higher is when it breaks above the high of our leg down. And so this bar right here, when it broke above here, that's a new leg. And so we want to be in the market when it does that. And so that is how we enter a trade. And so that's why this is called the signal bar. And this is the bar that puts us in the market. And so here for this two-legged pullback we have right here, right? This is the signal bar, and this is what tells us to get in. This is the final confirmation. We want this bar here to be a bullish bar if we are looking for a long trade. We want the trend of this signal bar here to be in alignment with the overall trend. Now with these signal bars, we want them to be in alignment with the direction of our trade, right? So if we have a new high here, here's one leg down, a pullback, and then a second leg down. So this is a two-legged pullback. And so what we want is we want our signal bar to be bullish because this is a long trade. We're looking for it to go to the long side. And so we want to make sure that this signal bar that we have is green and a bullish signal bar. So here we have that leg down, right? And so the moment it breaks above the bar, that's when we want to be in the trade, or that's when it signals the finish of that second leg pullback, and it's going to start continuing up. And so here you can see it breaks above here. And so this, because it breaks above here and this is the finish of that leg, that means this candlestick right here is our signal bar. And you can see that if we're looking for a long trade here, this signal bar is really bearish and it's not a bullish signal bar. And so this is not a trade that we would take because this signal bar is red. And even though this bar right next to it was green, this is not a trade we would take because the trade would have been right when it broke above this. It wasn't when we wanted to get in. Now, even though this bar here next to it was really green, because it had already broken above this bar here, this was designated the signal bar because it broke above that. And so we can't change that. And so we have to skip this trade. And we will definitely get into this more as we get into actually executing trades and how we execute in those. Now, if we look at, here is a really strong list of what bullish candles look like. And so kind of from the left side to the right side at this top area, this is basically the strongest bull candle to more weaker bullish candle. But these are pretty much, this top row is all really solid signal bars. If you have any of these as your signal bars, that is a really good possible entry. And then down here at the bottom, these two right here are still really solid signal bars. But once we start to get in to where the little story of the signal bar is choppy like this, and then especially a doji here, it starts to get choppy and it doesn't align with what we're looking for. And then of course, once these signal bars start to look red, for a long trade, we would not want those. And then if we were taking a short trade, any of these green bullish bars would be a really bad signal bar because they would be against what we're looking for. And so here's two other cases here. Sometimes when you have a really small signal bar, let's say you had a really big red bearish bar right here, the market just sold off really hard. If you have a little green bar here that technically signaled you into a long, sometimes it's actually not good to take that trade because this will just be a little bit of a pullback before a big sell-off. So that's definitely something to keep in mind. If you have a tiny signal bar next to a huge red bar, sometimes it's worth skipping on that trade. And then as well, this bar right here, this is still a bullish bar. Even though the candlestick is actually red, think of the story that this tells, right? The candle opened here, it sold off, and then it recovered here and closed. And that is still showing us a bottoming pattern. If we're looking for, the overall market to do this and then go like this is still a good bottoming pattern. And so this is still a bullish signal bar that we are okay using for a long trade. Now, if we move over to bearish candles, it's pretty much the same thing, just flipped. And so all these are really strong signal bars for a short trade. They're really bad signal bars for a long trade. And the same with these two right here. And then once you kind of get into these, things are a little iffy. You really don't want to be taking these as a signal bar because they are just choppy and, again, they're against the trend. The same thing with a bullish candle, right, is this is against if we're looking for a short trade, any type of these candles are against the trend we're looking for. And then of course, here's that example of that really small bar. If there was a really big run up and then you had a tiny little move here, if you tried to take a short on that, sometimes that's not a good signal bar because the market might just be pulling back a tiny bit because it just had a very large move up. Now, that's kind of an advanced concept, but I did want to just slip that in there. Now, and then of course we have this. This is a good bearish bar because again, it's showing you that the stock opened here, tried to move higher, and then sold off. And so that is still a good reversal candle. And so this is good to think about for every candle you think about, but the majority of this is for thinking about when we're looking at the signal bar. And we will definitely get into that a lot more when we actually look at entering trades and executing trades. So now let's look at some basic strategy concepts. What this strategy is mainly based off of is the idea of the market rule of two. And now what this is it just means that the market likes to do things in twos. And so a really simple example of that is the market here makes an extreme. It attempts to break through that resistance line once, and it breaks through that resistance line on the second attempt. And so that's kind of the idea of the market rule of two. Of course, this doesn't happen all the time, but the idea is that the market likes to do things in twos. And so that is what a lot of these strategies are based off of, is the market rule of two and the market moving in pairs like this. And the second attempt to do something is usually where we are getting into a trade. So we have three basic strategies we look at. These are a two-legged pullback, a higher low, and a failed two-legged pullback. Now we're going to dive into each of these, but essentially, if we don't see these, we don't take a trade. Now there are a ton of things on our checklist that we're looking for, but these are kind of a really big part of our strategy. And so what you can do here is what is great about this strategy is these can work either to the long side or the short side. So we don't care which direction the market goes. We can trade the market in an upwards trend or a downwards trend, or even in a sideways trend. These are just those trades on the flip side. You have our two-legged pullback that goes down in a downwards trend, a lower high, which is the opposite of a higher low in an uptrend, and then a failed two-legged pullback. And a failed two-legged pullback is essentially a two-legged pullback, but it's essentially a trap. And we'll definitely dive more into that and what that means. But the biggest thing is if we don't see these setups, we do not take a trade. Now, if we look at our first example, a two-legged pullback, this is kind of, I'm sure if you've been in the Facebook group or watched any of our videos, we mention the two-legged pullback all the time. This is a trade that is super consistent and it follows that market rule of two. And so this is what we're just looking at here. This is just saying we're in an uptrend. And then what happens for this two-legged pullback is here is one pullback, and then here is the second pullback. And so the idea of this trade is that the market moves up, has a pullback, it makes one attempt higher, has a second pullback, and then when the idea is that if it makes a second attempt higher here, it's going to resume the trend, or at least go in the direction of the overall trend long enough for us to make our scalp that we're looking for. When we see a pattern like this, we are looking to enter essentially right here when it switches back into that uptrend. And so again, we have that move up, that with the trend. Here we have a long trade. This is an upwards trend. We have that first pullback, and then we have a move with the trend, and then a second pullback. So here is that. And so this high right here does not break this high. Essentially, the market makes a high and makes 2 legs lower and then continues and possibly breaks that previous high. So if we flip to a couple more examples here, this low right here, this can change. The low that we enter on can either be, it can be a double bottom like this, it can be lower, and it can be higher up here. That still is a 2-legged pullback. We still will have that high, that first leg down, and then that second leg down. And then this is where we are looking to enter the trade, and then it continues with the direction of the overall trend. And so this is, again, why we want to know where the overall trend is, because we want to be taking these trades with the overall trend. Now let's look at this to the short side. A 2-legged pullback works to the long side, but here is also a short side example. Or what I mean by short is a bearish example. We're looking to bet that the market is going down. This is a downwards trend. So here we have the overall trend is down. The market moves down. It makes a new low. We have one pullback here and then a second pullback here. And then again, this is where we look to enter. We look to, going back to that market rule of 2, that second attempt to continue with the trend. That is when we look to get into a trade, because we are betting that is with the trend, it is going to create movement in that direction enough for us to get our 1-point scalp, right? We're not looking to predict that it's going to make a massive move to the downside. We just need a little move here to get our 1-point scalp, and that's all this setup is for. That's all we're trying to do with this strategy. And so just like the last example, this 2-legged pullback can look a lot of different ways. And so once we look at more live examples, you will start to see that it's not always going to be super clear like this, but the concept and strategy still works the same. Now let's look at a bullish trade to the long side, trade to the upside, a higher low. And so this looks like a lot like a 2-legged pullback. A higher low works really well after a 2-legged pullback trade has already worked. So here's our up move, here's our new extreme or a new high, here's that first pullback, here's that second pullback, and then if we were trading, here's that trade we would have taken. We would have taken a 2-legged pullback to the long side and hopefully gotten a scalp out right here. So the market then decides to make another move down here. And then the idea here is if the market moves up and looks like this is going to be a higher low than this one. And so what that shows us, it confirms the overall trend again, because this essentially, you can start to draw a trend channel off of this. And so that's what we're looking for, is this is a confirmation that is continuing with the previous trend. And so this is an area where we look to take a trade. We are assuming that it is going to go with the trend and it's going to make a move higher like this, enough for us to get that scalp out. And so again, just to show you what that looks like without any drawing on it, this is that higher low we are looking for. Now, let's flip this to the other side, to the downtrend side. Here is the same thing, just in a downtrend. We have that new low, that first pullback, that second pullback. Here's that area where we would have taken that trade to the short side. We would have got our little scalp out here. And then the market decides to have a little bit of a pullback here. And this is again where we look to have a lower high right here, because this right here, if it decides to turn down, is a lower high. Now, we don't know that this is going to turn down. This could decide to just go up, right? But what we're assuming here is if the market decides to start pushing down this way, then we jump in a trade right here because it is starting to confirm that lower high. And then when we jump in our trade and the market continues to go down, we then get our scalp out. And that's how this trade works. We don't know that the market is going to, make this move down after this two-legged pullback. We don't know it's going to make this move down after this lower high. We can only guess. We don't know that that's going to happen. And so what we do, and a lot of what trading is when you're actually live trading, is having a visual of what the market is going to do or what the market would look like to have a trade you wanted. So an example like that is if we just looked at this two-legged pullback here, right? And we don't see any of this. And we're looking to take a trade here. We don't know that the market is going to go down, but with the assumption that the market's going to go down, this is an area that we want to get into the trade. And so it's kind of like looking into the future without knowing the future. We just want to be like, okay, we see this setup here. We want to take this trade to the short side, and we're just going to assume that this is going to happen. And so that's the same with something like a lower high here. We see this happening, and so we're going to assume that if it does make a lower high here, that this is going to happen. And so we want to trade that. And so I'm sure a lot of this is kind of an overload, but it will start to make sense with either rewatching these videos or just as we go along with the course. Now, let's look at a failed two-legged pullback to the short side. So this is a trade setup that is definitely a little more complicated and advanced. It is technically a trap, and don't worry if this is just over your head right away. The main thing is that this is here, and you can always come back to this when you want to learn this. So the idea of the failed two-legged pullback is it always goes with the overall trend. So what we have here, right, is an overall trend of the downside. We have a new low, and the market decides to start pulling back to the upside, right? And so what this is this is still a little mini trend to the upside. And so we have a new high here. And what we have after that high is a two-legged pullback. Here's one leg down from that high, and then here is a second leg down from that high. Just like that first example we were looking at, this is just a smaller version of that. We still have that uptrend, and then a first pullback, a second pullback, and then here is where you would enter that if it was in an overall uptrend. But the idea here is that our overall trend is to the downside. We don't want to take a trade to the upside because that's counter trend. But some people are not going to do that. Some people are going to say, I have an uptrend here. I have a two-legged pullback. I'm going to take this trade to the long side because maybe the overall trend is bottoming, and I'm going to buy the bottom and the market's going to shoot up and I'm going to make a great trade. And so that can happen. That is totally possible, right? But the idea is that is unlikely, and we want to be taking trades with the trend. And so the whole idea here is the market does make a tiny attempt higher, and those people will start buying, and then the market will start to fail. And that two-legged pullback will not make that scalp, and it will start to reverse on those people, and it will start to look bearish here. And so this is where we want to be entering a trade to the short side because it'll start to sell off here and continue with the overall trend. And so that is the basic idea of how a two-legged pullback works. Is again, you always want to be trading with the trend. So even if you see something like this two-legged pullback right here, because the overall trend is down, you do not want to take this to the long side. Some people will do that and trade counter trend, and the market will then reverse on them. And though this is where we want to enter because that is the smarter trade setup and that is the higher probability setup. Now, let's look at this on the flip side to the upwards side of the trend, right? And so here, just the exact same thing. And so here, this is pretty much the exact same thing. It'll look a little different, but essentially this is how it works, right? Is we have a uptrend, we have a new extreme, that is okay. The market decides to start pulling back. We have essentially a little mini downtrend, right? And then so if we're thinking about a two-legged pullback to the short side, we have a new low, we have a first leg pullback, and then a second leg in that pullback. And so in terms of a two-legged pullback to the short side, this would be a great spot to short. And so some people will do that again. But because our overall trend is to the upside, that's a counter trend trade, and we don't want to do that. And so this will start to potentially reverse. And so if we see this reversing and continuing with the overall trend, we look to take a trade to the long side, and that is where we can get a scalp out of the market and complete one of our trades. And so this is essentially the overview of what these setups are. Now, we are going to actually get into how to count a leg on an actual chart, because I know there's a lot of confusion on that. And so we're going to actually take a quick shift and talk about that first, and then we will start piecing together this strategy. So being able to identify the overall trend is going to be the bedrock of our trading strategy. We always want to be trading with the trend. And that is because trading with the trend is going to increase our overall win rate. And that is a huge part of our scalping strategy. We want to have a very high win ratio. Counter trend trading is very ill-advised. There are trades that are possible, but whenever you're counter trend trading, you are going to be losing that little edge that the trend gives you. And so always trade with the trend. Now, there are three major types of trends. We're going to have an upwards trend, a sideways trend, and a downwards trend. Now, the way we identify these is looking at the highs and lows that are made in the trend, right? And so an upwards trend is going to be making higher highs and higher lows. Every time it reverses in either direction, the high is going to be higher than a previous high, and the low is going to be higher than a previous low. And so it's making a stair-step pattern upwards. On the flip side, that is a downwards trend is going to be making lower highs and lower lows in a stair-step downwards pattern. And so these are the two directional trends. And then a sideways trend, the highs are going to be relatively similar, and the lows are going to be relatively similar as well, kind of being in that choppy pattern. Now, a sideways trend is a lot harder to trade than a directional trend. And so whenever you're in a sideways trend, be aware of that and be extra cautious. Generally, the better trades will be in an upwards trend or a downwards trend. Now, when we're actually identifying trends, they're not always going to be as easy as one of these drawings, right? They're going to be on candlesticks. And so what we want to be watching is for those highs and lows. And so even if a low is slightly bit lower or a high is a slightly bit lower, generally if you see that lower low and lower high, it still is going to mean that it is in a downtrend, even if it's not as clear all the time. But whenever you are not clear about a trend, that is okay. And that just means that maybe you want to take a step back and get a better picture of things. So let's actually look at a chart here and look at some real examples of these trends. So here on the left side, you can see we have an upwards trend. And so this is pretty prominent by the fact that it's making higher highs and higher lows, right? Overall, the trend is up until we get about here when it starts to essentially become choppy, right? The highs and lows are all over the place. You can't really see if it has a direction. Now, one key note here too is look at the EMA here. We're going to talk more about the EMA later, but the EMA is still generally a pretty good way to see the trend. And now, of course, on this side, we have a downwards trend, and that's just denoted by looking at how the highs and the lows are changing as well, right? And so with this strategy, we don't have to predict when it's going to make these shifts right here, right? When it makes a shift from an upwards trend to a sideways trend to a downwards trend. We don't have to do that. When we are unsure of the trend or when it's making a shift like this, we can wait for the price action or the market to show us what is going on. So when the market shifts like this, we can wait until about here to really say, okay, we're in a downtrend now. And you can start being like, okay, now I can take trades to the short side because we're in a downtrend. And so don't feel pressured to trying to be predicting the trend a bunch and having to know exactly when it's shifting or where it's going. That it is okay to be patient and let the market show you what is going on. Now, this is generally the size of trend we're going to be looking at, but there are always trends on lower time frames and higher time frames. And so what I mean by that is if we actually just zoom out on this chart, you can see that there are broader trends as well going on, right? And so if I zoom out to this is a couple days, you can see we are in kind of an overall downtrend. And so that is something to be aware of, but that doesn't really affect our trading because we're trading on such a small scale and such a short time frame. We don't have to worry about that overall trend as much. Generally, what we only care about is the trend during the current day and over the last couple hours or maybe even half an hour, depending on how quickly the market is moving. And so here, this is essentially the current day so far, right? Here is about midnight, and then here's about the market open. And so this is the current trading session all through here, right? And so here you can see that overall, the market so far is in a pretty big, it's in an uptrend, right? But during these smaller trends here, here's an uptrend, here's a little downtrend, here's an uptrend, right? And then here's that downtrend. You can trade all those directions. You don't have to stick only to the one direction over the day, as long as there is a good enough trend established in that direction for you to make a trade. Generally, the idea is we want to be identifying the underlying trend that is happening, and we want to be trading in that direction. Now, let's jump into actually drawing trend lines and channels so we can help identify these trends. Okay, so now let's actually talk about how we enter our trades and how we go for our 1-point scalp. So what we're looking at here is a two-legged pullback. We have an uptrend, right? A high, here's one leg down, and then another leg down. So here's our second leg, here's our first leg, here's our signal bar that we're gonna be looking at. And so this is a trade. We have a matching here, it breaks lower, it doesn't break higher, but this is a really good bullish bar right here. So we're gonna wanna go long off of this, anticipating that it's gonna move higher from here, and then we can get a 1-point scalp. And so how do we do this? And so what we do, because we want to buy when that second leg down starts the leg up, we place our order one tick above the high of our signal bar. And so what that looks like is we'll have an order essentially sitting there waiting for the market to break above that price. And so what we do is we always use stop orders, because right here in this example, the market just rocketed through there. And if you have a limit order, you sometimes won't get filled and the market will just go on without you. And because we use a stop order, we are assuming that the market is going to have momentum in our direction. And so that's why we use a stop order with a break above this. There's always going to be that momentum in our direction because we're buying above the current value of the market here. We have momentum in our direction already, which can help us get that trade profitable very quickly. And so we never put in a stop order, or we never put in an order until this bar is filled. Even if the signal bar bounces here, is going up, and it's kind of trading here and it looks really strong, we don't put an entry until we actually see how this bar forms. Because sometimes you could put in an order here, you could get excited, be like, oh, if it breaks up, it's gonna go rocket up here. You don't know that. The market could just decide to go like this, and then the bar could close down at the lows. And so you always wanna be waiting for the bar to fill. And I say this because when I first started trading this, I would sometimes jump in early because sometimes you will see a two-legged pullback and it will look really good. And you have been sitting there for like an hour waiting for this to happen, and you don't want to miss out on it. And that is FOMO hitting you. And if you do that and jump in before you see the signal bar form and before it really hits all those entry checklist items, you could still end up with a losing trade. And of course, we do not want to be causing losing trades. And so that's just a little tangent, but definitely try and be as patient as possible and always wait for this to get filled. Make sure you have the tick counter in the bottom right of your chart so you can watch and be ready for it to count down the amount of trades, and so you know pretty much when the bar is about to form, and you can have that order entry ready right when it forms, because sometimes with this bar right here, it rocketed up very quickly. And so once you have that order in and it hits your order, you'll get filled. And because how we try and have our trade set up, it'll automatically put our profit order or our profit target at 1 point, and we never move this. Never ever move this. This is what we always go for. Never try and go for a tiny bit more because you think you can. Always go for that 1 point profit, because if you go for more, it's going to decrease your win rate, and we do not want that. Now with our stop loss, we try and have it be 2 points from our entry, but sometimes the candle can be kind of big and you will need to increase your stop loss a little bit more than that. I wouldn't suggest going much over 3 points. And if the signal bar is bigger than that, like something like this or something like this, it's probably not worth the trade, because you are going to be risking a lot to make a little. And you want to keep your profit loss ratio in a good area to where your win-loss ratio still makes it so you're making money. That's why you're not going to want to risk a huge amount on one trade. Sometimes because the signal bar is so big, you're going to have to skip on the trade. And so that is something to be aware of. Now let's look at a trade on the flip side. This is a trade to the short side. Again, this is the exact same thing. We are looking for, here's a two-legged pullback, one leg up, down, another leg up. So here's our second leg. We're going to want to short as soon as we see a good signal bar, and we want to have our stop loss below that signal bar in anticipation that it's going to start that leg down and continue with the trend, right? And so here we can see that the EMA is down, so we have an overall downtrend. And then we have a signal bar here, right? And so this is a really nice bearish signal bar. So we're going to want to put our stop below that signal bar in anticipation that it's going to break lower. Now, we don't know that it's going to break lower. The market could keep going up here. This next bar could actually be a bullish bar all the way up here. And then we could have a bearish bar up here. And then maybe this is the bar we enter on, and it goes short from there. You will see Michael and I sometimes put in orders and then cancel them because we don't know when it's going to break lower. We are just ready and waiting for it to break lower at a good point that we want to be in the market. And so that's when you just have to anticipate. And so you put that order anticipating that the market is going to break through your order and fill it, and then you have your profit target already there and your stop loss already there. And again, you never want to move these. Always have your profit target here at 1 point, and then put your stop loss above the high of your entry bar for your bearish trades. So hopefully this makes a lot of sense with entering. We will get into more examples and it'll start to make more and more sense as we go on. Now, let's actually look at our trading entry checklist. This is essentially what we have been building to over this whole course. And so this is what you want to be thinking about every time you are trading. And you want to think about it in this order. And so what I have is I have a sticky note essentially on one of my monitors that has this list. And I definitely suggest doing something similar. And so it's something there that is just you always look at right before you're about to enter a trade. Just something to remind you, because there's a lot to remember and you want to be making sure you check all the boxes, because what if you forget your, item number one, the most important, you go against the trend? That is going to cause you to have a losing trade. And so what we want to do is we want to go every time we are evaluating a trade, we want to first be looking at what is the overall trend. Is it up? Is it down, right? Where is the EMA? Are we below the EMA? Are we too far away from the EMA to trade? Is it not even worth looking at a trade here because we're just so far extended away from the EMA that it's just going to move away, that it's just going to go back towards the EMA and not the direction we want? And then, of course, we need a two-legged pullback. We need a setup to actually look to get in a trade and to start stocking a setup for our entry. And then once we have that two-legged pullback, that higher low, that failed two-legged pullback, right? We actually have to have a good signal bar. And if we don't have a good signal bar, then we can't take the trade. If any of these are a no, or it doesn't work for the trade we're looking for, we have to essentially cancel the trade. We want to have all of these need to be in a line. And then the last thing as well that we have to have checked off is where is the support and resistance. So if we're looking to take a trade long and the market has made, let's say, a double top here, and you're looking to enter long right here, if our 1 point scalp would make the market have to push through that resistance level, we can't take it because we're not going to bet on the price moving through a resistance or support level, right? And so that right there, that can cause you to just have to skip on a trade. And so be aware of each of these items, because if one of them isn't in line with the trade, it'll cause you to have a potential losing trade. Now, of course, the trade still could work out if one of these doesn't align. But again, the idea here is to increase our win likely percentage and optimize it as much as possible. And that's what this does. So let's go in here and look at a trade. So here is a trade we're looking at, and let's do that checklist. So what do we have here? This is going to be the area we're looking at here. I've marked the signal bar. And so first off, where's the overall trend? The overall trend, it looks like we're in a pretty solid uptrend. And so that is a really good indicator for us. And so that's what we're going to look for. Number one thing, where is the trend? We have the trend up, so we can kind of check mark that. And so zooming in on that, so we have the trend is good. And then where is the EMA? The EMA, we're above the EMA. That is really solid in terms of going to the long side. And then also you can see we just bounced off of the EMA. So we'll definitely look into that a little more with the signal bar. But that is a good thing too. We're a little far from the EMA here, but because the market just came and bounced off the EMA, that is a really good sign. And then what is our setup? We have a high here and it trends down, right? Looks like we have a one leg down and then up, and then we have a second leg down. So this is a two-legged pullback. We have a setup, so we're good there. And then what is our signal bar like? Because we're looking for a long trade, we're going to need a bullish signal bar. And so this signal bar right here that we're looking at, it opens here, trends down, reverses off of that EMA, which is really strong, and then closes. And so that's essentially a reversal bar to the long side. So a bunch of people maybe tried to short here and it rejected that. And so that is really good in terms of pushing this chart to the long side. And then where is resistance or support? So each one of these horizontal lines right now on this chart is 1 point. If we look at where 1 point would be, if we entered our stop here, we'd be looking for the market to break here to get our 1 point. And so that is barely below the high here. And so we want to be careful of that if it was all the way up here that we had to scalp. And so that is what we want to be thinking about when we're looking at support or resistance. Where does the market have to go for me to make my 1 point scalp? And if where it has to go is unlikely, or there's something in the way, we want to be reevaluating and potentially skip out on that trade. And so what we do is we put our entry here right as that signal bar filled. And then once it broke through, we would have our order automatically go to that 1 point scalp. And then if we had our 2 point stop, it would move here. And so once it fills that, we're going to have to manually move the stop below the signal bar because we always want it below the signal bar. And so we don't, even though it's farther than that 2 points, we need to be having it below here. And so this is definitely kind of a larger signal bar, but it is small enough that we can still take the trade. And so with this checklist, always be thinking about this checklist when you're going to be entering a trade. Every trade, you should be thinking about these 5 things. And I suggest doing them in this order because it'll make it a lot more streamlined for you and it'll make sure you don't miss one. So now let's go look at a ton of examples so you can start getting a really good idea of how this whole setup works together. So now that we've talked about individual candles, let's talk about a few different pairs of candles that are troublesome and that we want to be aware of and be on a lookout for. And so our first one is when adjacent candles have matching lows or matching highs. And so what we have right here is an example of when there's 2 candles with a matching low. And so what this does is it creates support. And so if we go back into looking at that hidden story or what these candles mean on a smaller time frame, the left candle would have opened up somewhere here, sold off to here, and then went up and closed. And then the next candle opened here, sold off, bottomed, and then went up and closed at the highs. And so you can see on a smaller time frame, that is a double bottom. And so that creates an area of support. Now, it's not going to be as big as an area of support where the chart has sold off and hit it multiple times, right? But this is still an area where we want to be aware of because this can stop us from getting our 1-point scalp. So if you see matching lows like this, you don't want to be trading and betting that the price is going to break through that level. Now, the same thing goes for the flip side. Like right over here on the chart, you can see these 3 candles have matching highs. Every time the price tried to hit the high here and it wasn't able to break through. And so that's a mini resistance level. And so you don't want to bet on the price breaking through that level because that is going to decrease your win rate. And so here, this other example over here on the chart, you can see we sold off. This candle bottomed here, closed, and then it opened here, the next one, and bottomed, and then rocketed off. So this is still essentially a little double bottom right here. And we can see if we draw to a support level, the market then bounced off that level, came over, and then bounced off of it again. And so that can create an area of support that we want to be paying attention to because it can be good for our trades, but also bad for our trades. So our next example is an inside bar. And so what this is more pertaining to our signal bar. We don't want to have the signal bar as an inside bar. And so an inside bar is just, let's say we have a downtrend right here, and this is our 2-legged pullback that we're looking to buy into, and this is our signal bar. We don't want to be buying above this bar because what this arrangement, it shows a lack of strength because the price didn't break below and then turn up, and it's also not breaking above the previous high. And so we just want to avoid bars that look like this because it is a lack of strength. And so sometimes this can cause you to miss a 2-legged pullback trade. An example right here is if we assume that this is the extreme, we have 1 leg down, 1 leg pullback, a new high, and then a pullback down right here. So here's your first leg, here's your second leg. And so this is right where the price turned up. So this is where it would have made that entry or that trade possibility. But because this bar right here is smaller than this one, because the low is higher and the high is lower, that's mainly what we're looking at. We're looking at the high and the low in relation to the bar before it. And because it's essentially just smaller in every aspect, no matter the color of the bar, this bar could be totally green and this bar could be totally green as well, and it would still count as an inside bar and one that we just don't want to take and one that we want to avoid. It can be frustrating because you can have a perfect setup. The EMA could be right here. That could be a great channel line. And if you have an inside bar like this, that is something in our checklist that is not checked off because that inside bar is not a good signal bar. And so that is one that we have to avoid and can cause you to skip on trades. And so the next one is also a signal bar that we want to avoid. And we're forced to avoid it. So what this is an outside bar. It's just the opposite of an inside bar, right? And so this one is it's just bigger than the bar it's adjacent to in every way. Just the highs and the lows are higher and lower than the bar next to it. And so what this does is just crazy movement in both directions that essentially forces us to miss out on a trade. Because if we were looking to buy the next break higher here, and if we're looking for a good bar, this bar right here wouldn't have been a good bar. This is a bearish bar if we were looking to go long. And so you can see here it breaks lower and immediately breaks higher, and that gives us no chance to get in. And so what this bar does is a lot of time it'll cause you to miss a trade because we have to wait for a bar to finish, and a bar like this doesn't allow that, and it just causes a lot of crazy movement that we can't deal with. Now, one thing though is this outside bar is actually good for traps. So if we look at an example of this, so here we have an outside bar, we have a new high here. We're just going to assume this is essentially a two-legged pullback. So we have one leg down and then two legs down to here, and then it starts to break higher. And so this is a bad entry for a two-legged pullback, and we're going to assume the trend is down. You can kind of see we're below the EMA, right? So we're not going to want to take this two-legged pullback to the long side. We're going to want to hope it traps people and then we sell off. And so we're going to actually want to enter here and short it. And so how this works in actually real time is you start to see it break higher. And so when it's trading up here, we want to anticipate what is going to happen. So a lot of it in the market when you're trading, you have to visualize kind of the future of what could happen. And if that's going to happen, where do you want your entry to be for the trade? So if you're going to assume that this two-legged pullback here is going to fail, you're going to want to short below here, assuming that it's going to drop out. And so that is what you want to do here. As soon as you see this start to break higher, you want to put a sell stop down here, anticipating that it breaks lower. And so that's why an outside bar is okay for traps, because the market can and will make that break higher, trap people, and then flush down lower really quickly. And so that's why we don't always want to wait for a trap signal bar to form. We want to just have our order ready in anticipation that it's going to happen. And then the market can quickly flush down from there. And so you won't even have time sometimes if you don't have your order already in the market. So this is pretty much everything we need to know about candles. Now let's actually look at how to enter trades and really start to put all of this together. So channels and trend lines, these are what we use to visualize and confirm what the overall trend is. And so these are really useful tools for helping us make that decision of what the trend is, and then therefore which direction we need to be trading. And so generally trend lines are used for shorter term moves, and then channels are used for broader overall trends and seeing what the larger trend is doing. Now, trend lines also essentially are just half of a trend channel. Channels are just made up of a trend line and then it duplicated on the other side of the market. If it was drawn off the lows, you just drag it up and put it on the highs. We'll definitely get into examples of that. And then a trend channel usually has a midline, and we'll talk about that too. And then how do we confirm these? And so usually what we want to confirm a line is 3 touches, because if we only have 2 touches, that really doesn't confirm that we have a trend line. We want to be seeing multiple times the market has touched this level and pretty much shown us that yes, this is a support level that the market is respecting. And so then that shows us that, oh, this is a level that the market's respecting. And so we can bet on that holding or taking a trade off of that level. So here we're looking at our chart again. Let's draw a trend line for this upwards trend right here, right? So get my drawing tool line. And so how we want to draw these is we always want to start from the most prominent recent low, or if in a downtrend, the most prominent recent high, right? And so down here, this is for the uptrend, this is the most prominent recent low. And so we're gonna go all the way to the bottom of that candle. So we're at the actual low. And then we're just gonna drag our line and see where it fits best. So this might be an area where it fits pretty good, but we want to try and touch the lows that it's making as it makes its uptrend. So if I just quickly get my drawing tool out here, as we kind of make this stair step pattern up, we want to touch those areas with our drawing tool, because that's going to show us kind of where the actual trend is. And so not everything's going to fit perfectly. You just want to see kind of what fits best. So some quick rules here is when you're starting, you always want to start from the actual low. And then as you draw the trend line or trend channel, you can see here, I've actually touched it to kind of just where it fits on the candles. Kind of touching either the closes or the opens of the candles can work. And then also up here, this is just the kind of the low of the candle. And so a big thing is trend lines and trend channels they're just visuals for us. We want to make sure they fit the current trend as best as possible, because in the end, they're just for us and the market doesn't respect them at all, right? It's just a good visual way for us to understand what is going on. And so it's okay if your trend channel is touching a few different places in the market or on the candlesticks as it goes up. And so as you start to see more and more examples, that'll start to make sense. It's always best to try and have your channel fit as best as possible. But once you have this drawn here, you're not going to want to move it as you see the market. You don't want to move it to here once you see the market move. When you see these touches here, and that kind of confirms this trend. And we'll get into later what that means once it starts to break those trend lines and what that tells us for the current trend. For a trend channel here, they're pretty much the same thing, except you just match it to the other side. And so here's a trend channel. Again, we're just going to draw it off the lows and then match it. And then it'll just match to the other side. And so what we want to do is just match it to the best looking highs here. And so this is the most recent high here. And so I'm just going to put it there. And then you can see it kind of respects it up here. So once it gets to the upwards part of the channel, it's going to start seeing that as resistance. And so that is one key thing when you're trading is if you have a channel, don't take a trade at the top of the channel, because that is a resistance area. You want to be taking trades at the bottom areas of the channel if you're in an upwards trend, because that is, again, we're looking for the highest probability areas to trade. And so in an upwards trend, the bottom part of the channel is going to be the best part to be taking trades in. Even if you have a good setup at the upwards area of the channel, that is still going to be a trade you're going to want to skip on, because there is that resistance area of the overall trend. And again, the overall trend is the most important thing and the most foundational concept with our trading. Another example here, let's actually just zoom out on the day. And so as the day progresses and as you're analyzing the chart, you're going to want to have trend lines and trend channels of different parts of the chart. And so what I mean by that is we want to see an overall trend channel for the day. And so this is essentially the overnight low. And then here's the open of today. And here we are currently trading at. And so when you first come in and as the day progresses, you want to be looking at the overall trend as well. And so here, this is the most prominent low from the overnight session. If we zoom out even more, this is the previous day. And so we're not really interested in that too much. We're just wanting to, again, analyze the trend over today. And so what I'm going to do here is I'm just going to get our trend channel tool. I'm going to click on the low here and just see where this fits so we can get an idea of what kind of trend we're in for the day. And so this looks like it kind of fits. It touches those two lows. And then I'm just going to snap it to the top somewhere. So this could work. And then this actually looks like this kind of fits a little better. And so one thing as well here is this doesn't have to match perfectly. Now, it fits pretty good. And another way we can actually look to confirm the trend line and also just use the trend line is this midline right here, right? And so this is a line that is exactly in the middle of the channel. and it counts as support and resistance as well. And so you can see as the chart comes and hits this midline here, the chart tends to chop around in this area of the midline, right? And so sometimes it'll come up and it'll act as resistance. And so that is another way you can start to evaluate your channel, and just another way to use your channel. Generally, in any channel, again, the better trades are going to be at the extremes of the channel, right? Always trading at either the lows of the channel or the highs of the channel are going to be your best bet. Trading somewhere in the middle of the channel can cause congestion and sideways chop, and that is not what we want when we're trading. Now, one thing that we actually use trend lines for more of, we just zoom in on the kind of the most current price action, is sometimes the market will have some pretty crazy moves where it just goes straight up and then straight down, right? And so that doesn't give us time to start to draw a trend channel. We still want to know what's going on in the chart, right? And we want to keep track of that. And so what we can do here is just draw a trend line matching these lows here, kind of where it makes a couple lows, and that'll still give us a rough idea of what's going on. You could essentially make this into a channel, but generally these are just really tiny channels. And so a trend line is good enough for that visualization, right? And so you can see here on the flip side here, it also made kind of a trend line down here. And so that is something that we can just draw to kind of get an idea of what's going on, especially if you're not sure what's happening. Always trying to just visualize and either zoom in, zoom out, and see what is going on in the chart. To see kind of where we're at right now, if we just take a trend channel here, because we've kind of, now that we have seen some price movement, we can start to look at where a channel is again, right? So if we draw off the low here, kind of match it to the lows that it's making, and then just flip it to the high here, right? And so here, this kind of looks like a channel that the market is currently in. And maybe as we start to get to the top of this channel, the market is going to sell back off and come and touch the bottom of our channel. And that is where we would potentially look for a trade again. We have identified here that we are in an upwards trend, but again, we don't want to be taking a trend at the top of the channel. We want to be taking a trade when it sells back off to the bottom of the channel. And so we're not going to watch this and look for a setup, because that's, we're not at that part of the course yet. But as you can see here, it's kind of starting to sell off towards the bottom of that channel, and that area that we would actually want to be looking for a trade. So now let's talk about actually another type of channel. So let's go back to our part of the chart that we're looking at. And so channels will generally be drawn off the most prominent low or the most prominent high, but sometimes you'll have something that's called a spike and channel. And so what I mean by that is sometimes the market will make a very quick move. It'll move down very fast or up, and then it'll go into a channel. And so that's what we have right here. We have something that the market moved very quickly, and then it goes into an actual trend. If you try to draw a trend off the high here, it doesn't really tell you much. And that is because this is actually one of those places where you have a spike and channel. And so what we want to do is draw it off the most recent high after that spike, and then you can start to match it to the highs here, and then we can put it down to the lows right here. And so here you can see this channel actually fits really well. And this would allow us to take a lot of trades off of this. Here you can kind of, after this point, you pretty much have the channel confirmed because it's made essentially 3 touches there. And then you just drag it down to the bottom. And so when you actually draw channels, you won't always know where the bottom or the top is. So if we initially drew this channel off the 3 highs right here, and we hadn't had these bottoms to draw it off of yet, you can just draw your channel and then leave the bottom and then move it as you get updated with data. Now, in a downtrend, you can move the bottom part of the channel, but never move the top part of the channel. And then with an uptrend here, you can move the top part of the channel, but never move the support side of the channel. And so that is a very key thing, because you will have channels that you don't know if it's a midline or not, right? And so what I mean by that is this channel right here could be double the size, and this resistance line here could have just been a midline, and we don't know that until we can actually have a bigger idea and more data on the channel. And so that is why we have that flexibility in drawing with the trend channels. And so in this case here though, this was just a channel here. And so going back to this channel here is very solid once you kind of have these three tops in here and then drawing it off the bottom. And then as well, looking at that midline, you can see it acts as resistance here a lot. And then also once it starts to break to the upside, it actually acts as support. And so again, be aware of that midline. It can be helpful, but it can also be detrimental. So quickly looking at this trend change here, right? How would we then draw this next channel? All we would do is just go to channels, and off this new low, we just draw and match where it fits, right? And so it's matching off those lows, and then we just match the highs, right? And then eventually it breaks. But so this is just how you draw trends and channels. And so this will be very helpful in our trading strategy. Now, what does it mean when a trend channel breaks? And so what we call these is a trend break and a trend overshoot. And so trend breaks are when price breaks counter trend. If we're in a downtrend here, a trend break is when it breaks to the upside. And so what these like to do is they like to retest the most recent extreme, either a high or low. And so what that means is in a downwards trend, when we have a trend break, the market will like to then make a retest of this low. It'll either make a new low or it'll make a move in that direction in some fashion. And then in an uptrend, a trend break will be to the downside. And when it does that, it will try and retest that high before it changes its trend. Now with trend breaks, this doesn't always happen. Sometimes you will have a trend just break and then sell off right away. But this is one thing to keep in mind as we start to look forwards. Now, an overshoot is when price breaks with the trend. And so what that means is in this downwards channel we have here, if the price broke all the way through the bottom of our channel. Now, I know we did just talk about that you can move the bottom of that channel, but once you have a confirmed bottom of that channel, you don't want to be moving that. When it does make a break to the low side, prices should attempt to retest the trend line here and then continue with the trend or decide to reverse to the upside. And so these are really key concepts with understanding trend shifts and where the trend is going to go after it breaks your channel you have spent so much time drawing, right? Because it can be really frustrating when you have a perfect setup channel and then it decides to break that, right? Just when you're about to take a trade with it. So let's look at some example of these. And so here we have that upwards channel. And so this is a trend break because we are breaking counter trend to the channel. And so what happens here is we have a trend break and then it attempts to retest that high we just had. It's not always going to retest it. Like this is a perfect example where it retests it to the exact price. Sometimes you'll have it overshoot the price and then go down, or sometimes you'll have it just retest and then go down. But the idea here is this is what's going to happen a lot of the time when a trend breaks. It's going to make this retest here. So here we have a really solid up channel here, and then we have an overshoot. And so once an overshoot happens, we're going to expect it to retest the bottom of the channel before starting to change trend. And then when we have that retest, we're generally going to expect it to make a new extreme with the direction of the trend. So here we can see it makes a new high and then it starts to shift trend. And so once it does that overshoot, we're going to expect the trend to shift and this channel that we're in to not be valid anymore. And so at that point, we're going to want to start reevaluating the trend and looking to draw another channel. So moving on to another example here, we have another upwards channel. We have a trend break, and then it looks to retest the highs. And you can see just because it breaks the trend, right, and retests, it doesn't mean it's going to start a sell-off. But it does generally mean the trend is now shifting. And so don't expect the channel that you just had to be holding. You can see here, once it makes this break, it makes a new retest. We go in a little sideways chop here, and then it starts to do some sideways chop or larger sideways channel. And so that is one of the biggest keys. If you're still really new to understanding this, is that at least take away that when you see a channel break, that trend is over. You can almost delete that channel now because it's not going to be useful to you. Generally, when I trade, once I have a channel break like this, I don't leave it on my chart very often because otherwise you would have so many channels and drawings and lines on your chart. And at that point, they're just not useful. You want to be having your chart as clean as possible because, again, we're just looking to read the price action. And the channels and trend lines, they're just for our benefit. And so if you have so many of them, they're actually going to not benefit you anymore. It's going to start looking like clutter and it's going to get confusing. And so that's what we don't want, right? And so here is another example of an overshoot. And so here is in a downtrend, right? So here we have a nice downwards channel confirmed off the bottom, confirmed off the highs. Again, this is just another example to say this isn't nothing in the stock market is a fact. We're not going to say, oh, we have a trend break, we're just going to come back and hit. This is a example where we just have the market just decides to just blast through this support level and it doesn't look back, right? It just goes down and then it sells off even more, right? And so just be aware of that when you're looking for what the market's going to do after a trend break or an overshoot. These are guidelines on what they normally do or one thing that they do. But again, this can happen as well. So again, be careful of that. How do we trade these overshoots and trend breaks? Now, again, number one, be cautious. They're definitely a little bit more of an advanced kind of technique. The easier trades are just when you have an upwards channel is buying off the bottom of the channel. This is always a higher probability trade. And so you don't have to be taking these more advanced kind of strategy or trend strategies right away. Just be aware of them and start to understand them. With overshoots and trend breaks, we pretty much always take them in the direction of that channel trend. So if we have a trend break here, we're looking for a trade to the long side because it's going to retest that high. If we have a trend overshoot, we're looking for it to come back, retest, and then we're going to look for a trade to the upside from there. And so again, always trade with the trend and even with these overshoots and trend breaks. Now to show some examples from today's chart and that chart we were just looking at, right? That first channel that we drew, if I just draw it again here, that was a trend break. If I just draw this again, here's the lows, here's the highs, we have a trend break right here. And you can see that rule, it broke the trend and then retest and actually made a new extreme here, made a new high, and then again, the trend started to shift, right? And so that is the biggest thing is with looking with these is this is the area we would look to take a trade potentially as it puts a new extreme in. And then once that is done, we want to be aware and just kind of sit on the sidelines until we see what happens to the new trend, because this is a trend changing sign. And we always want to know where the trend is going. And if we don't know where the trend is, that is our number one thing. We don't want to take a trade. And so until you start to see the sideways trend, you don't know where the trend is and you want to sit on the sidelines. Now, if we go to that spike in channel we were just looking at, this I believe was a trend break as well. And it doesn't take much to show that it's a trend break right here. This is just a tiny little trend break, but you can see it makes a trend break and then it attempts to test the lows or make a new extreme. And it actually does that. It makes a new low here and then it reverses. This is just kind of how these trend channels work. They are really important to understanding where the trend shifts are happening. Now, in the next section, we're actually going to talk about sideways channels and horizontal support and resistance. So now that we've looked at our basic strategies, right? Now we need to figure out what is a leg and what counts as a leg, so then we can start counting our two-legged pullbacks or our higher lows or our failed two-legged pullbacks. And so a leg is generally just a move in one direction. And so these could be considered legs. But there's also legs on smaller time frames. So what we're kind of looking for is legs like this that make up the overall trend. And so that's really what we're trying to determine. And what counts as a leg? What rules do we use to identify when we switch from a leg going up to a leg going down? What we're going to do in this section is really dive into that so we can get a really clear, concrete understanding of how to count legs. So if we just look at a super basic down leg, so we're just looking at this move down. And so what makes this count as a down leg, and when does it switch to being a leg in the other direction? So when we're looking at a down leg, the color of the candle does not matter, okay? So if we have a red candle and then a green candle, that doesn't count as a leg. What we're actually looking at here is we only have to pay attention to the highs of the candles. We don't have to look at the color of the bar, the lows of the bar. We don't care about anything else in a down leg except looking at where the highs are in relation to the previous high. And so what we're looking for is the high of the candle lower than the previous high of the candle before it? And if it is, it counts as a down leg. And so here, as you can see, as these highs of the candles get lower and lower, that means we are in a continuous down leg. This move here, all these candles here count as one leg down. No matter what their body looks like, no matter where the wicks are, no matter the color of the candle, as long as the highs make a downwards stair-stepping pattern, we are continuing to make a down leg. And even here with this green candle, even though it is the low is higher than this one or it's green, as long as the high right here is lower than the high of the previous candle, then it is still in a downwards leg. And so the whole idea of tracking it like this is that we don't know when the market is going to switch to an upwards leg. And the whole idea of our trading is jumping in before it makes that move higher. And so this is why we quantify a change in the leg based on the highs here. And so looking at the definition over here, one tick higher than the previous candle's high is the end of a leg. And so going back to that stair-stepping pattern, right? As soon as we make a higher high than the previous candlestick, then that is a change of direction. So as we're going down, right, this is still a downwards leg, downward leg, downward leg. And as soon as this high of the next candle is higher than the previous high of the candle right before it, it is now switching to an upwards leg. And so this is how we quantify a change in leg. And so all we have to do for a downwards leg, we just watch the highs. As long as they're making this downwards step fashion, that's a down leg. And then as soon as a high breaks above the previous high, that down leg is over. And then you now are starting an upwards leg. And so because of that, we don't need to see a huge move in the opposite direction to count as a leg in the other direction or reset a downwards leg. And so what I mean by that is if we again look at this chart here, here's a high, a lower high, lower high. We're making this downward stepping pattern, right? And then right here, this high is higher than this. And so what we have here is one down leg, and then we have the start of an up leg. And you can see right away, this next candle has a lower high, and we start a stair-stepping lower fashion. And because this high right here is lower than the previous high, that means that we are now in another down leg. And so this is our second down leg. And so even though this is a tiny little move here, right? In terms of looking at a larger trend or a larger chart, it doesn't really look like this is a move like this. It more looks like this. But this is how we quantify it. And so all it is it's an attempt to move higher. And that counts as a change in leg. And then again, watching the highs, once we start that stair-stepping pattern down, that starts our second down leg. And so the market only needs to make this very small little one tick higher move here for it to count as an attempt higher and complete this down leg, and then allowing for us to start a second down leg. And then you can see down here at the bottom, we made another move higher, and it looks like there's a bearish candle. So that same thing might have happened. It might have made just a little move here and then started another leg down. And so let's look at an actual chart here. And so let's say the chart has just formed this high, and so we're going to now count the pullbacks from that high. And so here is the most recent high. And so as we go down, the highs, we're just looking at the highs again. All we're doing here is looking at the highs, and we're seeing that downwards stair-stepping pattern of the highs. And so here we have a higher high. And so here we have one leg down, and then we have a little stair step up, which makes this one leg down. And then we have a lower high here, which starts the second leg down. And then you can see right after, it makes a higher high here, which means that the second leg then ends. And then moving on, we make a matching high here, which doesn't change anything. And then we start making lower highs here. That's another leg down. That is leg 3 here. And then we make a higher high here. And so that ends leg 3. And then we make a lower high, which starts leg 4. And then we make a lower high here, which then makes leg 5. And so you can see here, it gets really choppy, and it starts to, we're not going to count to leg 40 or something, right? The count resets, and we only care about leg 2 because we do that two-legged pullback. Once it gets past a two-legged pullback, we're not really looking for a three-legged pullback or a four-legged pullback. That's not part of our strategy. Our strategy is to look for this two-legged pullback, and then that's our potential trade entry. And so if it starts doing a three-legged pullback, four-legged pullback, you can see at that point you're kind of potentially in a downwards trend, or what we have here is kind of a sideways trend. And so at that point, you're just sitting on the sidelines and not looking for a trade because it's past our trade entry parameters. And so how do we reset the count? A leg count resets every time we make a new swing high. And so what that means is every time a new swing high from a previous high is made, we reset the leg count. So here, as we've gone down here, the leg count hasn't reset. And so here, I think we were at leg 5. And so as we start this upwards move here, this has now made a new high here. And so this high, it's not higher than this high, right? Our original high, it's not higher than that one, but that's not the high that matters. The most recent high is the one that matters. So down here, this high is higher than that high. And so that's when our count resets. And so going from this high now, we would just go down, stair step pattern down, right? Up, new high. And so this is one leg down. And then we have a little leg up and then stair step pattern down again. And so this would be our second leg down. And so that's our two-legged pullback right here, right? And then you can see the market decides to take off from there. And then here, this would be a third leg pullback. That's not one we're looking for, but that is just one to keep in mind because this high, again, this high right here is not higher than the most previous high. And so that's why the leg count has not reset here. And this is technically right here is a third pullback. And then from here, the market just decides to just go up. These highs just keep going up. And so you haven't seen where the leg count resets yet. So hopefully this is starting to make some sense. Let's actually go and jump over to a chart and count some more legs at the chart we were looking at today. And so let's actually just zoom in a little bit so this makes it a little easier. And so let's just start with this uptrend here. And so we have this move higher and we have a new high here. And so what we're going to do is I'm just going to zoom in a tiny bit more to make this is a little choppy here. So it can be hard to see, right? Because these moves here are, again, all it takes is one tick higher and the market is really volatile right now. And so seeing some of these moves can be really hard. So here we have a new high, right? Stair step pattern down. That's one pullback. And then we have a little tiny break higher. So we have one leg down, a little pullback, and then another leg down. And then here, this makes a new high. This makes a high that is higher than this high. And so we actually reset the count. And so here, new extreme or new high to count off of. And then here's a pullback. And then we make a higher high here, right? Stair step pattern went down and then up. And so this counts as one leg down. And then we have another leg down here, right? And so this is our second leg down. And then it starts to actually break higher here. And so this is another two-legged pullback. Now, these aren't great examples of two-legged pullbacks, but these are still two-legged pullbacks based on that watching those highs. And so as we go along in the chart, again, we're just looking for a new high to develop. And so the count has now reset for sure because we've broke above all these highs, right? And so we're just looking for a pullback to start or a new extreme to happen. So here we have a high, a lower high, and so that is a one leg down. And then we just, market continues up. You're not always going to get a lot of pullbacks. Sometimes you'll just get a little move, and we can't always trade that. We're not looking to trade that. We are looking for the very high probability setup. So we're not going to get everything really solid in the market. And so just zooming along here, as we move to the high here, you can see here, now we have made a new high. This looks like the new extreme, stair step pattern down, right? Again, we're just looking at the highs. This high right here looks like it's broken above. So this is actually one leg down. And we start moving down again. And so this is a second leg down. And so that's our two-legged pullback. And you can see here, just looking at the EMA, right? We bounce right off the EMA. That is a pretty solid spot to buy. Now, just continuing on, breaking higher, breaking higher. This high is higher than this one. And so we're going to reset the count. Lower high, that's a leg down. So we have this is just a little mini one-legged pullback here. And then the market continues to break higher here. All the highs, again, I'm just looking at the highs here. I'm not looking at the lows or what the candlestick looks like. Just to look at the pullbacks in an upwards trend, we just have to look at the highs, right? So here, looks like we have a new extreme. And then we're just gonna watch the highs. Stair-step pattern down, stair-step pattern down. We broke. So this is one leg down. Start moving higher. In case there is any confusion here, this does not reset off of something like this, right? It has to be a prominent new leg to the upside, right? This candle right here doesn't count as a leg higher because the high hasn't broken above the previous candle's high, right? So we're not gonna reset the count. And so we have our one leg down, we have our pullback here, and then this starts moving down again. And so we start resetting the count. And so here, this is our second leg down. This looks like it breaks a tiny bit higher. And so that actually does complete our second leg down. And so we then start moving down again. And so here, this is a third-legged pullback. Again, making that stair-step pattern up again. So we have a little another higher move and then again down. So this is our fourth leg down, I believe. And then we start to punch higher, new high. This is gonna reset the count right here because this high is higher than this high, the most recent high, right? We're not caring about this high or the highest high. We just care about the most recent one. And so moving on here, this gets a little choppy here. And so it can get kind of hard to count these, right? And so here, I'm gonna start speeding up a little bit. But here, looking at the highs, this is one leg down, then we break above. And so these highs are higher, so we're gonna reset. This is one leg down, break up, break up. This is higher than this one, so we're gonna reset. While looking at the highs still. And then here's a leg, move up, start making another leg down, one leg down, two leg down. So this still counts as a two-legged pullback. Now, moving on with the chart here, you can see we start going into that downwards trend. And so once we start moving into a downwards trend, we are going to not get as many resets because the highs aren't going to break higher very often. And so here we have a one leg down because this started to break higher. And then we have a second leg down, right? So here, then we have a third leg down, just looking at the highs again. And then here, it actually breaks higher. So we actually reset because this high is higher than that high. And so start to reset, come down. Here, it breaks higher than the previous high. And so this is going to be one leg down. And then we break lower. And then we start to break higher. So this is a second leg down. And so you can see here, this works for a scalp. This is a two-legged pullback. But because it's counter trend, it's unlikely to work, right? And so that's why we're not really looking for those kind of trades. But we still want to keep track of the legs down because that's when we can look for the traps. And we will definitely get into that. And so now, once we kind of, here's another leg down. And then here's an up move, and then a leg down, right? And so another two-legged pullback, and then another move higher. And so definitely, if this is still confusing, rewatch that as many times as you need, but go on a chart and do it yourself. It will become second nature. You will start to just naturally do it and be able to watch this and easily do it. But when I first learned this concept, it was very confusing because it's not really something that is taught all the time or very common knowledge out there. And so definitely don't worry if it is confusing and it takes you a while to get a grasp of it. Now let's actually go to the flip side and talk about moves up or pullbacks from the short side, right? And so this is just the same thing, but flipped. And so instead of looking at the highs, we are actually going to be looking at the lows now, and right? And so all we care about is what does the low of the candle tell us. And so again, compared to the flip side, we're just looking for one tick lower. That makes a change in the leg. So as soon as we make a lower low here, that ends this up leg and starts a down leg. And so here, then we're just looking at the lows on the way down. And then here you have it make another leg to the upside. And so that's, again, that super basic chart. All we're looking at is the lows now because we're counting legs to the upward side now. And so let's look at a little bit one that has a little bit more complicated on it. And so just like the other side, all we need is a slight move lower or one tick lower to change the leg count and to finish a leg count to where we start another leg. And so here, then we start going higher. And so this right here, what we're looking at is here's a low, right? And then here's a leg up and then another leg up. And so this is a two-legged pullback. And then so this could be an area you would short right here and the market would go down and you would get that scalp. So here's another example of a chart. Let's just start on the left. We have a double bottom here. And then we're just looking at the lows, right? We're just looking for that stair-stepping pattern. And so this is a leg up. And then this low is slightly lower. And so that's going to count as our first pullback. And then we start moving lower. And then this makes a slightly higher low. And so that's a move down. And then that slight move higher makes that second pullback. And then it starts to move lower. And so this is a two-legged pullback right here, even though it is such a small move. And so this is a two-legged pullback right here. And so it only needs that slight tick higher. And again, this picture is when the market is very volatile. So this move will be a little bit more prominent normally, but it still counts as a two-legged pullback. Now, as we keep going down, again, looking at resets, now it is every time a new swing low is made. And so we're looking at the lows. So this swing low here is lower than this one. So we're going to reset the count. And so this now is going to be our new low. And then we make a slightly higher low and then slightly lower. So this is just a little one-legged pullback right here. And then we make a new low. And so this low is lower than this one. And so we're going to reset the count. Now we're just looking at the lows here as the market just rockets up here. And then we make a lower low here. And so that is going to be a one leg up. And then we start, this is one continuous leg down because the lows are getting lower. This looks like this makes a slightly higher low here. And so that is a second pullback there. And so we make a new low here, which looks like this, and it's technically lower than this low here. And so that, again, resets the count. And so we then start making a move up here and then start making a move down. And so this is another leg down. And then here you can see this leg looks slightly lower than this one. And so this is still a one-legged pullback right here. And so we have a move here, and then we start moving up and then start moving down. And so that's our second leg here. And then we start moving down, we flush all the way down here and then start moving back up. So this is a move here, up, and then we start moving down. And this low right here is lower than here, right? That's pretty obvious. And so we are going to reset the count there, right? And so this little pullback right here, this would be a one-legged pullback. And then down here, we kind of reset the count as we rocket back up here. And so now if we go back to our chart here and look at our leg pullbacks from the short side. So here, this is just looking at the lows again. All we care about at looking at pullbacks from the lows is the lows. And so here is a one leg up, and then we start making lower lows. And so we have a one-legged pullback here, and then we make another move up, which signifies our second pullback or our two-legged pullback. And then we make another push lower here, and then the market moves higher. And so this would be a third-legged pullback. All the way up here, these lows are just stair-stepping up, and then couple down here, and so this resets, and then we make another leg higher. And so pretty quickly you'll start to just, it doesn't take very long to be like, okay, all these lows are higher than each other, we're just moving up. And then here make a little leg down and then a little leg up, and then we actually start to push lower here. And so this low all the way down here is actually lower than this one, and so we're going to reset the count. And so resetting from here, we make a move up. This, if I zoom in here, you can see this does break a little bit lower. So we have a low here. That's a one pullback, one-legged pullback, a little reset, and then another pullback. And so this is our two-legged pullback to the short side from our little down move here. And so if this was a downtrend, we'd want to short here, right? But because this is an uptrend, we could actually look for that trap. And so looking for that two-legged trap, right? So here, when it makes that little move down, we'd actually look to buy here and catch this move up. And so we will definitely come back to this when we have talked about that a little more. But I did want to show that here with this example we have right here. And so here we have that move down, and then it starts to move up here as we continue to skyrocket. And people did get trapped right there to the short side. And we will definitely go over that more later. Now moving along, this is that choppy area of the chart. And so you can count. So once you get into an area like this, you can continue to count. But quite often when the chart is very congested like this and choppy, you're not going to take a trade anyway. So it's not even worth to even take account and be keeping track, because you're not even going to trade if you see any kind of entry. And so sometimes you will see this and you'll be like, oh, I'm just going to go, make breakfast or something and take a break, because you need to wait for something like this to happen, because then you can start actually having a good idea of what's going on, and it's actually an area where you want to trade. But so we can still count some of this just to give you an idea of what that is like on the chart. And so here we have, if we go back to where we were, moving down, here's that leg down. And then here's a slight move up. So that is a leg up. And then down. And so this is actually lower than this. And so you actually reset off of this bar here. And then you start moving up. So you have a one-legged pullback. Then you start going down. Resets that leg. And then you actually have a higher low here. And so that is a two-legged pullback. And then it moves down from there. And so here we actually reset the count because this low is lower than this one. So stair stepping up, even if they're matching here, that's okay. As long as it doesn't break lower, it's still counting as moving up and one leg here. And so here, this looks like it broke a tiny bit lower here. And so we are going to, this counts as one leg up, and we have a leg down. And then this isn't lower than our low all the way down here, right? So we're not going to reset. We're just going to continue the leg count up. And so here is where it looks like it moves up to, and then it starts making a lower low there. And so here's that two-legged pullback. And so you can see here, once you get into this choppy area, you're not going to want to be shorting a two-legged pullback here, because the market is in a trading range, and it's not gonna, even though you have technically a two-legged pullback here, which can be a sell signal, there's not room in the market to move down because it's not in a trend. And so here the leg count going back to this doesn't actually reset. We get another leg up here and then move down, down, down. This low is actually lower than this guy, right? So we actually do reset over here. And then moving on here, we start moving up, move down. So this is a one leg up. And then we start making a lower low, which changes the leg direction. And then we start making higher lows, which make that second leg up. And then this is where we flush down, right? And so this is where the market moves down. And then as you can see, once this happens, you just wait, right? You just wait until it starts making higher. And then once you're in a massive downtrend like this, where it just keeps making lower lows, you can see here, we have it just keeps making lower lows. Here we have a little bit of a reset. It makes one leg and then it just starts making lows. Here's another leg up, new low, reset. Here's one leg up. And then here, this is actually a two-legged pullback right here. We have a new low and then a stair step up, stair step down, and then a stair step up. So that is our new low, our one-legged pullback, and then our two-legged pullback. And so from that downtrend. And so this is where we look to short, and you can see the EMA is holding it perfectly too. It's kind of a red bar. We'll get into that later. But this is kind of what we're looking for. And so now let's actually go back to our chart picture. And now we need to do both sides, because as we're doing this, even though we're in, when you're in a downtrend, you're looking for that two-legged pullback normally, right, to short. You're also looking for that two-legged pullback trap to the upside to short off of as well, to trap people. And so this is why you have to keep counts to both sides, because when we are trading, we can get trades off of counting the pullbacks from the highs, but also counting pullbacks from the lows. So by all means, if you want to go and practice on a chart with doing one of them at a time and then come back to this, do that, because this is going to combine both of them, and it will definitely get confusing because it's going to be a lot on the chart. So for simplicity's sake, I'm going to just start off this low here. And so this is going to be our new low. When we're counting legs to the downside, again, we're always looking at the lows here. And so we have a one-legged pullback, and then we start moving down, right? And we've already done this. And then here is that second pullback. And then that new low. And so here is one pullback, two pullback. And then as this is trending up here, we make a new high. And so we want to be looking at the highs for counting the pullbacks to the upside, because we want to be looking for that two-legged pullback to the downside and the upside at the same time, right? So here, counting the lows, the highs, sorry, and then this is one-legged down, so this is a one-leg pullback, stair step pattern up, that resets the leg, and then we make another low here, which starts the second leg pullback, and then right away we break higher. And so this is actually a two-legged pullback here, which you could potentially go long off of and scalp out here. And so here then you can see we start going up and we start resetting the count. And so this high right here is higher than this high, and so we reset the count to the long side. And then also down here, this low here is lower than this guy. And so we're going to reset both counts. And so in this area here, even though we're counting both sides, you're not always going to use both sides. With this overall setup, we had an up move and then a two-legged pullback, which in this case, if you took it, it worked out great. The market moved up here. And so the brilliant part about this first section that we're looking at is we had that two-legged pullback to the upside, but we also had a two-legged pullback to the short side, which actually failed. And what I mean by that is you can see as the market started to rocket up here, those people that tried to short off of this two-legged pullback right here. Right here we have one leg, here we have our second leg. If you went short right here, you can see the market did not sell off here. It made a short move down and then reversed. And so that's a really good long signal on itself right there. And so this was actually two setups in one. And so we will get more into that later, but I just wanted to point that out here. Hopefully that makes sense with what we are looking at. Now, back to the leg counting, we have our new high, our new low. And so just going off the lows first, we have counting up our stair step pattern, right? We have one leg up, one leg down. This low is actually not lower than this guy, so we have another leg up, so that's two legs up, and then it looks like it just falls out from there. And so from the top side, we have stair step down. This is one leg down, one leg pullback, and then we start moving up, and so that kind of resets that, and then we start to move down. And if we look here, this doesn't make a lower high all the way down to here. And so this can actually count as the second leg of the pullback. Even though, we've sold off really far, it still counts. And so a second leg can still be super far down here, and you could get that trap here by shorting those people trying to buy that second leg to the long side. But if we go back to our EMA rules, you can see this is really far from the moving average, and so we're not going to want to take that trade. Now, let's actually go back to our chart example and start to look at some more of that counting just on both directions of the market. And so as we move up in this upwards trend, I'm going to try and go through it pretty quickly because this video is very long. And so we're going to start here. We're going to move up, right? We got a leg up from the lows and then down. So we have our first legged pullback here, and then we have a move up and then down, and then we start to go up from there. So here's one leg, two leg, here's our third leg. From the upward side, here's our high. We have one leg down, we move up, we have another leg down, and then we make a new high. And so we actually have a second leg, two-legged pullback right here. And then we have a new high where we make that other smaller two-legged pullback. And so this is a little congested here. And then as we go up, we make that fourth leg pullback from the lows. And on the long side, we have a little one-legged pullback here. And then we start stair stepping higher. And then we have a new extreme. Here I think is a fifth leg pullback to the lows. And then all the way down, we make a new low. And so this is going to reset off of this, our lows. And then from the extreme up here, we make a one leg down and then two legs down. And so this is a two-legged pullback from the high here. And then from here, this was like a five-legged pullback from the lows. So we actually, once you're up here, you don't even count the legs anymore. You just want to be paying attention to, has it reset? And that's the biggest thing. And so here, now that we have reset, we're now looking at the lows and counting this again. So we have, here's a low, we have that one leg, and then here is that second leg. So this was that two-legged pullback from the lows here. And then going up, the highs, they only reset here. And so this is a little tiny one-legged pullback, and then they shoot up and start moving higher. And then this then just keeps going higher and makes another third leg pullback to the upside. And so this actually might make a new low here and reset. But once you see, you're still in the uptrend, that's not a huge deal. And so here again, once we get to the more choppy section of the chart, you can still be counting the lows. So if we just quickly go through it, here's a new low, an extreme, and then we have these pullbacks, right? You can see I can just scanning the lows, right? We're just looking. And so this here actually resets. And so we have, this is one section here, and then this is another section here. And then from the highs here, here's 1, 2, 3, 4, something 5 in here, right? At that point, you really don't care too much. and then here's a reset, one down, reset, one down, reset, one down, two down, and then reset, and then we're down from there. And so once you get in a sideways trend and sideways chop, you can kind of just not pay attention as much, because when the market is in such a trading range like this, you're not really going to want to trade anyway to begin with. Now, as we move down here, we have that extreme, right? And so we have that move down. This is one-legged pullback from the upside. Here's that two-legged pullback. And then we have three, and then we have a new high here. And then one down, two down. Here's a reset, one down. And then off the lows here, we all the way down, here's a new low. Here is a tiny legged pullback, and then we move to a new low here. A little bit of a pullback here, new low. And so here is actually that two-legged pullback we were looking at earlier. That is great. And so it is good to keep track of both sides, because you don't know when you're going to either get a trap or just a normal two-legged pullback, or even a lower high or higher low. And so this will take practice and a lot of kind of just wrapping your mind around it to get used to it. But hopefully this extremely long video of walking through all this did help you. And if you still have questions, try and rewatch it again. But if it's still not making sense, definitely reach out to Michael or I, and we will be happy to help you with this. Now we're going to actually move on to candlesticks and what those tell us. So now let's go to a chart and actually look at examples from this chart that we have been looking at. And so one thing, because the market is extremely volatile right now, looking at that support and resistance is going to be a little weird, because the market, the candles aren't the normal size that we're used to looking at. So the setups are all going to be the same and they're all going to look the same, but that resistance and that distance in the market is going to be a little bit weird. But hopefully, because we're mainly looking at examples of setups, it won't be too confusing, right? So let's just start on the left over here, and let's just say that we are right here in the market. The market has essentially just kind of come down, started to sideways chop, and now we're breaking up here. So we're kind of starting an upwards trend here, right? And so we want to start looking for potential long setups because the trend is up. And if we look at the EMA, we are now above the EMA. And so let's just zoom in a little bit more. Here we have this, I remember, is, I believe, a two-legged pullback right here. So we have one leg down, right? And then a two leg down. And so that is a setup. So that's our next thing on our checklist. And then we want to, as this bar is forming, this is a good signal bar. And so we want to put our stop above this bar. So when it breaks above this, we get filled on our order. And then where is resistance? So resistance is right up here. We do definitely have room to scalp out here. And then we put our stop below here. So one thing on this trade is, once we got filled here, this might have got us. This might have filled our order for a profit. But sometimes if your order is right there to the exact price, it sometimes won't always fill because of how limit orders work. If the price comes and touches your limit order and then sells off, it might not get filled and you might have to wait. And so on this trade, if we were in from over here, we actually had to watch the market do this, and then eventually it worked out. And so this, once you're in a trade, you just have to let it sit there. Sometimes it can be really agonizing, because a lot of the time we're used to being in trades almost just a few seconds. And then that one trade out of 50 or something, when you're in a trade for a couple minutes, it can be really agonizing just because you're not used to being essentially at risk or in a trade that long. But never change your trade. Always stay with it once you're in it. If it turns out to be a bad trade, that is okay. Just go back and reevaluate. Don't change it or get in the habit of changing anything when you're in a trade. Otherwise, it'll cause you to get used to doing that, and it will hurt your bottom line. And so for this, if you didn't get filled here, you wouldn't really look for another trade. So I don't like, once I'm in one trade, even if another good looking setup comes in, I don't like to have two trades going at once, because then you're just increasing your risk. You are doubling your chances to make a profit too, but I don't like the increased risk, because what if you made a bad read in the market, right? You are essentially doubling down on the same point in the market. And even though if there's another good looking setup that shows you that, oh, this is going to go higher, I'm perfectly happy with just the first trade that I put on working out. I don't like increasing my risk, because maybe there's something I didn't see and the market decides to turn and you essentially lost two trades when you would have only lost one. Okay, so once we saw this filled, the market started going up. We did have that little two-legged pullback here, but because we were already in a trade from over here, we wouldn't want to take that to the long side. And at this point, the market is kind of getting a little choppy here, and this isn't the greatest signal bar, right? And it is an inside bar. And so we definitely do not want to take this trade, because this is a smaller bar than this one, right? On both ends. And so we want to just avoid that. Now you can see that it worked, right? But our original trade here would have worked. And just because something does work doesn't mean it works often enough for it to be profitable. And so as we rocket up here, we can see we have that one-legged pullback here. That is not, we don't want to trade that, right? Even if we go in our checklist, the trend is up, the EMA, we're above the EMA. You can say we are a little far from the EMA. And so definitely be careful with that. Sometimes it still will work like this, but I generally like to stay away if we're far away from the EMA. Now, the setup, we only have a one-legged pullback here, and so it's not really a good setup here. It is a higher low from all the way down here, but because it has already moved so much in this direction, it's not really what we're looking for. And so as we start to move up, right, we can start to actually, if we zoom back out and we look to, now that we have some price action here, we want to make sure we're drawing our trend lines. And so if we go back to drawing a channel off the low here, we can match it off of here, right? And then we can see where this is a trend, and we can match it. Now we can match it here and see how that fits. As we're going forwards, we can see that it breaks this. And so what does that mean for us? And so once we see this break, we can start looking for it to potentially make a new extreme before it makes a trend, right? If we go back to our trend channels and our overshoots and trend breaks guidelines. And so what we're looking here is, here's a new high. We have this is a one leg, two legs. So we have two legs, and then we have the trend is up. The EMA, we are right at the EMA. Now this signal bar is not good. It's pretty bearish. It's really not a great signal bar. It kind of sucks, because you can see now that this, if we scalped out here, this would have worked great. But because this signal bar is bearish and not good, that is one thing on our checklist that isn't met. And so that's going to be a trade you're going to skip on, and it's going to suck. I mean, it's going to suck watching that. But there's always more opportunities, and there's always more trades coming. So here, if we actually count off the lows here, so as we start to shoot up, let's count the lows and the pullbacks to the short side. So if we have this low here, we have a one-legged pullback, make a tiny leg here. So two-legged pullback. So we have a two-legged pullback here, but because, right, we're in an uptrend, it does this, and then this has failed. So this is a two-legged trap trade right here. So we have that two-legged pullback right here, right? But we're looking to buy it because it's going to trap shorts. And so we're going to expect the market to go up from there. And so here we see it break lower, and it starts to then reverse. And so what we would do is we'd put a buy stop above this red bar right here, because this is the bar where it signaled that two-legged pullback initiating. And so this is where essentially people are shorting here, expecting this two-legged pullback to work. And we're going to say we're in an uptrend, and so we're going to bet that it's going to trap people. And so once it breaks above here, that is when people are going to be trapped. Because think about on the flip side, right? If we went short here, we would have our sell stop right below here, right? And so we'd be going for a scalp, and we'd put our stop loss above here. And so if we then on the flip side, if we put our buy stop above here, as soon as the market starts to reverse on those people, it'll make them have to sell, and we will essentially buy from them. And then this will cause the market to shoot up in our favor. And so that's how traps really work. And so that's what this trade here is. And so we would scalp out, right? And so that's a two-legged pullback trap. And so we look for that trap because we're in an overall uptrend. We just had a trend break and we're above the EMA, and we're going to assume that it's going to keep going up for a little while before it tries to make a new extreme, right? And so we can see that does end up happening, and that the market just starts to go up here. Now, here, we eventually make a new extreme up here. We're not really going to be looking at this because at this point you're far from EMA, right? And we want to now wait to see what the market is going to do, because we've made a new extreme here, because we've broken the channel here, and we are starting to make a new extreme. So we're just kind of going to wait for that, right? And so here we have a one leg down and then two legs down. And so it does break above here a tiny bit. And so that's a two-legged pullback, right? To the long side, it's technically at the EMA. The trend is, you could say, kind of up. But again, because the signal bar here is, this is not a good setup, right? We don't really know where the trend is right now because it was up, but it could be, starting to go sideways. It could start to go down. We could keep going up, but we're at a point where we want a little bit more information first. Once we see the market start to do some of this, starts making a lot of entries, we just want to stay out of this. And so even if we count to the short side to see if there's a trap, here's one leg up, two leg up, and so this is a pretty bearish signal bar for a two-legged pullback, right? But we don't want to take that, because look at all these adjacent bars. We will actually, after this, we will talk about trading in chop, and just right here, we want to stay out of this, right? The EMA is flat. That's a really good indicator that you're in a sideways chop area, right? And so you just want to stay out of this. And so once you kind of see this, you don't even have to be watching what this is, because you kind of just want to wait until it breaks out of that area. Now, one thing you do want to do, like when we were drawing channels, you want to start trying to look at, okay, where is the support? Where is the resistance? Just so I can get a grasp of what's going on, right? So I usually like to draw a line at the highs and then try and figure out where it is on the lows. You can also do a channel too, of course, but sometimes they won't match very well. Still, this is essentially a channel as well. And then as the market goes forwards, as we know, it pukes out this side and sells off. Now, looking at this channel, just to kind of look at this, here is a low and here is a two-legged pullback to the short side, and you can see that it does work. But because we're in that sideways chop, we're not going to want to take that necessarily. We're going to want to just wait and see when the market then breaks out here and starts doing something that's a little more momentum based, because we don't always need to be trading. You can just sit out the market and wait, okay? Again, the bottom line here is for us to make money, right? And so if there's an area in the market where your likelihood of making a good trade is less than, let's say, in a very strong move like this, just wait it out. And especially on a day where there is so much movement in the market, where there's going to be plenty of opportunity, it is okay for you to wait and wait for the market to then start to make, a great down move like this, or make another move up in a trend like this. You don't have to be taking every trade. That is a really hard part that I struggle with, and I think a lot of people struggle with, is they want to take every trade and they don't want to miss out on anything. But at the end of the day, all that matters is if you're making a consistent income. And even if you have to just not take a trade over a whole day, right? Sometimes you just sit out a whole day. If the market is super slow, or if you're just having trouble reading it, sometimes it's best to just not trade at all And that can be kind of frustrating, especially when you really want to trade. But the bottom line again is making that consistent income. And if you're trading to where you're losing money, those are the kind of things you need to do and change to make it so you start making money. Now, back to this chart. Now that we started in that downtrend channel, we don't know where it's going to go. We have to wait for it to start, making swings so we can draw a channel or a trend line, something that gives us an idea of what kind of trend the market's in. But first off, once we kind of see this happening, we can see that, okay, the market's below the EMA, the trend is down, right? And so we can start looking for setups. So one thing that you always want to start looking at is when the trend switches to the downside, right? You want to be looking at that failed two-legged pullback. So if the trend is up, there's going to be traders that are looking for that two-legged pullback and they're going to look to buy that, right? But if the trend is about to switch, we can trap those people and then buy it as it goes down, right? So here is a high, we have one leg down, and then here is our second leg down, right? And so this is a potential where we're gonna do that, right? And so here, you can see it breaks up here, initiating that two-legged pullback from here. So people are starting to buy this. Now, this is a really bad signal bar for that. And so we would definitely want to skip it because of that. Also, why we would want to skip this trade to the long side is, well, first off, the trend is down. We're below the EMA and it's a bad signal bar. So there's definitely a lot of reasons to not take a trade to the long side if we're not even sure that we're in a downtrend. But there's a lot of factors here that let's just go and put this on the right side of the chart so we don't really know what happens next. This is not a spot where you would want to be buying, right? We're below the EMA. We've just broken to the downside of this. This signal bar is really bad. And so if we just actually continue to the right, you can see here people started to buy, right? And then it reverses on them. And so this is actually a really good looking failed two-legged pullback to where you could short here and bet that it's going to go lower. Now, why do we not want to take this? Because we are so far from the EMA. If we're going to enter in, think about if we're going to enter in all the way down here, we need the market to move even further down here. And so that's forcing the market to get even further away from the EMA when we're already really far from the EMA. And so that is a reason why we do not want to short right here. And so other than that, this short looks great. There's no support down here that we can see, right? There's nothing holding this back except for the fact that we're far from the EMA. But that is a 100% valid reason not to take the trade. And you can see that if you tried to short here, it would have worked a tiny bit and then it would have blown you out because the market needed to come back close to the EMA. And so that is why following that EMA rule is so important, because even if a setup like this one looks so good, that one reason right there will keep you safe away from some trades that will cause you to lose. Now, as we continue this downtrend, we can start to get an idea of a channel. So when you're drawing, we already know that this is a spike in channel because we've looked at it before. But when you're initially drawing, you're going to be drawing channels like this. You're going to say, okay, maybe this is the down channel that we're in. And then as soon as you see the price break above this and then start to trend like this still, you're going to want to move your channel because, oh, I didn't have enough, you didn't have enough data at that point to draw the channel. And so from here, then you can start to draw your channel here. So maybe it looks something like this. So we have the lows here. This looks pretty good. And then this kind of starts to validate there. And so you don't have to, when you're drawing channels, you don't always have to be drawing them off the highs in a downtrend. You can sometimes go in here and say, okay, we have all these matching lows, right? And then you can drag it up and match it off the highs. And so put it up the high here. And then I think to make it longer, it's always a struggle to find which one extends what. And then, but here, so this can start to look a little better, right? And so it can be really hard to get it to match perfectly. But so this kind of starts to look like a better channel. And so This can be when we're going forwards here, looking at the chart. Let's say we have this channel, the chart's trending right here. We just made a high. Here's a leg down. Here's a one-legged pullback. And then here is a two-legged pullback. And so we're not going to want to buy long here, right? We're not looking at any longs right now. We're only looking for shorts because we're below the EMA and the trend now is clearly to the downside. And then so as we start to break up here, we definitely want to be looking at two-legged pullbacks to the short side, right? So here's a matching low here. And so that, again, keep in mind that is going to be a potential resistance area. And so we have a low here. One pullback leg, looks like a little down here. We make another candle forms, right? And so now we have essentially that two-legged pullback. And so how does this one look? And so we have our overall trend is down. We're right at the EMA, which is really good as well. And then we actually kind of are at this pretty close to confirmed downtrend channel. And so that's not on our list as a check mark. But that is definitely something that is really important and can solidify your trade. And so because we're going to butt up against essentially this downwards resistance line, this is essentially a resistance line as well. And so that is another reason to say, hey, this is a good area to short. And so now what we're going to look for is this bar to form bearish. And so we would look down here, we'd watch these numbers go all the way down to 0. And then as soon as it formed, we would put a sell stop below this and then hope that the trade then gets filled. And so we would then, as the market then continued, this then filled us, and that was a great trade right there. And so that was just a two-legged pullback, downwards trend right at the EMA and right where this trend line converged. And so that is really a really good textbook setup here. This candlestick right here is still bearish enough that it is a solid entry. Of course, they don't always have to be bearish candle bars that look like this. This one is good enough, and this one right here would be good enough too. Now, we wouldn't want to take a signal bar that looks like this doji, right? Because that's not really very solid in any means. And so now the market kind of sells off here. We want to, let's just extend our channel to the right, and so we just have a really solid understanding of when it potentially breaks. And so again, we're just looking for trades, right? So we have a move down. Here's one leg counting from the upside. Here's a one leg pullback and then a two leg pullback. And so we're not going to take this long, of course, but we're just again looking for potential traps. And so if this two-legged pullback came up here, then we would look to trap off of this. But because it is so low down here, right, we don't want to be taking shorts off of that. But so here, off this low, we have a one-legged pullback, and then it doesn't make a new low, and then here is a second leg. And so let's just analyze this trade. We have that two-legged pullback, we have a setup, we know the trend is down. Where's the EMA? We actually bounce right off the EMA, that's really solid. And then we're still in this channel. And so when you're looking at that first checklist of where the trend is, looking at where you are in relation to your channel is essentially that as well. Because, right, if we're breaking out of a channel, that is number one. We know that we're breaking out of the channel and the trend is changing. Right now, the trend, it looks like it is staying in this channel and downward. And so that is a really key thing. So right now we have the trend is down, just overall, and then we're by the EMA, and then we're still in this trend channel line, and we're holding that really well. And so now moving forwards, next thing, what is our setup? We have a two-legged pullback, and then what does our signal bar look like? Our signal bar is a really nice bearish signal bar, and so we're gonna wanna short right below that. Now, in terms of support and resistance, this is definitely a little on the close side, but I would say there is enough room here to scalp out if this was a normal looking chart. Now, again, these lines are a little bit abnormal, but in terms of what a normal chart would be, there would probably be enough points here to scalp out, and there isn't a really solid double bottom here. Now, because we're in such a downwards trend, you can assume sometimes that the weaker support levels are going to break easily. Here's that kind of that double bottom, and the market just blasted through that. You can be more assured that support levels are going to fail and resistance levels are going to hold in a downwards trend. And on the flip side, in an upwards trend, you can assume that resistance levels are going to break and then the support levels are going to hold. And so when you're kind of on the edge where there's not really a solid looking support level here and a really solid setup, you can assume that it's probably going to be okay in your favor and it is going to have that extra to potentially push through there. So let's assume we took this trade because it's a really solid looking setup. So if we just move here and assume that we have an order waiting and it gets filled, you can see that the market just sells off right through that and you make a great scalp there. And so now going forwards, as we start to break out of this channel, we can say, okay, the trend is still down overall, but we want to be cautious now. And so we don't want to be taking every trade we see, right? And so here, new low, we have a one-legged pullback and then we move up, right? And then so as it forms, we have a two-legged pullback right here. Here's one leg, two leg. This bar is pretty good, bearish. And so one thing is though, now we're kind of above the EMA, right? This doesn't look amazing, but this can be a trade you take sometimes. I would say this is an aggressive entry because you would be betting that we're going to break through the EMA. Now we do have the idea that, okay, because we've broken the channel, we're going to potentially try and remake a new low. But sometimes we still want to be waiting for a better setup. So let's say that we're going to skip this because we don't know it's going to break through that EMA. And so here, moving forwards, it looks like that two-legged pullback would have worked. We would have got a scalp out there, and that's okay. It is okay to miss out on trade. The thing we want to definitely miss out on is losses. We always want to try and keep our losses as low as possible, even if that means we miss out on some winning trades. Now, what we have here though is this is the better entry off of this setup right here. So what we have here is we've made that two-legged pullback, and then now we're starting to make a leg down, and then the market has made one leg up. And so what this is this is a potential lower high because it's lower than this little double top right here, right? And so because we still have that overall trend down, we are assuming we're going to try and break and make a new low here. We have good justification that we're going to still go down. And so this as well is a pretty bearish bar for a lower high because the market went up here and then kind of closed at the lows. And so what we want to do is we want to have a buy stop below this candle right here because we're going to assume it is making a lower high, kind of confirming that downtrend. Let's say that we have an entry there, we're waiting, and the market then starts to move forwards. And it looks like the market then essentially just falls out and fills our order very quickly and breaks and makes a new low here. And so that is great for that setup. And so sometimes in areas like this, when you are unsure about wanting to take a two-legged pullback, wait for this lower high. This is always the better setup. It's always it's essentially confirming that shift in trend. And especially when you have a very bearish bar here, and you can see again, we were below the EMA on this trade now compared to shorting up here, betting that it's going to go through the EMA, right? And so now moving on, you can see here here's our one-legged pullback, here's our two. So we're making a second leg here. Now we're going to see, is that going to break higher and potentially make a trap? And of course, we want to make that at the EMA, right? So here is a two-legged pullback, right? From the long side, and so we're in a downtrend still, but the market now, we're not sure if it's going to reverse here. And so this is a good signal bar to the long side, but we're not going to take a long trade yet because we are still in an overall downtrend. We're below the EMA, and that's just not a trade we're looking for right now, right? But we could be looking for a trap to the short side. And so here we have a really good bearish bar now. This looks like a good reversal bar if you're going to short this, attempting to go lower, right? But we're a little far from the EMA. Entering down here is far from the EMA, and our overall trend, we might be making a trend shift. So we are going to skip on that, assuming that we would not have enough room to get our scalp. And so here the market then goes lower, but it looks like it might reverse. So here we start, actually looks like we're starting to reverse here. Now here we reset the leg count, right, from the highs. Here's a double bottom. So you can reset this as a new low right here to count, or you can have this be a first-legged pullback. So let's go up here, see what happens. And so this, you could say this is a two-legged pullback from the short side. And you could look for a short, but we're above the EMA, and we're kind of starting to get a little choppy, right? So we're not going to want to take any of those setups potentially yet. We want to wait for a really strong setup. So here, this is one leg higher. That's really nothing we're looking for. We're not really looking for a good lower high setup here yet. This isn't a really good lower high. And so actually at this point, kind of once we have a lot more data, let's zoom out again and reevaluate your trend line. And so this is maybe where we'd say, oh, we are now seeing that this is a spike in channel. So you can see here now we can say, oh, okay, it looks like here, and then drag this on the bottom. So this is a case where, initially we had this channel, this channel worked out great for us. And then now that we have more data, we actually don't want that channel anymore. And so we're going to delete that, and this is going to be our new channel. So we're actually still in this channel. So this would have actually been an okay reason to take a short trade here, knowing that you had that channel in place. But now we can see we have actually overshooted this channel as well. So we can assume we might make a retest of the lows and then trend shift again. And so as we could kind of move forwards here, we can start to see, okay, here is one leg, two leg. Let's actually extend this channel so we kind of know where the lines are going forwards. And so this looks like a two-legged pullback, and here's would be your signal bar. So that's a bad signal bar to go long, right? Maybe we could look for a trap here below here. This is kind of a bullish bar. And so we're not going to want to potentially take a trap on that. And so here, this is actually a really good bearish bar to take a trap off of. Now, we have, again, downtrend, right? We're kind of breaking this channel, so our trend is a little weird. We are at the trend line, good signal bar. Our setup would be a failed two-legged pullback. And now the only thing here is we have a matching low here and a matching low here. So it kind of is starting to look like we're bottoming. And so this would be a reason to stay away from this, especially because you are kind of shorting away from the EMA. You're still kind of far from the EMA. Even though the candle came up and almost touched the EMA, you're still making the market have to move pretty far away from the EMA. And so this is not an area where we would want to take a trade. And so moving forwards here, we can see it does start to break through that, but it does rebound. So it kind of breaks through that a tiny bit, but not enough for us to get a potential scalp out. So that would have been a good area to stay away from, right? And so now we have broken out of the channel again. So maybe we will start to reverse because we made that break of the channel and then we made a new extreme right here. And so we can start to look at, okay, maybe we're going to change trend, right? So our trend right now is kind of a question mark. And so what we want to do still though is be counting the legs, right? So here's a low, moving up. Here is a one-legged pullback. And then, so that's one leg right there. And here we move all the way up here and then we come back down. So that is a two-legged pullback and it initiated to the short side. So we're not going to short this candle, right? Because we're kind of changing trends. It's above the EMA. But here, this candle, this is a two-legged trap. And so it kind of makes a break lower and then it starts to make a reversal candle. And so what I mean by this is still kind of a bearish candle. It's not a great looking candle, but walking through it to just kind of show you what this candle is telling me, it opens here, it goes lower, and then closes here. And so the idea is that, okay, maybe if we analyze all these three candles to look at what's happening, so the market kind of went up, and then it kind of went down, and then now it is essentially right here. And so that's kind of talking through what these three candles are doing. We moved up, we kind of went down, and now we're starting to look like we're going back up. And so that can be where we maybe want to potentially get in and see if the market is going to take off. And so I kind of did move further in the chart by accident, and we can see that we did take off there. But that's the idea of candles. And so once you start to really understand them more, it can be okay to take some signal bars that are a little iffy like this if you are very clear and aware on what the trend is doing. And so this is a very aggressive setup, and I wouldn't suggest taking this a lot of the time, but it is something to be aware of. And so moving forwards, we can already see that setup does work. And so moving up, the market just kind of takes off from here and we start shifting higher. And so I think I'm going to wrap it up on these examples here because I am starting to lose my voice. And so hopefully this was a really good analysis on the chart and kind of my thought process going through the chart and seeing how trades work. Definitely there will be either some examples in Michael's course or we will start to add more. But for now, this is a really good starting point. So now to wrap up this course, let's talk about further education, a few resources, and things you can do to continue improving your trading beyond this course. Now, first off, there is a course private Facebook group. So now that you're in this course, you do get to join the private Facebook group that is only for people that have taken this course. So there will be a link to that down below. So definitely join that. There are a lot of people that are discussing trades. And if you ever have questions, definitely go there and seek people out. And because collaborating is a really big way to help further your education, because for an example, Michael and I, really when we first started to learn about trading, we collaborated a ton. We always would be talking about trading. We'd always be bouncing ideas off of each other. And so if you can find a buddy to talk about trading every day or every other day, right, that will be a huge boost to your learning curve because it'll be someone with a different perspective, different ideas, and it will just help solidify everything for you. And especially if you have questions, maybe they have the answer. One thing that really helps in terms of understanding and getting a better grasp on all this is just like that example of where I went through the charts and kind of just walked through every trade and analyzed the chart. Do that yourself. Go back multiple days and just start looking at charts and look at trades. See where trades are. Try and look at the chart bar by bar and say if you would take a trade there or not and say why, and then see if that trade worked out. And then also, once you start trading, at the end of every day, go back and review the whole day. See where you took trades and then see trades that you actually would want to take based on the trade ideas. Because sometimes during the day, in the heat of the moment, you will take trades that you will later say, well, that was actually a bad trade. I shouldn't have taken that. And I shouldn't have taken that because this, and this, right? And that will help you learn a lot quicker. And then also going through and learning all that stuff is it will help everything become like muscle memory. As you look and see two-legged pullbacks, failed two-legged pullbacks, higher lows, double tops, as you just look at this stuff more and more, it'll become more ingrained in you and you will be able to do it faster, which will make you be able to see everything clearer in real time. Now, in terms of daily journals, I wouldn't say I do a daily journal of my trades, but definitely so many mentors out there say it is good to do. And one thing I do is keep track of my daily emotions and how that affects my trading. I do plan on creating a psychology side of things course that will be added with this if it isn't already. And I'm really going to talk about a lot of that and how emotions affect your trading and how you can deal with those to better trade. And so definitely check that out because honestly, strategy is only half of the battle. I think the really thing that's what sets profitable traders versus non-profitable traders is the emotion sides of things, right? There are so many strategies out there that work and that are good, but if you can't handle your emotions around trading, it doesn't matter how good the strategy is. Now, in terms of contacting us, the best place if you have questions, I would say first, if you have questions, try and reach out to the Facebook group because Michael and I do get a lot of questions. If you want your question answered quick, try and reach out to the community first maybe there is someone else or multiple people that will already be able to help you. But if you do want to ask us directly, either comment in the course Facebook group, or email us. Those are generally the places we will check first. And if you comment on somewhere like YouTube, we might never see it. We kind of have to go through messages in a hierarchy. And so because you're in here, we want to make sure we're answering your questions first. So those are the best places to contact us, either email in the course Facebook group or commenting on the course directly. Now, with all that said, don't hesitate to reach out and give us feedback, either good or bad. We are always wanting to improve this course, and we are always planning to add as much as possible to this course to increase the value of it over time. I hope you enjoyed this course, and I will look forward to helping you out mastering this strategy. So because counting legs can be so confusing, these next couple videos are going to be still talking about counting legs and trying to explain it in a different way, just so it comes across better if it's still being a problem for you. Now, when you're first starting out, even though we have gone over all the setups, start with trying just to learn a two-legged pullback with the trend. I know we've talked about lower highs and higher lows and traps, but those are a lot more advanced, those are a lot more confusing. And until you really master the two-legged pullback with the trend, those are not going to be worth your time. And so what I suggest and what I'm going to walk through with these two videos is to push you towards that and really be talking about only two-legged pullbacks with the trend and trying to ingrain those into your mind a little bit better. So first off, this video is going to be talking about two-legged pullbacks in an uptrend. And so for counting legs in a two-legged pullback, what are we doing, right? We are looking at counting the highs. That is all we cared about for counting highs in an uptrend. And so what I mean by the highs is looking at the highs of the candle. And so that's what we use for counting legs or pullbacks in an uptrend. So if you're in a solid uptrend, only be looking at the highs for a pullback. It doesn't matter. The lows do not tell you anything. No matter if a low is lower in this regard or whatever the lows are doing, it does not matter. It is all about what the highs are doing. What counts as a swing high? So a swing high is confirmed when the next candle after a high is lower than the previous candle's high. And so that's what a swing high is, and that's what we mean when we say a swing high. It doesn't need to be multiple candles that go down. All it matters is if there is a high put in place and then the next candle's high is lower than that. And so basically this is what we're looking at here. If I just draw a line based on the highs, is we have a leg up and then it starts to make a pullback here. And so this would be our first leg of our pullback from that swing high. So what about when the count resets? The count resets when a new swing high is made that is higher than the previous swing high. So if we look at this right here, we have a swing high here because the high of the next candle is lower. And so that makes this essentially a swing high right here. This is what a swing high would be. And then the next swing high is when we have this candle, the high of it is lower than this one. And so this essentially makes, if we simplify it, it looks like this. And so why it resets here is because this swing high is higher than this one. And so if we show another example of another swing high, the market then goes down and then it starts to go up, right? And then this makes another swing high here because this candle's high is lower than this one. So then that makes a swing high here and it starts to go down. Now this high, based on our count reset rules, it has to be higher than the previous high here to reset, and it's not. So the count does not reset here. So this keeps the count going. So this would be our first leg in the pullback, and then this would be in the pullback. This would be the start of our second leg. And then this second leg would only end when we had a higher high than this candle put in. So if we had a candle that looked like this, this would then be higher than this one, and the leg would then start to move up here, and that would make our two-legged pullback. And so with all this, we are never looking at anything but the highs of a candle in an uptrend. So let's go to a little bit more detailed of an example. So here, this is an uptrend. And so we have a very strong move. And so what we're looking at here is essentially this, looking at the highs, this is just one leg up. And then we have one candle. The next candle that forms, the high is actually lower than this one. And so that creates a swing high. And so from there, we start our leg down. And until the market makes a high that is higher than this one, the leg is going to continue down because we're counting the highs. And that is how our count is going to work. So let's say that the market then produces candles like this. So let's say the market continues to produce candles, and if we draw based on the highs here, this is all we have, is we have one move up. This is a high, so the count is new here because this swing high, we don't know that it's higher, but I'm just going to assume that and say that the count resets here because this is the highest high we have on the chart. And then it doesn't matter again what the candle bar is, where the lows are, the count is still, or the leg is still going down because the highs are still going down in a stair-step fashion. And then as soon as a higher high gets made, the leg direction is going to change. And so we're going to then start going up. And we don't know when the market is going to turn down again. We are just watching as the bars form. And so as the bars continue to form, again, we don't care if it's a red bar, if it's a green bar, we just care to watch the highs here. And all we're looking for is when a high is made that is lower than the previous one. And so here we have the next bar does that. And so this makes another swing high because essentially we have a high here that is put in, and then the next bar's high is lower than this one. And so that creates a swing high. And so then we start getting this kind of looking pattern here. And so this is our first leg of a pullback. This is our second leg. And this one doesn't reset the count because it's not higher than the previous swing high. It's lower. And then from there, the market then, let's say it continues to sell off. And then this is our formation of our second pullback in this pullback of an uptrend. And so here's our first leg, here's our second leg, here's the reset. And so this is when we would be potentially looking for a trade to get a two-legged pullback to the long side with the trend. And then as the market forms, it puts a higher high than the previous candle. And so it changes the leg direction. And then that signals the initiation of the two-legged pullback firing. And we would want to be in that potentially, right? Because this is our two-legged pullback we're looking for. Here's our first leg, here's our second leg, and this doesn't reset because it's a lower swing high than this one. And then the market decides to shoot up from there. And so as we shoot up above this high over here, we are going to say that, okay, as soon as the market pulls back and makes a lower high, we are going to say that this is making a swing high. And then we are going to just know that it's going to be higher than this one because the market has already made that high. And so as soon as it makes that pullback, which we have right here, we know that this swing high is higher than this one. And so that is going to reset the count. And so then it starts making a leg down. And this is a swing high because this only reason right here, this high of the next candle is lower than this one. We don't care about this candle being lower. That's how it works in our setups. And so let's actually go to almost an identical looking chart in terms of swings, but the candles are a little different. And so our previous example was a lot more easier to read. And now here, this is what a normal chart will look like a little bit more. It's going to be a lot more confusing with candles looking all different and wicks all over the place and the lows potentially being different. And so here in this leg up, we are only looking at the highs, right? And so even though this low here is lower than this one, that doesn't do anything for us in the pullbacks in an uptrend because we are only keeping track of the highs. And so as we're looking at the highs here, we are saying, okay, our leg is still moving up, 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 And then, okay, the next candle produces a lower high. And so boom, right here we have a swing high. And because let's just say the high, this is higher than the previous high, so this is going to reset the count. And then the leg starts moving down. We're only looking at the highs here. We don't care what the lows are doing if they're lower. And so here it's still going down, and then boom, this makes a higher high than this one. And so this is changing the direction of the leg. And so this is a one-legged pullback so far. And so here with this leg change direction, we don't care. This, you can see this low here actually continues lower. And so this candle, even though the low is lower than the previous candle right here, that doesn't matter at all for our counting the pullbacks in an uptrend direction. And so the leg direction still shifts this way on this candle, even though this low here is actually lower than this candle. And so from there, again, we're just looking at the highs and we're seeing as it keeps going up, and we're waiting for another swing high to initiate that second leg in our two-legged pullback scenario. And here it makes a lower high, and so this counts technically as a swing high because this high is lower than this one. But if we compare our swing high here to our previous swing high, it is lower than this one. And so it does not reset. And so we continue looking down at the highs, looking for when it shifts in direction. And so here, the leg direction now shifts because we now put a higher high than the previous candle. And so we keep our stair-step pattern up. And so here, the market then punches up all the way up here, and then makes a lower high here than this high right here. And so what does that do? That shows us that there is a swing high right here because we have this kind of looking setup right here. This high is lower than this one, making this a swing high or kind of a top. Now, if we compare this swing high to the previous swing high, it is higher. And so this resets the count. It is higher than this high, but we don't care about that. In our last example, the swing high here was lower than this one, and we still reset the count because we are comparing it to the previous swing high. We don't care about the highest swing high, we only care about the previous one. So here, the count resets, and here, the count resets because we are comparing it to the previous swing high. And so the reason why we reset the count is because in our strategy, based on the market rule of 2, we only want to be looking for our two-legged pullback setup right here. This is our first leg, this is our second leg, because our two-legged pullback, if we enter in right here, as it breaks up, initiating the finish of that second leg, that is our high probability setup. A first-legged pullback is not a high probability setup. And then let's say a third-legged pullback or anything beyond a third-legged pullback is not a high probability setup. The idea behind this strategy is that two-legged pullback is that sweet spot that we're looking for. And so that's why we only look for the two-legged pullback. You can have one-legged pullbacks that work fine. So like if you look at this trade, it did go up from there. But the idea is in the long run, the higher probability setup is that two-legged pullback that we want to be trading off of. So now let's jump over to a chart and actually look at two-legged pullbacks in an uptrend. So this is a really solid uptrend we have right here, and we are going to start counting the legs right here. We're going to say this is our swing high, and we're going to go from there counting the legs and the pullbacks and the resets. So I'm actually going to put this to the right of the chart so we can watch as each candle forms and go from there. And so right now, this is just a high, and so we're going to wait for the next candle to make a lower high to confirm a swing high. And so here, as we move forward, this candle's high here is one tick lower than this one, so it does make a swing high here. So right here, this green dot is going to represent our count resetting. And so we have a reset here, and we're just going to watch as the market makes lower highs, having that leg go down. And then once it makes a higher high, it's going to shift the leg direction. And so here, the leg makes a higher high, making this shift direction. And so if this starts to continue to produce higher highs, the leg is going to reset. Actually, it doesn't. So here we have a high. This makes a new swing high because the high here is lower than this one, but this swing high is lower than this one. And so we're not going to reset the count. So this is forming a two-legged pullback. And so all we have to do is wait to see if we get a trade out of that. And so here, this essentially forms here, pulls back and comes down here, and then this is a two-legged pullback. And so that then starts to shoot higher. And you can see this low here is lower than this one, but because the highs here keep shooting up, that's all we care about. We only care about watching the highs because we're looking at the pullbacks in an uptrend. And so here, because we're just shooting higher, we're going to assume that this is probably going to reset the next time it starts to pull back and makes a swing high. So here, this is a matching top, and so we're not going to reset the count here, but most likely it is going to start to reset here as soon as it makes a lower high. And so here it finally does make a lower high, and so we are going to then reset the count here. And so that is going to be our reset. And then going forwards, this starts to make lower highs. And so we have a one-legged pullback here. And then just watching the highs, seeing where the leg takes us, this shoots up right away. And so we're going to assume this is going to reset as soon as it makes a swing high, because it's going to make a swing high that is higher than this one. And so as we go forward, the high is still higher, so we're not resetting yet. We're still in that upwards leg. And then here, this makes a swing high because this high right here is lower than this high. And so we are going to reset the count now, right here. And then we're just looking at the highs. What are they going to do? Are they going to make a leg down or are they not? And so here, actually, it starts pushing higher. And so we have a leg up. And we'll see if this breaks higher and makes another reset. And so here it actually looks like it makes, this is another swing high because this high right here is lower than this one. And so actually what happens is these, if I draw a line right here, this is a matching high. And what we do on a matching high is we reset the count. And so from there, going forwards, we're just looking for what happens now. So here we're starting a leg down because we're looking at the highs. And then moving forwards, we're just waiting to see what it does in terms of producing legs. So here we now make a high. And so this is one leg down. And in terms of two-legged pullback, we want it to make another swing lower to produce a two-legged pullback. So this is a two-legged pullback. This makes a swing high, because this high is lower than this high, but this swing high is lower than this one, and so we don't reset the count. And then continuing forwards, this makes a two-legged pullback right here, and then makes a higher high here, and this looks like it'll probably reset as it makes a lower high on this next bar. So once this next bar happens, this high is lower than this one, and so that makes a swing high. And then this swing high is higher than the previous swing high here, so this resets the count as well. So we reset the count right here. And then we go forward, seeing what this does. We're making a leg down right now. And then we start to look like we're bouncing off the bottom of the trend line here. And so here we have one leg down confirmed, and then we start to make that attempt to go higher. And then moving forwards, we're still making that attempt higher. We have not made a swing lower yet. So here it looks like we might be topping out. And so here, this is a matching high in two candles, but that doesn't count as a reset. We want to see it separated like this. So there needs to be a swing lower and then another attempt for us to say that's a double top and we reset off of that. This is just two adjacent candles making a double top, and that does not count as a reset. So here, if we keep going, if we look right here, this makes a one-legged pullback, push higher. This is a swing high, but because it's a lower swing high than this one, it's not going to reset. And so here is our second leg in our two-legged pullback. And then this could be a possible point where you enter in on a two-legged pullback, and you can see here the market then starts to shoot up. So this high here is higher than this swing high, and so as soon as this turns, the next candle turns lower in terms of where the high is located, we are going to reset the count. And so this keeps going up, and so here actually this makes a lower high than this one, and so that's going to make a swing high, and this swing high here is higher than this swing high. So what we're going to do is we are going to reset the count off of that, and then we're just going to see what it does. And so it looks like we make a tiny little one-legged pullback here and then start making a higher high. And so this makes a swing high as we start to move down, and this swing high here is higher than this swing high. And so what we're going to do is we are going to reset the count based off of that. And then it starts making a pullback down. Just watching the highs here, this is a leg down because we have that stair-step fashion down. And then continuing on, we make a punch higher even more. And so we can assume because this high is higher than this swing high's high, as soon as this confirms a swing high, we're going to reset the count. So we're still making higher highs. We're not going to reset the count yet. And then here it looks like we might. And so here it does make a lower high than here. So that creates a swing high. And this swing high is higher than our previous swing high. So we are going to reset the count here. And so moving forwards, we actually make a tiny little leg down, and then it starts to make a leg up, and this high is actually higher than this one. So if it makes a swing high, we're going to assume that it resets the count. So it does. So this high here is lower than this one, so we make a swing high here, and it's lower than this swing high, so we're going to reset the count off of this. And so moving forwards, here we go, keep going. Looks like we make a leg down, and then this high is higher than this one, so it confirms this down leg. And then we continuing on, we make this is our high, we make a leg down, make a leg up, and then our second leg down. So this is a one-legged, two-legged pullback. And then here we have actually a green bar with a green arrow under it. And so this is actually a trade I took this day when we were actually trading. And so what I like about this trade is this is a very bullish bar, and we can assume that as soon as we break higher than this one, we are going to start that second leg. And because of how we place our stops, we enter above a bar. As soon as it breaks above that bar, we are going to make a second leg. So if we look at this two-legged pullback right here, we have a swing high, one leg down, and then it makes a little leg down right here. We place our stop above this candle because we assume that if the market breaks above this candle right here, it is going to confirm that second leg or that second attempt to go higher, and that's where we're going to want to be in the market. And so that's what we do when we enter. We'll get into entries a little bit more later, but I did want to talk about this here because this is a great example. And so if we have our order entry right above this bar, assuming that if on the next candle it breaks higher, it's going to complete that two-legged pullback, and it's going to start going up. And so that's why we enter one tick above the candle, is because that's how our leg confirmation happens. Every time it breaks above a high of the previous candle, it changes the leg direction. And so that's why we are only looking at the highs in an uptrend, is because of how we enter and how we count legs. And so if we move one candle forwards, you can see that here it broke above here and then started to go up, and this made a nice scalp as a trade. And so this is how our general strategy works, is we're looking for a two-legged pullback. We're by the EMA, we're kind of at the bottom of the channel. This bar is a nice green bar, and so that is when we place our stop order. We assume that, okay, we are going to get above this candle, and if we do, I want to be in the market. And so that's why you place your stop. And if we do get above it, we're going to complete our second pullback, and we're going to want to be in the market at that point. And so that is how this whole strategy works. And so from there, we just continue to start going up, and the market really takes off at this point. And so here, again, we have a higher high than this swing high right here. And so we're going to assume as soon as it makes a swing high, it is going to make the count reset. And so here, looks like it does. We have a lower high here, and so we are going to reset the count based off of that. And then we are going to continue actually higher from here. And so as soon as we make a lower high, we're going to get another reset, because here is going to be another swing high, which is higher than this guy, right? And so here, we're just going to reset the count, and we're just going to keep moving on. And so it looks like the market keeps going up. This right here does not count as a reset, because we just have two matching highs adjacent to each other. And so we're just going to keep the count going up because we have not made a lower high. And so here we actually have made a high that is lower than the previous one. So we're going to reset the count again. And then continuing on, looks like we're still going up. So when you're in an uptrend like this, and especially when the uptrend really just takes off, you're going to get counts that reset over and over and over, and you're just going to not get a two-legged pullback. And so when the market goes extremely just straight up like this without having any pullbacks for us to buy into, you kind of just have to sit on your hands. And that can be hard when you really want to get in the market and you see that the market is really going, and you're getting FOMO and you don't want to miss out. But based on our strategy, you have to. And if you are going to jump into this, that is going to increase your chance of losing, and that's not how we trade. And so don't do that, because that is going to cause you to lose money. Even though if you look back and said, oh, well, if I bought here, it would have been fine, because look, now we're all the way up here. That is not a good way to think about trading, because you don't know that's going to happen. So as we keep going up here, we're just looking for another reset. We have a little matching top here, but they're adjacent candles, so we don't reset yet. But we do make a lower high there, and so we do reset here. And so we can see that here, the market just keeps going up here. And so this can be frustrating when you're seeing the market do this and just keep going up. But again, we only need 2 to 3 trades a day, 4 trades a day. And so if you got one here, this is only half an hour to produce this. If you get a one trade every half an hour, you're done in 2 hours and you've made your profits for the day. And so here we have another swing high, or it's going to make another swing high. And so here we have that swing high confirmed. And so this swing high is higher than this previous one. And so we're going to reset again off of this. And then so here we're just looking at the legs. I'm kind of going quick now because all we're looking at is the highs in our pullback. And we have another swing high here. So again, you can just be sitting here on the sidelines of the market waiting. But you do want to be watching and waiting for that two-legged pullback, because as soon as you come back, the two-legged pullback, and hit the EMA or the bottom of the channel, you're going to want to get in, because here, as you see, as soon as it made a nice two-legged pullback with a good candle at the EMA and at the trend line, that was your only place to enter in, because after that, the market took off for, half an hour, 20 minutes, what we have so far, right? And so here, this is actually another two-legged pullback that happened. So here we have that swing high that we had that reset off of. And then we have another attempt to go higher here, but it makes a swing high, which is lower, so we don't reset the count. And then from there, we have a green bar at the EMA and off the midline. And so this is kind of an aggressive setup. Usually it's better to take off the bottom of the channel, but you can still take trades off the middle of the channel here when it's off the EMA and the trend is so strong like this. So here, this is another trade that I took, and you can see that here is the candle. It's a nice bullish candle. We always want that in our direction. And then we have, this is a very small two-legged pullback, but it still counts as a two-legged pullback. We don't need a lot of candles to make a leg. Again, based on our leg rules, we only need just to be watching the highs and how they change. And so this counts as an attempt higher, so that confirms our one leg. And then down again, we don't know that it's going to keep going lower here, But we are going to, based on this candle, we're going to say, okay, this is a good candle. If it does break above this, we know it is going to confirm that second leg. And at that point, we want to be in the trade. And so this is why we put a buy stop here, one tick above this candle, which would be right here. And then we just wait to see if it fills. And so then from there, it does, and we get a scalp out of the market and our trade, and the market just continues up, and we're done from there with that trade. And so then we wait for the market to produce another one of those. And so that's all you're doing in an uptrend, is you're waiting for the market to reset, make a two-legged pullback, buy the EMA, a good signal bar, and buy the channel if you have one, and then you just scalp from there. And then anytime you're just in this and far away from an EMA, you're not going to take a trade. And you're not going to take a one-legged pullback because you could get a scalp here. You're going to skip out on that, and you're going to wait for a two-legged pullback like this with the correct guidelines and checklists. And so later in the course, we will go over a checklist in a lot more detail, but this is kind of what you're looking for in the market. And so here we have, boom, from this trade, we go up higher highs here, and then boom, this high is lower. And so we have a swing high here, and then this swing high is actually higher than this swing high. And so we are going to reset the count. And then from there, we actually have a overshoot of the channel. So based on our overshoot rules, right, you can expect that we are going to start to change trend. And here we actually have another swing high. And so we're going to reset the count again and then continue on from there. And so I think I'm going to wrap it up here, but just to kind of zoom forwards and show you guys that we did start to change trend here. And so here you have, here's a one-legged pullback, two-legged pullback, and then we had a little swing high here. And so the count actually resets here as well. And so you could put it here, doesn't really matter. And then we start to move down here. And then we actually started to kind of break out in the trend change. So that's why as soon as you see that overshoot, you want to start to be cautious, because the trend is going to change there. And so here, just to zoom out, if you want to take a picture of this and kind of zoom in on it later, here's everything we looked at. And so here in this crazy uptrend, you can see the count resets a lot because you're looking at the highs, and in an uptrend, you're going to be making a lot of new highs, and so it's going to reset a lot. And so in this uptrend, in this move of 55 to 6 to 10 in 50-point move, of course, this day is a little more volatile than normal, but in this move, you're only taking 2 trades. But this move happened over 7 to 9, 2 hours. And so 2 trades in 2 hours, that's still not bad, especially if you're trading multiple contracts. And right now in this market, I was scalping for 2 points. And so that would be one contract, that would be $100 a trade. Now, if you still have questions after going through this video and the next video, don't hesitate to reach out to us, and definitely on the Discord in the mornings and active trading hours, Michael and I are in there, and don't hesitate to message us one-on-one in the Discord or message in any of the group channels about questions on this, because that is where you might have a really good breakthrough. I've had people message me, they were confused, and just with a couple sentences, I was able to clear things up for them. Sometimes all it is just the wording that is different and not working out. And so that is another really good resource you have at your fingertips to get tips and help with this kind of stuff. So horizontal support and resistance lines. These are just a lot like trend lines that are just drawn horizontally compared to with a trend. And so a big thing about these is understanding that every time the market makes a low or a high, that is a potentially support or resistance level. And so a really easy way to find solid examples of these is looking at extremes or where the market bottoms. And so here is a pretty good example of a horizontal support level. And so what we have here is a double bottom. And so that definitely makes a support level. And so what you want to be aware of when you see things like this is how it's going to affect the chart or the market as it touches that level again. And so what we want to look at here is, and what we want to do is when we see something like that, especially when you're starting out, you want to be drawing lines so you can keep track of these, because there are so many things to keep track of in the market. And if you don't have lines like this to help you visualize those, it can be hard to remember them, right? And so as soon as you see something like this, let's draw a support level, and you can see that once the market comes back and retests that level, it turns up and goes higher, right? And so this is that downwards trend we had earlier, right? And that trend break and then that retest. And so with this double bottom here, that kind of tells you another reason for the market to bottom there. Now, how we want to use these support and resistance lines is just understanding where the market is going to have trouble, either going up or down. And so how we can draw these is you can draw them off the lows, or you can draw them off the closes. Again, with just like the trend lines, it's about what fits best, because again, these are just visual aids for us, right? And so now over here where the market is a little more choppy, we might find some better horizontal support and resistance lines, right? And so again, what you're looking for is just where the market, either if you're drawing a support line, where the market bottoms multiple times. So what matches along that best. So we're just going to draw a line here and see where this fits better. And again, it doesn't matter that it fits perfectly. The biggest thing is all this line is telling us is we don't want to take a trade to the short side betting that it's going to break through this level, because we've seen the market bounce off this area multiple times. In the broad scheme of things, we're wanting to take the higher probability setups, and betting that it's going to break through this is going to decrease that win percentage. But on the flip side, taking a trade off of this support, that is actually going to be good for us, right? That's going to increase our chance of winning. And so for our actual trading, we want to be aware of these, because if we trade against and try and bet that the market's going to break through these levels, that is going to be a low probability setup. Again, we want those high probability setups. We want to be taking trades off of these levels, because those are going to be the chances where the market is more likely going to go in our favor. And again, that is going to be that high probability setup that we want. Now, in a more sideways channel like this, you can generally just make this and draw and drag it to the top here. And you can see that on the top there, we also kind of have a support or resistance level. Now, support and resistance levels, they can drag really far across the chart. You can have very large support and resistance levels and very short-term ones, kind of just like that overall broad channel for the day that we drew. Those work same for large support and resistance levels. And so you can see one thing here, just to show you that, is once the market broke out of this, it came, tapped it, and then took off. And again, once you break out of one of these channels, the trend is going to change. And so be aware of that. Just like our directional channels and trends, the sideways channels act the same. They are going to have a trend shift. Now, with how the market moves, there are support and resistance levels everywhere, right? Every new low it makes is a support level, and every new high it makes is a resistance level. And so what I mean by that is, if I just use this, is every time we make a lower high here, that is a resistance level. So you can just drag this level down here, right? Every time it makes one of these levels, these are resistance levels. And so as the market made a attempt higher here, that is a resistance level, right? And so as the market attempted to break through that again, it failed, and then it sold off from there. And so these are things to be aware of as the market is going on. These are levels you want to keep track of. And so these work on the other side too of this channel we have here. Every time you make a new low, that is going to be a support level. So as we can just drag this down, and you can see where it starts to match up. And so these areas in the chart start to become either support and a resistance. And so it's really something to be aware of, that, you know, this is kind of a little choppy area right here, and you don't necessarily want to take a trade to the short side, even though you're in a downtrend here, right? You don't want to necessarily take a trade through that support level, because it's possible that it fails and it reverses on you there. And so keep in mind that every time you make these lows, right, you are making those support or resistance levels. So here we have that double bottom we initially looked at. That became a support level. And then this high right here, this is going to be a resistance level. The market stopped here, came down, it broke through, kind of failed, and then broke through it. And so not everything is going to be a really solid support or resistance level. Each one of these new lows or new highs, those aren't solid support or resistance levels. The more times or the more touches you have, the better it's going to be. And so for this example right up here, we have a pretty solid sideways chop going on right here. And so this means that it'll be harder to break through these levels, but you see once that they do, the market can flush down pretty quickly. Now I want to pull up a more clear example here of just a really nice sideways channel. They're kind of hard to find in the market right now because we are in such a directional market, but a lot of the time you will have a very sideways market like this, and this is just a great sideways channel. You got multiple touches, right? And so other people are going to notice this. Other traders are going to notice this, right? And so there's a lot of traders out there they're called breakout traders, right? And so they'll see this sideways channel and they'll say, okay, we were in an uptrend here. I want to buy the breakout of this channel. If it breaks above here, well, we're gonna continue the trend, and I'm going to buy a bunch of shares, calls, or whatever they're trading, right, to the upside. And so this can be where the market actually reverses on those people and traps them. And so what will happen is all these breakout traders, they'll see it break up and they'll start to buy it. And then the market decides to actually reverse back into the channel and then slam through the other side of the channel. And so this is what happens a lot of the time, is because it's so hard for the market to break through one of the sides of the channel, it will use the momentum of trapped traders to do that in a big way. And so how that works is because imagine you bought up here with the idea that the market is going to shoot up. As you start to see it reverse on you, and then you start to see it reverse on you even more, and you start losing a lot on your position, you're going to start to sell. And what that does is put more pressure on the market before, and it causes it to have massive momentum that will push it through what this equilibrium level was before. And so that's what a sideways trend is. It's where the buyers and the sellers are at equilibrium. There is an even amount of people buying and an even amount of people selling, right? And so to break through one of these sides of the channel, you have to have an increase in one of those directions. And so quite often what will happen in the market is it'll pretend to make a break higher, and then it'll actually reverse in the other direction. And so this is another thing to keep in mind when trading and looking at actual sideways channels, is it will actually reverse. And then of course, once you see a trend break like this, assume that the channel is broken and that the trend is going to now change. Now, I definitely don't want that to come across as that's what always happens, because as you can see in this sideways channel right here, the market decides to just kind of puke out one direction, but that is a scenario that will happen quite often. Now, we'll get more into horizontal support and resistance later, but this is generally the idea of it. And so next we are actually going to talk about the EMA and how that affects our trades. So let's talk about chop. And so what I mean by chop is essentially just a really sideways trend where the market is just going back and forth and it really doesn't have a solid direction. And so you can have examples like this where it's back and forth a little bit, but it's still really congested. Or you can have examples like this where the market just has bars right next to each other. And in either of these examples, the biggest thing is just to stay away, because the market has no direction. We don't know a solid trend. Even though maybe here you can say, oh, well, the trend is up. We want to be staying out of these just because it is very easy for the market to flip against you very quickly, and you're not going to have a very good chance of having a higher win ratio if you trade in these kind of markets. Now, another reason to stay away from these is generally you are really close to resistance or support levels. Like over here, if you try to take a scalp here, there's a huge resistance line up here. And so you're not going to want to take a trade into that. And so that's a big thing as well, is keep in mind where the support and resistance levels are, because those you definitely don't want to trade into. And so that's why we really want to stay away from chop. Okay, so let's actually look at a more of a bigger chop range on a chart. And so this is, I went back a couple months because the market's really volatile right now because of coronavirus. And so it always has a direction. So it can be a lot easier to trade when the market has very strong trends in one direction. And so that pattern we've been looking at today a bunch is essentially the market's very trendy and it moves very quickly. And so that's not always going to be the case. This right here is, I think, pretty much a whole day's worth of data. And that is a lot more of a norm. Right now, when the coronavirus is wreaking havoc on the market, this is more like 30 minutes in the market. And so you got to be aware that that's not going to be the case all the time. If you're used to trading in a very quick and volatile market, be prepared for when the market might slow down and start to get back to the norm. And so when that happens, things are going to get a lot. Potentially, you're going to have days where they're going to just be choppy like this and very slow moving. And so how do you switch into that? And so the biggest key when switching to a market like this is you need to be a lot more disciplined about taking trades, and you need to be aware that you're not going to have very easy directional setups. And so this is when you want to be aware and be looking out for, well, oh, maybe we're in a sideways trend now here, right? And so you want to be trading based on those parameters. And so here, this is what normal moves in the market look like. Each of these horizontal lines is 1 point. And so that's what we're normally trading in. If we go to a chart of right now, this is, I think, a couple hours right now over the market. And so you can see there's a lot more candles over a shorter amount of time. And then the horizontal lines are very small. So these candles are huge. And so what you need to do is you need to be prepared for when the market makes changes like that. When the market is very volatile and fast like this, or when the market is very slow and methodical and choppy like what the market can be in a more slower market. And so how do we trade that? One thing is you need to be ready and to be able to adjust to that. And so it might cause you to start losing more than normal because you're gonna have to do a mental shift. And so what you want to do in these markets is be looking for sideways trends, to be seeing, okay, where is the support? Where is the market bouncing off of? And where is the market bouncing off of on the top end as well? And so all our setups are still going to be the exact same, but you're going to be trading them in a different fashion in terms of, instead of having a downtrend and you're trying to short off of this area, right? A sideways trend, you're going to be trying to go long off the bottom and then short off the top. And that's a lot different. And if you're not used to that, it's very weird. And so maybe if you've been live trading and you've been doing good for a while when the market's been trending, when you start to see days like this, maybe shift and go to a sim trade and practice and learn, because this is going to be a different type of market. Now, with these sideways trends, just like in an upwards trend, with these horizontal channels, we want to be trading at the extreme. So either selling from the highs or buying from the lows. You don't want to be trading in the middle. So even if you have a failed two-legged pullback or a two-legged pullback, right? If it's more in the middle of the channel, you can see with this trend midline right here, this can cause the market to either have support or it can cause resistance. And so what we want to do is we want to avoid trading in the center of the channel. And we want to be looking for opportunities at the lows and opportunities at the highs. Because those, again, going back to, we always want to just be trading when we have the highest chance of winning. And so those are the areas where you're going to have the higher win rate possibility. Now you can see here as well in terms of the EMA is going to be in the middle of the channel. And so it's going to be kind of counterintuitive or counter our rule before of if we're below the EMA, we want to short, right? In this instance, the EMA is always going to be in the center, and we're generally going to be buying back or selling back towards the EMA. And so in that regards, we want to be using the EMA in terms of we expect if we're really far away from the EMA, right, all the way down here, and we're at the lows of the channel, that's a more opportunity to use the EMA as expecting the market to go back to the EMA, and that's where you can get your scalp from. And so in a sideways market, expect prices to generally pull back to the EMA, and don't trade expecting the market to move away from the EMA. Expect it to move back to the EMA and be buying it off of the extremes. If you're unsure of a setup, it's better to just skip it and wait for that really strong setup that you know is going to work. So now let's get into the other side of things, counting legs and pullbacks in a downtrend. Again, for the simplicity's sake of things, when you're first starting out, just focus on doing the two-legged pullback strategy with the trend. So in the last video we did uptrend. Now we are going to be focusing on a downtrend and counting pullbacks and taking trades to the short side. So pullbacks in a downtrend, we count the lows for counting legs and pullbacks. So all we're looking at is the lows of the candles. We don't care about anything else. We don't care about the color. We don't care about the size of the body. We don't care about what the highs are doing. We just care about the lows. Now, a swing low is confirmed when the next candle has a higher low than the low of the previous candle. And so these are the exact same rules for the other side, but all we're doing is looking at the lows. In the last video for this slide, I did word this as slightly a bit differently, but it is going for the exact same outcome. All we're caring about is where the lows are, and if there's a low made and the next candle has a higher low, then it's going to count as a swing lower. And so essentially it's going to make something like this in a simplified drawing. Now, a count resets when a new swing low is made that is lower than the previous swing low. So here we have a swing low here, and then the market starts moving down again. And then we make a higher low than the previous candle. And so that creates a swing low. So we have a swing low here and then a swing low here. And because this swing low is lower than the previous swing low, then it is going to reset the count. Another example here is the market starts moving up at this point, and then we start pushing lower again. And so from that point, we're looking to see when it makes another swing or change in direction. And so the change in direction comes right here when this low is higher than this low. And so it makes that switch there. And so that creates a swing low because it has essentially made something looking like this. And so here are our swings. And again, all we're looking at is essentially these two lows in relation to each other. And because this low right here isn't lower than this low, the previous low, we are not going to reset the count. The count only resets when the low is lower than the previous low. If this low went all the way down here, this swing low here would have been lower than this one, and we would actually reset the count. But in this case, we do not. And so now let's jump over to a more detailed version of this. Again, here we have a big leg down. This is one continuous leg because we have that stair-step fashion. Every low is lower than the previous candle. And then we start making a change in direction of the lows. And so here, this new low that got printed is higher than this low, and so that counts as a swing low. And so this signals a swing low, and because this is the lowest low or lowest swing low on the chart so far, we are going to reset the count right here. And so where the count is going to be at 1 in counting pullbacks to the downside. And so from here, let's just say the market shoots up here. Again, we're looking at the lows. All these lows are higher than the previous low, so that's going to signal just a continuous up leg. And then as soon as the market breaks lower and has a lower low, that is a signal in change in direction. And so that's all we're looking at when we're looking at pullbacks in downtrend. We are looking at the lows. So think of in a downtrend, you look at the lows. In an uptrend, you look at the highs. And here, the market then just continues down. And again, we don't care about the color of the candle. We just care about the lows in relation to each other. And so all we're looking for is to signal a change in swing is a higher low to be printed. And so here, there is a higher low printed. And so this signals this to be a swing low. So that confirms this to be a swing low. And then let's compare this to this swing low over here. This swing low is higher than this swing low. So we're not going to reset the count. For our swing lows, we need them to be going lower to reset. And so this is not going to reset the count. So in our downtrend, we currently have a one-legged pullback. And then now we just started our second leg in our two-legged pullback. And so from here, then the market is going to shoot up from here. And then to initiate our second attempt to go lower and kind of where we want to enter for our two-legged pullback is when it starts to make a lower low than the previous candle. And so here, that's what happens, is the market then makes a lower low. And so that changes the direction of the market and makes a leg in this direction. And then the market continues down from there. And so now we have a leg all the way down here, and we're just looking at the lows again. Because each low is lower than the previous, that is one continuous leg. It only changes when we have a change in the relationship of the lows to the previous candle. So here, because this low is lower than this one, we get a swing low here and a change in direction of the leg. And then this candle here, we don't care about what this candle is in terms of counting the swing low here. This just is continuation of the leg that continues up this direction. And then now we have this swing low confirmed because of this candle. We can then see, does it reset here? And so here we want to confirm this swing low to the previous swing low here. And so it is lower than this previous swing low. And so it then resets the count. We don't care about this swing low. We care about the most recent swing low in relation. So everything is in relation to the most previous thing. So in terms of a swing low, the lows are in relation to the most previous candle. And in terms of resetting, the swing lows are always in relation to the most recent swing low. And so now this is again a more simplified looking chart because of the candles. Now let's jump into a similar chart that is the same thing, but because the candles are all over the place, it's a lot more confusing in counting the legs. So here, starting up here, again, we're just looking at the lows. You can see I have some of these highs are higher than the previous candle's high, but we don't care about that because we're counting the lows and the pullbacks from the downside in our downtrend right now. And so we don't care about the highs of the candle. We only care about the lows and the fact that they're making this stair-stepping pattern. And so here, when it makes a higher low here, in relation to this one here, this is going to signal a swing low. And because this is the lowest swing low that we have on our chart right here, this is going to count as a reset. So we're going to reset the count here and start the count off fresh from this swing low. And then we're just going to be watching the lows here as they keep going higher. And so here, these highs are all over the place, and we don't care about that. We just care about what the lows are doing. So we're making the stair step up. Now we make a lower low here, and so that changes the direction of the leg. So we have a one-legged pullback here, and then we start going down again. And then here's more lows, lower lows, and then we go up here. And so that creates another swing low here because the relationship of this candle to the previous low. And so then here's the swing low. Let's compare it to this swing low, the previous swing low, if there's going to be a reset. Because this swing low is higher than this swing low, we do not reset the count. And then from there, so that means this is one-legged pullback, and then this is starting our second leg of the two-legged pullback in our downtrend. And so here we're just looking at the lows. They keep going up. Now they start going down. And so here we start that leg. And so this would be essentially that second attempt to go lower. And so this is kind of the area you would want to be getting into the trade. Now we're not going to go into specifics on entering the trade right now, but this is kind of, that is the area of where you want to enter in on your two-legged pullback. And then again, we're just watching the lows as this goes down. And so this is all we care about in a down leg. We don't care about what the highs of the candles here are doing. We just care about the lows here. And so that's why we can kind of just draw a very straight line like this, because the lows are making that kind of relationship to each other. And then so here we have, it starts going higher here. And so this is another swing low. And so if we compare this swing low to the previous swing low, it is lower than this one. And so we're going to reset the count. And we don't care about this low. Even though this swing low right here is actually lower than this swing low, we still reset the count right here because we are comparing it to the most previous swing low. We are always comparing to the most previous swing low or the most previous candle to determine a swing low. So now let's switch over to a chart. And just like last time, we are going to look at the lows, the resets, the pullbacks, and look at some two-legged pullback trades that we would potentially take in a downtrend. And so here, I've already got a channel drawn, and this is where we're going to reset the count. So this is a swing low here, and we have that confirmed because this, the low of the next candle is higher than this low we had. So this is making our swing low. And so from there, we're just going to keep printing candles and seeing how our legs work out. And so here, this starts to make a directional change. It makes a lower low here. And so this is our one leg of our pullback. And then we're just going to keep going and seeing if it produces us a second leg. So it looks like we just keep going down. So even though these candles are kind of all over the place, we're just looking at the lows here. So let me actually zoom in a bit more. So we're just looking at the lows here, and it's still going down. So this is one continuous leg right here. Still, even though there's this weird doji all over the place, it is one leg. And now actually, if we pulled back there, that would have been a matching low. But we're still continuing down. And so this is because we're going down and we have started to make lower lows, we're going to assume that the count is going to reset. Because once it pulls back, this will be lower and a lower swing low than the previous swing low. And so here we are still pulling down. The market looks like it's just selling off really hard here. And so here we actually do have a low and then a higher low. So this is the only point that the count actually resets here, because here is, we have a swing, and then comparing this swing low to this swing low, it is lower. And so we're going to reset here. And then the markets, we're just going to, again, we're still just looking for two-legged pullbacks. And so here we have one pullback, start going down. And then market's still going down. We have a swing here actually. So here's a low, here's a higher low. So this confirms a swing. Comparing this swing to this one, it is higher. So we're not going to reset the count. And then so here, the next candle, we are going to want to be looking for a two-legged pullback, right? Because we just made a reset here, and now we have two legs up. So here's one, here's two. And so this is where in a downtrend, we're looking for a two-legged pullback. And so what we're looking for again is kind of by the EMA, by the trend line, a good bearish bar. Again, we'll go into more detail in this in the actual guidelines checklist, but this kind of checks the box for a lot of things. And so to enter, we are going to put a sell stop one tick below this bar, assuming that if it breaks lower, it's going to initiate the change or the finish of that two-legged pullback, and it will start that move down. And so we don't know that's going to happen, but we have to anticipate of that happening, because as soon as it breaks lower, it's going to make a lower low and it's going to initiate that leg. And so here, if we put a sell stop here, we are going to wait for the market to break below that on the next candle, because that's, if it does that, we want to be in the trade. If we just print the next candle, it actually doesn't break lower. And so I think this is a really good example I wanted to show. This is a spot that if it broke lower, this would have been a really good entry because of the signal bar and just how this setup looks. Now, because the next candle actually never broke lower, it just matched that and then started to go up. This is not a trade you would actually be in, because you only get in a trade when it breaks lower and it actually fills your buy order or your sell order when it breaks lower. And because it didn't break lower, we actually wouldn't be in the trade. And so if you see this happen, you have your order here, this next candle forms and it's green like this, you cancel your order and you wait for another signal bar to form. And so this is a big thing that happens when we're teaching and showing charts kind of previously after they have already happened. In real time, you are seeing a candle like this and putting a sell order here and waiting for it to happen. And then when it doesn't happen, you cancel that order, because again, we don't know when these legs and directional changes are going to happen. We are only anticipating when it is going to happen and trying to prepare for that. And so here, the market then just continues higher. We're again looking at the lows. So here, the two-legged pullback is still going up. And so we're waiting for that initiation to go down. And so here it does end up going down. And so this bar is kind of a doji. And so this is actually a trade you would skip on based on our signal bar rules. But that's just how things happen. This would have been a great bar to enter on if it did initiate. But this is what ends up happening in the market sometimes, is it gives you possible places to enter and it doesn't actually put you into the trade. And so that's okay, because we are just trying to get in the market at times, and when it doesn't happen and we cancel our order, that's okay. The trade didn't actually initiate when we wanted it to. Now back to our counting the legs, we have a two-legged pullback here, and then it starts another leg down. And it looks like we're breaking lower than this previous swing low, so we'll probably make a reset on our count. And so here we do. So here, this is a swing low because this low is lower than this low. And then comparing this swing low to this swing low, we are going to reset the count. So here, let's just reset the count there. And then we keep going down. And so here, this was kind of a quick one-legged pullback, and then we started making lower lows here. And then the market actually here, we make a lower swing low, and that's because these lows in relation to each other, this low is higher than this low, and so that makes a swing low. And then this swing low compared to the previous swing low is lower, and so we're going to reset again. And so this can kind of be frustrating sometimes when you have a two-legged pullback like this that kind of checks off everything in the list and then doesn't work out. But that's just based on our rule guidelines. We need to follow them because that will keep you out of some losing trades. Maybe in this example it would work if you just jumped in, but sometimes it won't. And so that's the idea of our trade entry guidelines, is that it keeps you out of those sticky situations. And so going forwards in the market, we have another low here with a higher low to the right of it. And so that's going to make a swing low. And then comparing it to the previous swing low right here, it's lower than it. So we're going to reset the count based off of that. And again, because we're in this downtrend, we're only going to be looking at two-legged pullbacks to the downside. And just kind of like our last example, sometimes you will just get reset after reset because the trend will be so strong. And so we just have to skip out on that and wait. And so here, this is another swing low because of this low here is higher than this one. And so this swing low here is lower than this one. And so we're going to reset again based off of that. And then so here looks like maybe we're punching higher, And hopefully the idea is while you're seeing this, you're just hoping that it comes back up to the trend line and the EMA to actually get in. And so here it looks like this is another swing low made because this low is higher than this one, but this swing low is not lower than this one. So we're not actually going to reset the count here, but this is a one-legged pullback and a two-legged pullback. And so you can see I have a red arrow here, and so this is a trade I did take. And so just quickly walking through that is we have our two-legged pullback. We are bouncing right off the EMA, and we're kind of close to the trend line. We're still in a great downtrend, and so this is our bread and butter setup that we're looking for. And so we're just going to put a sell stop right below this bar and assume that if it breaks lower, it's going to initiate that two-legged pullback and start that next leg down. And so like this bar over here, maybe we won't get filled, but we're just anticipating that that's going to happen. And so moving forwards, you can see we did get filled. The market did break lower here and then actually formed a green bar. And so this can be kind of scary sometimes in a trade, but this is still an entry. This is still a two-legged pullback, and it did make a lower low here. And so it started our trade and it put us in the market. But sometimes right away, a trade will pull back and make you down on the trade right away. But that's why we have our stop above the signal bar. And so here, thankfully, the trade did go in our favor and it shot down at this point and it filled our scalp right here. And then we just, again, we're happy we made a trade. We're just looking for more swing lows, resets, and two-legged pullbacks. So here, this is a swing low, and this swing low is lower than this one. And so we're going to reset the count off of that. And so again, we're just looking for the lows because we're in a downtrend, and looks like now we just shoot down really quickly here. This is a little matching low here adjacent, but that's not going to reset it. Every low here keeps going down, and so this is a continuous leg down. And then we're going to wait for it to make a higher low to reset the count. And so here it looks like it actually does. This low right here is higher than this one, so we're going to reset off of this guy. And the market looks like it decides to shoot up here and actually break out. And so here, this is one continuous leg up because we're looking at the lows. And then we have a shift here because this low is lower than this guy. And then we have a shift down and then a shift up. This low is higher than this one, so we have a swing low here. And comparing it to this one, it is not lower, so we're not going to reset the count. And then punching up higher here. This is a larger two-legged pullback. You can see now we went up and we started to go down. So you can see here's one leg and two leg. So this is still a two-legged pullback. You can have two-legged pullbacks like this, where it's very tiny, or you can have large ones like this. And so from there, we started moving forwards. Now, if you have any questions on why this is a two-legged pullback with a nice bar, if you come back and look at this example, there's a little matching low right here, which isn't good to try and trade into. And then also you're kind of going right into the EMA. And so that's why I stayed away from this trade. Now going forwards, if we look at counts, here is another swing low. We just zoom right here. Here's another swing low here. So this low right here is higher than this one. So we're going to make a swing low there. But in relation to the previous swing low, it's actually not lower. So this is a third-legged pullback in our pullback scenario right here. And so then we actually make another swing low. And so this is not lower than this one. And so this is 4 legs now in our pullbacks. And then the market just keeps going up. So this is kind of when the market gets choppy. You want to avoid this. And then here we have another swing low. And in relation to this one, it's not lower. And so it's not going to reset. So even though we have this low is lower than this one, and we have a swing low here, in relation to the previous low, it's not lower. So we're not going to change the count. So this is kind of when you want to start avoiding things. And this, we don't want to trade in this because this is a lot of legs and it starts to get choppy. And you can see the EMA is flat, and so that helps you stay away from taking trades. And now here you can see we broke down out of this little trend line here. You can draw this as like a little support line. So we break out of that. And then here, finally, we make a new swing low to reset. And so when it's like this, you kind of just sit there and wait for it to make a new low like we have here. And then you're like, okay, now it's going to reset as soon as it makes a higher low. So now we have a swing low. And comparing it to this swing low, we can finally reset the count because it is a lower swing low. And then the market starts to shoot up. Here we have a lower low. And so this is actually going to be a swing low. And so this is another very quick two-legged pullback. So here's one leg, here's two legs. And because we're in an overall downtrend, we're going to be looking for shorts, right? And so we're looking for a two-legged pullback here. And now we have this little support line. And you see, like I've said before, is when you break through a support line, it can turn into resistance. So you can see the market broke through it, sold off, and then now has come up to it and sold off again. So the idea is this support line has now turned into a resistance line. And then we have a two-legged pullback right into it, a very nice bearish bar here. And so you can see I have a little red marker here. This is a trade I took. And so this is what we're looking for. We're at the EMA. We're kind of right off of a resistance line. And so we're going to assume we're going to put a sell stop order here. And as soon as it breaks below this, we're going to be in a trade because it's going to initiate that two-legged pullback and that second attempt to go lower. So from here, zooming forwards, you can see that right here, it didn't work. And then after that, it did enter in. And so this is definitely a little bit of a weird setup because this candle right here next to it did actually fully complete before you were entered. But because this candle as well is so bearish, it's still okay to stay there and try and enter. Now, I wouldn't recommend doing that very often, but I do want to be transparent, and this was a trade I took. And because I felt it was okay to stay in it, thankfully it still worked out in my favor, and the market just, as you can see, kind of sold off from there. And then all the way down here is a new swing low, and then we reset the count off of down here. So then the market kind of just crumbles from there. There weren't any setups from there at that point. But so here is our trend zoomed out and the potential really solid two-legged pullbacks. Now these last two videos have kind of talked about a few things we haven't gone over to. So definitely once you've gone through the course, maybe come back and look at these because there are some really good examples in here. And once you kind of go through a few other things in the course, some of the stuff I talk about in here might make sense, but it did make more sense to have these two videos right here in the leg counting section. Now, again, if this stuff is still confusing once you've got through the course, leave questions below this video, make a comment in the course Facebook group, or reach out to us on the Discord channel during the live trading hours, and we will be happy to help you figure how to count legs out, because this is the fundamentals of the strategy, and if you can't count legs, it's going to be really hard to move forwards with learning the strategy. So now what I'm going to do is I'm going to go through the chart and find a bunch of really good looking examples so you know what a near perfect setup looks like. So you start to get that muscle memory or that picture of what you should be looking for when you're trying to trade. So there is no gray area of what a really good looking setup is compared to a bad setup. Now, as I go through these, there will probably be setups on the chart that I won't talk about, and that doesn't mean that they're bad setups in any means. It's just these are the ones I decided to pick as I was quickly scrolling through the chart. Now, how we're going to do this is I'm going to label the signal bar or the bar that's signaling our entry with an up arrow or a red down arrow. And so for here in this section, I'm going to only be talking about two-legged pullbacks, either to the long side or to the short side. And then we're going to go through our entry checklist. So here, this is our first two-legged pullback. What we're going to do first, of course, is where's the trend? We're in an uptrend just based on looking at the EMA. It looks like we made a high and then a little downtrend, and now we're in an uptrend again. And then zooming in on this, we want to then also look at where is the EMA. We're right at the EMA, so that is really good for our setup as well. And then the next thing is we have our two-legged pullback. Here's our first leg, here's our second leg. Our signal bar looks really solid. It broke below the previous bar by 1 tick, which is just good for the signal bar to do. And then it closes up pretty much at the highs and above the EMA. So that is a really good signal bar. It's above the EMA. And then of course we just put our buy stop above this. And where's resistance for this? Resistance is really high up here. So this is a really solid two-legged pullback. And here, another thing that makes this almost even better as well is this low here is higher than this low here. And so that's another thing that makes a two-legged pullback even a stronger setup. It's okay if a two-legged pullback comes down here, but if it's a higher low, that's still a better setup. So here we have our next setup. We can pretty easily see the trend is up right now. And zooming in on this, next thing is we are right off the EMA right here, which is really solid. And then our setup here is a two-legged pullback. And so there is our two-legged pullback. Here is our signal bar. Our signal bar looks really solid. It opened here, bounced off the EMA, and then closed pretty close to the highs. And then from there, our resistance, we have plenty of room to the resistance. And then so from there, our trade just shoots off from there. So this is another very clean looking two-legged pullback to the long side. So here's our next setup. We seem to be in a pretty solid upwards channel. There was a tiny bit of an overshoot here, but it did seem to start respecting the channel again. So I think that's okay to still use that channel. And then zooming in here on this setup, we have the EMA. It's bouncing right off the EMA. It's bouncing right off the bottom of the channel here. And then our setup here is from the highs, a two-legged pullback. And then our signal bar is still, it's not a amazing signal bar, but I would say in my book, it is still a good enough signal bar. It is a doji, but again, going into how the doji formed is it probably formed something like this, right? It opened, broke a tiny bit higher, sold off, and then came back. So it's still a reversal bar. And so I think that still warrants for a trade. And so entering it up here, there would have been a tiny bit of movement against you initially, and then it would have taken off in your favor. So this is still a pretty solid looking setup. So here we have an interesting example. Here we have a channel up, but we do have an overshoot. And so with that overshoot, we are going to expect to come down to the bottom of the channel and then potentially look to retest the highs or make a new extreme before potentially changing trend, right? And so what we're going to look for is we are going to look for a setup to the long side. And what we have here is we have a two-legged pullback. It's a little different than I think what we're normally used to seeing, but it still is a two-legged pullback. We're off right off the EMA, so we're good there. And then our setup is a two-legged pullback to the long side. Our signal bar is good, pretty much opened, sold off, and then closed at the high. So that is a good reversal candle right there. And then resistance and support. All these lines I have right here for all these examples are going to be 1 point. And so we would be entering right here and going for about right here. So we are just in amount of room for a 1 point scalp there. And so that is a setup that you can take. Now it does barely fill you, but it still gets there. And so that is another good two-legged pullback example. Now here is an example to the short side on a two-legged pullback. I think I recognize this from one of our entry examples. So here, not really exactly sure where the trend is on this one. Sometimes you might have the trend like this. So the trend isn't super clear, but overall you have a solid downtrend. So there might be maybe a channel like this that you can draw off of. And so that's not a bad representation of where we are. And so here, zooming in on this, Again, looking at where we are compared to the EMA, we are right at the EMA, which is great. We have a two-legged pullback right here. And then our signal bar is nice and bearish. And then compared to where we are from resistance is this 1 point scalp, we would scalp out right here. So even if this is potentially going to be resistance, we have room to that. And really the resistance would be down here at the low that we would be really worried about. And so this does get enough movement to fill. And so that is a really solid two-legged pullback to the short side. So here is another two-legged pullback to the short side. We have a really solid downtrend channel at this point, which we would have been able to draw matching here. And then so it would have been confirmed by here. And then really once you saw these lows too, it would have been confirmed. So you would have had this line here by the time the market came up and hit this area. And then what we have is a two-legged pullback right here. It's kind of a short one. And so this is definitely a little far from the EMA. But I would say it still is a good setup in terms of it came up to the EMA, bounced off. It's a really bearish signal bar, which is really good. And then compared to where the resistance is, you do have room to scalp out. And so sometimes why you can take entries a little far from the EMA is when the market is being extremely aggressive. And so here, all of a sudden, this was, if we look at the time, this was the market open and the market started to sell off really hard. And so when it has momentum like that, you can be a little more aggressive in your setups, but you still want a really near perfect setup. And so this is still a near perfect setup. I would say the only thing with it that is maybe stretching the limits is that it is a little far from the EMA, but everything is still really solid in terms of the setup, where it is compared to the EMA in terms of touching. And then it's right off that trend line. The signal bar is really strong and it's got room to the resistance. And so, and it's got room to the support. And so when you try and bend the rules on the entry checklist, make sure you are doing it very, very conservatively, and really don't do that until you have a really good grasp of the overall strategy. When you're first starting out, you're going to want to play it safe when it comes to taking trades. And then once you start to understand more and more, then you will start to potentially see places where you can be more aggressive. So here's a nice example to the short side again. We have a downtrend. We're right off the channel here. We can kind of confirm it once we see this here and then this, it hit there as well. And so when we see this, first we have a good downtrend. We're right at the resistance line of the channel. The EMA is pretty much right where the price is trading. And then the setup is a two-legged pullback right here. And then our signal bar is essentially it looks like it's a double top here, which is really good as well. That's kind of another little thing that can sometimes make a trade even better. And then the signal bar is really bearish and it breaks below the EMA. So we're opening into the trade below the EMA. So we want to just put a buy stop right there and hope that the market goes short from there. And so that's a really solid setup. And we have plenty of room to resistance down here or even potential to the bottom of the channel. So hopefully this is starting to paint a picture of what a really solid setup looks like. You're always wanting to have a very clear idea of where the trend is. You have a confirmation essentially off of the trend line. You're pretty much trading at the EMA. The signal bar is always very strong in your favor. You have plenty of room to wherever support or resistance is, and you are trading on the right side of the EMA. And then of course you always are wanting to have a setup like a two-legged pullback, because if you're trying to enter in some weird setup without that, you're not gonna have a really strong probability of winning. So a good example right here is if you took this two-legged pullback right here, you have a low, here's your two-legged pullback, and there is a nice little double top here. You're off the EMA, right? You've just started to make what looks like probably a downtrend if we zoom out here a little bit, but you don't really have a strong confirmed downtrend. And so that's what can get you into trouble, is if you just start taking any two-legged pullback that you see that's close to the EMA that has, this signal bar isn't great, right? This is pretty much doji. Even if it was a bearish bar here, it would still not be a really strong setup to take because you haven't really got a good picture of where the market is going, right? At this point, if we look at this trade right over here, kind of when there's no data, that's a really solid looking setup because you can see you have this trend line. It's pretty clear that you're starting to make a reversal here. And then you have a really good bearish looking signal bar and a really good room to the resistance or support, and just everything is aligned here. And so that's what happens if you start taking setups where things aren't essentially near perfect, and that causes you to end up pretty much start losing trades, and it will eat away at your win percentage. And if we go back to the introduction, right, when we looked at the win rates to potential income, all you need is sometimes a 5% increase in win rate to make a huge difference in your income overall. And what makes that difference is avoiding setups like this and only taking setups like this. So the only indicator we actually use is the 21 exponential moving average. And so why do we use the 21 EMA? And so this is because so many actual traders out there already use the 21 exponential moving average. And so that's going to give the 21 exponential moving average more weight to it. And so it's going to allow us to use it as support and resistance and a guide with our trading because everyone else is already using it as well. And so first, the EMA is a great way to identify the trend, right? It's just a nice line that tells you if it's going up, the trend's probably up. And if it's sideways, the trend is probably sideways. As well, the EMA acts like support or resistance. So if we're in an upwards trend, the EMA is probably going to be acting as support as it averages up with the price. Quite often the price, you will see it come and bounce off the EMA. Next thing is the EMA acts like gravity. Price always wants to come back to the EMA. And so because of that, what we want to do is we want to only take trades when the market is actually at the EMA because that increases our chance of being profitable. We don't want to be taking a trade when the price is so high away from the EMA because as price gets farther and farther away from the EMA, it's more and more likely that it comes back to the EMA. That is why we want to be taking trades as close to the EMA as possible. And so in cases where there is a good looking trade far away from the EMA, we never take it because there is that increase in chance likelihood that the market is going to come back towards the EMA. Now, another thing is don't bet on price breaking the EMA. If the trend is starting to shift and price comes below the EMA, don't bet on it breaking through the EMA. That is also because you're betting on it essentially breaking through that resistance now. Because if you're below the EMA, price is usually going to have trouble breaking through the EMA. And again, on the flip side, if you're above the EMA, price is usually going to bounce off the EMA. And so we always want to be trading with the EMA in our favor. It is just another thing that is going to increase our win percentage. And so here is an actual chart example. Again, you can see just the basic. Here's the EMA. You can see we're in an uptrend. As it shifts to a sideways trend, the EMA is flat. And then as we shift to a downtrend, the EMA is down. So that is a super easy way to identify the trend if you're unsure. And then again, another thing is if you're far away from the EMA, right? Like in this area right here where the market is really far from the EMA, we don't want to take a trade because it's more likely it's going to come back. We want to be taking trades when we are at the EMA or when we have bounced off the EMA. Those are always the best trades. And even in a downtrend, the best trades are closer when we have tapped the EMA, because there is essentially more wiggle room for the chart to move, right? We want to have room for the trade to move in our favor before it comes back to the EMA. If we buy up here, right, you could still be right. There could always be a trade that could still work here. But again, it's about probabilities, and over the long term, does it work every time or almost all the time, right? And taking a trade up here, that is not going to work as often as taking a trade down here. Now that's pretty much how to use the EMA. And now we're going to shift into actually talking about what is a leg and pretty much our strategy basics and what those three kind of setups are that we look for. Now let's talk about lower highs and higher lows. Now these are a little trickier to find perfect examples of, because generally I would say this is definitely a more aggressive kind of a setup. And so when you are first learning and starting out, this might be one I would suggest skipping on, because the two-legged pullback and the failed two-legged pullback, those are really the solid setups and a lot harder to potentially mess up on. And so the lower high and the higher low might give you a little more trouble, because in a way it's kind of a one-legged pullback. And so it's really hard to differentiate when you should take them and when you shouldn't. But now talking about the higher low and the lower high, what they are really good for is when you weren't able to take a two-legged pullback or a failed two-legged pullback. And so an example right here is, first off, right, our trend is a really solid uptrend to the upside. And then let's just look at this pullback right here, right? You would want to try and enter in right at this trend line. But as you can see, there is at least a one-legged, two-legged, three-legged pullback. That's where this trade wouldn't have worked. I think this is also a pullback right here. And so this wasn't a good, you weren't able to get a setup right here. And so that's one nice thing, that lower highs, or what we have right here is a higher low. What that gives us is another way to get in on the market moving in case a setup wasn't made at a really key entry point. And so walking through this is essentially, we're just looking for that continuation. The market sold off, it bounced and really confirmed our trend line off the EMA. And then our lower high is essentially, it's just like a little pullback here. And then it's pretty close to the EMA. It is a little extended, but it has already broken above this resistance over here. And so that is a really good indicator for that. And because our trend is a really strong uptrend, we can assume that it is going to keep pushing higher there. So it is, I do like going for a scalp right there. This is, again, a little bit more of an aggressive entry style compared to trading a two-legged pullback, because this is, a lot of times this can be a bit of a breakout pattern, but you can find lower highs that are more down here. It would have been a more perfect setup if it was actually down here. And so hopefully I will find some of those going through this. So here we have our next example. We kind of have a choppy trend. We kind of were going down. Now we're kind of going up, and then we see a trend break here, a new extreme, and then it starts to break out of the channel. So we can expect there to be a potential trend shift here. And so just analyzing what's going on, here's an extreme. We have a two-legged pullback here that failed, and then a third-legged pullback and a fourth-legged pullback. But what we're really looking at is, here is a low, a two-legged pullback to the short side, and then it sells off from there and then pulls back again, making a lower high. And so that's what we are going to look to go short off of. We have a little double top here, which is really nice, and we're right off the EMA. We have a really good bearish looking bar for our signal bar. We have pretty good room to the bottom. If we draw a little channel here, it looks like we can pretty much confirm it off the top here and then match it here. So we have room to the bottom of the channel. If we entered right here, we have room to scalp out as well. So that pretty much matches everything in our trading setup. And so this is a pretty good example of a lower high. And again, this is a more aggressive entry, but it is a way to get in on a trade if you weren't, either you missed a two-legged pullback before or a failed two-legged pullback, or it just didn't give you a good setup and you kind of had to wait. And so when you miss out on a two-legged pullback, remember that there could be a lower high or a higher low that might set up that will still allow you to get in. So don't just jump in on a bad looking entry because you fear that you're going to miss out. There might be a potential lower high that is going to get you in on the move. Now, I do want to point out this lower high right here. We have kind of some congestion here. It breaks out and then starts trending up. And then we have a little lower high right here. We have a really good bar. It's kind of far from the EMA. Now, you can see that this setup here worked, right? But I don't like taking lower highs like this. I think that's a little too aggressive. Once you see the market move up for a decent amount of candles, I think it is not worth it to take a lower high. You want the lower high to be pretty quick right after the two-legged pullback. You want it to have gone up, done a two-legged pullback or a three-legged pullback, and then make that lower high. You don't want the market to have already started making its move and then be entering up here. That is kind of asking to have a trade fail on you, because just think about it, the market is going to want to pull back at some point, and the longer you have had a move in one direction, kind of like the longer you are away from the EMA, the longer you've had a move in one direction, the more likely it is you are going to have a pullback. And so it does work out sometimes when the trend just decides to go straight up like this, but you don't want to bet on trends doing that. We're not really betting on trends going up like this. And so quite often with our strategy and how our entry checklist works, moves like this, we pretty much miss out on them because we are only looking to take trades near the EMA after the market has made a move and then had a pullback, because that is where the higher probability setups actually exist. Trades out here can work, but the probability of winning is a lot lower, and so that's why we skip out on those. So here is another example of a higher low. It looks like the market has come down and then gone into a spike in channel here, which we can pretty much confirm off of here and then off of these lows as well. There's actually a two-legged pullback right here as well that looks really solid, and then the market then just makes a higher low right here. And what looks good about this setup is the fact that it's close to the EMA, it's pretty close to the bottom of the channel, and the fact that we are in a uptrend, we can assume that it is going to continue higher here. Now, I have gone into more of a volatile market just because it's a little easier to find higher lows there, but this is still what a solid looking higher low will look like. So here is another example of a pretty decent looking lower high. What we have is kind of a choppy market starting to go in a downtrend, and we have a channel we can pretty much confirm off of the highs here and the lows here. And then here is our possible short off of. And so what's going on here is we have a high, we just have a two-legged pullback here, and then this is kind of a third-legged pullback. And from the lows, it's kind of just a one-legged pullback. And so what's going on is there was a failed two-legged pullback right here. And then the market kind of just starts to, it doesn't really give you any other setup other than just this lower high right here. And so what this lower high is and why I like this is because we have a channel we're right next to, we're right at the EMA. There's a good bearish bar. We have room to the resistance. The overall trend right now is down, and our signal bar is solid. And so it pretty much matches up with everything. It is a little bit more of an aggressive entry, and that's how these generally work. It's pretty hard to find a setup where they look perfect with that initial two-legged pullback and then the higher low right there, or on the flip side, that two-legged pullback and then the lower high right there. But that is what we're looking for, but sometimes it can come in kind of a weird form. And so in this instance, we are looking at a failed two-legged pullback here, which is this guy right here. It fails and then it makes a lower high. And so that's what we're shorting off of. A lot of the times a lower high or a higher low ends up actually being a failed two-legged pullback. And so that's why I'm kind of struggling to find a lot of clear examples, either because they turned into failed two-legged pullbacks or because they are a little too aggressive, and I don't want to be showing super aggressive examples. So now let's get into traps and failed two-legged pullbacks. And so the whole idea of these is they are, of course, always with the overall trend, and they are a two-legged pullback to the wrong direction that has started to fail. And so what we have is we have an overall downtrend, right? And then it starts to make a pullback in the upwards direction, and then that pullback has a two-legged pullback. And then once it makes that attempt to go higher, that's not a trade we want to be in, right? Because the overall trend is down. And so that's a two-legged pullback we're going to skip on. And then we wait to see if it develops with a bearish candle or a good looking setup to short off of that in expectation that it is going to continue with that overall downtrend. And so here, this is a pretty solid setup in terms of a two-legged pullback. We have a pretty strong down move here, and then we have an up move here, and then here is that two-legged pullback, and you can see it starts to attempt to go higher here by making a break above that previous high. Now, this candle right here, this entry, this signal bar, this is not the greatest of candles, I will say that, but you pretty much have everything else going for you. The overall trend is down. We're bouncing right off the EMA. We attempted to go up, and the EMA is now being resistance. And then our setup is this failed two-legged pullback here that we're attempting to short off of. And then our signal bar, it is a little bit of a reversal bar. If we kind of look at it, it opened here, sold off a tiny bit, went up, and then sold off and closed about at the middle. And so our idea here is if we put a sell stop below here and the market then decides to open the next candle and then sell off, that's still a reversal pattern. It's essentially that lower high and then that failed two-legged pullback. And so this is where we would want to potentially put a short in and then go short from there. Now, this is a little bit more of an aggressive failed two-legged pullback, but I did want to talk about this one. And so now let's go into another more clear example. So what we have here is another failed two-legged pullback to the short side. And just looking at the overall trend, we are basically really big trend down. And then the market decided to do a little flat. And then we started to make a attempt higher. And so what we're going to look at there is because the overall trend is down, we're going to look to see this move higher, essentially make a two-legged pullback, and then fail because the overall trend is down, right? And so zooming in on this, we can see that it has that high there, that one leg down, that second leg down, and then it makes that attempt higher. And so all it has to do is make a one tick move higher for us to say that, okay, it's made that attempt to go long off a two-legged pullback, and we're going to look to see that fail. And so initially, if we were looking to think, oh, maybe this is going to go in an uptrend and we're going to take a two-legged pullback, we're not going to take this two-legged pullback because this signal bar is bad. And then we had this initial huge sell off here. And so that's going to kind of say that, hey, the overall trend is kind of down. So you're going to look to have attempts to go long fail more often than not. And so here, as soon as we see the market make a tiny break higher here, we can put our sell stop below the low of the signal bar that would be for the two-legged pullback. And so that would be this bar right here. And so then we just put our low here. And so this, the signal bar for our failed two-legged pullback is an outside bar, right? It's bigger than the bar before on both ends. But because this is a trap, that is okay, because we're looking for the market to break higher and then reverse on people and cause a large amount of movement. And that's what happens here, is it reverses on them and then we get our scalp out. And this is a great setup because we have a really good reversal bar that we would enter in on, and then we're below the EMA, the overall trend is down, resistance is nowhere near in sight. And so that is a really solid trade. So here we have another solid entry. The trend is clearly down right now. And so what we're looking at is we are looking at here is a new high. So we have a one-legged pullback, a two-legged pullback. It makes an attempt to go higher. And then because this two-legged pullback is counter trend, even though that this is a good signal bar, we're not going to take that, right? We are looking for trades to the short side. And so that's why we always want to be trading with the overall trend, because it'll keep us out of potential bad trades. Now, this trade was bad because it was at the wrong side of the EMA, but sometimes they will be on the right side of the EMA. And so this will keep you out of those. And then what we look for is this is a good signal bar or a good bearish bar. And so we're going to put an entry below that, expecting the market, if it breaks below that, that it is going to sell off. And so what we have is for this trade, right, we have our overall trend is down. So that makes our setup strong there. The EMA, we're pretty close to the EMA. The market is pretty volatile right now, so this is essentially close enough to the EMA. And then our setup is that failed two-legged pullback here. And then our signal bar is really bearish and strong. And then in terms of distance from the resistance or support, we definitely wouldn't want to be trying to break through this low here, because that would be really far from the EMA as well. So that would be just kind of like multiple things of resistance or support working against us, but we would definitely be scalping out before that level, so we are safe in that sense. So that is a pretty solid setup. So moving on to the next setup, there's actually one right here. And so this is, again, we're in that overall downtrend, right? This is a really big downtrend. And so because traps sometimes work very quickly, what we have here is, here's our two-legged pullback, and then it attempts to go higher right here. And so this is that outside bar again. And so what we're going to do with this trade is we're going to have our sell stop right below this bar, expecting that when it breaks higher, if it breaks below, it's going to trap and sell off really quickly. And so that's what we're going to look for with this kind of setup. And if we go short here, we have plenty of room. There's potential support here. And so we have plenty of room to get out before that. And so that's okay there. We're at the EMA. We're definitely making lower highs here, which is good for our trend as well. Our signal bar, we're going to assume our signal bar, because if it goes up and then breaks off down here, we're going to assume our signal bar is going to be really strong in our direction. And then of course that resistance or support, we have plenty of room to that. And so that was a really good trade. This is actually a lower high example right here that you could short below this bar, but I would say don't take this because you have this support right here. So other than that, this would have been a good lower high to go in off of, expecting it to break below this bar. And if it did, it would sell out. And you can see it did sell out there because the trend is so bearish. But because there are these support levels here, I would avoid taking that, especially when you just made a winning trade right here. So here we have a pretty good looking setup to the short side again. So the overall trend is down. So we're going to look for reversals of the trend to the short side. And so what we have here is essentially the market does a little bit of an uptrend here. makes a high, and then does a two-legged pullback. And we're going to look for that to fail. And so this is a two-legged pullback that we definitely would have not entered because it's a inside bar right here for that signal bar. And so we would have avoided that. And then once we saw this candle form, we would have wanted to put a sell stop right below this, expecting this two-legged pullback to fail and keep going down. And so the overall trend to look at our checklist is down. The EMA, we are right at the EMA, but selling below it. So that's in our favor. We have a good failed two-legged pullback as our setup. Our signal bar is a really nice bearish bar that opened here and then closed after it attempted to go higher. And then our support and resistance, there's maybe a little bit of support here, but that's really not big enough to cause too much of a worry, especially because we do have an overall solid trend to the downside. And so this trade works out really nicely for us as another trap. So here we have a trap that pushes the market to the upside. So we have an overall solid uptrend here, pretty good channel. And then zooming in on this, we have our EMA is pretty much right where the bars are forming, which is great. And then our two-legged pullback, our failed two-legged pullback is right here. So we have a little down move and then one pullback here and then another pullback here. So that is our two-legged pullback. And then it makes a tiny attempt lower here. And we're going to look for that to fail. And so this is one of those times where we have an outside bar. And because it's a trap, we're going to put our buy stop right above the candle right here, expecting that if the market, after it has broken lower, if it reverses, it's going to trap those people and the market is going to then shoot up from there. And so that's why we want to get in right here instead of after this bar is forming. We want to get in when those people are being trapped and when the market has decided to reverse, because these reversals can happen very quickly sometimes. And if we waited for this candle to form, entering up here would have been too close to this potential resistance up here, and we would have avoided the trade. And so that's why we want to enter in here, because it is essentially the trap is still working in our favor, and it allows us to get in closer to the EMA as well. So here we have another example that traps people and pushes the market up. So first off, our trend is to the upside. We are currently pretty much at the EMA and at the bottom of this channel, which is really good as well for our overall trend. And then what we have is we have a down move and then a one-legged pullback and a two-legged pullback. And so this, because the bars are really big right now, it's kind of hard to see that this does make a tiny bit of a break lower. So what we're going to do is we're going to enter right above this bar as it has made this failed two-legged pullback, expecting this market to continue to the upside here. And so this bullish bar right here is really solid for a trap to the long side right here. And so this is a really good example where right here we have a two-legged pullback, which would have been great to catch because we are in that uptrend. But you can see here it's an inside bar, and so we wouldn't have actually taken that trade. But now that we have a two-legged pullback here to the short side that failed, it still allows us to jump in on this move right here. And so that's how all these setups really work together, is either you'll have a two-legged pullback that works or a failed two-legged pullback that works in your favor, or a higher low that ends up working in your favor. And so there's really a lot of ways to essentially enter in on the same move. And so that's what these three setups do for us, is they allow us to get in on multiple possibilities for when the market is as either being choppy or not giving us the right setup. And so that's why you should skip on when you see two-legged pullbacks like this, because maybe the market will form a failed two-legged pullback that will look like this, that will still allow you to get a scalp out. Or maybe it'll just form a lower high that'll allow you to still enter on. And so be patient when a setup essentially doesn't work like this one, or it doesn't form the way we want, because there are always other opportunities that will potentially get us an entry into the market. So let's look at one last example here. And so the market has been in a huge sell-off, so it is a little easier to find really solid looking trades to the short side. And so here we have an overall downtrend at the moment, and then here is our setup we're going to look at. So what we're looking at here is the market has made a sell-off, and then it has made a move up. And because the overall trend is down, right, we're going to look for this two-legged pullback right here to fail. And so it makes an attempt higher. It has a great signal bar here. It makes a really strong move to the upside. And then we have a very bearish bar forming here. And so that is that two-legged pullback, make an attempt higher, right, and then failing here. And so we're going to short as we see that bearish bar, expecting it to continue with the overall downtrend. And so we're going to put our sell order right below here. We're pretty much at the EMA. Our signal bar is extremely bearish, which is really good for us. And then support and resistance, maybe you could say that's here or down here. Definitely if it's here, we have room to scalp out. And so this is another really good looking trade. Now, all these examples that we have looked through in the last 3 sections are really solid examples. And so what you should try and aim for is all your trades looking similar to these. Now, not every trade is going to be slightly different. That's the hardest part about trading in the stock market, is every trade is always different. So you can't have a perfect picture for everything. But hopefully through these examples, you will start to get an idea of what a good setup looks like. Now, in terms of what a bad setup looks like, it'll essentially be a trade like one of these that won't have something on the checklist that we have gone over. Hopefully throughout this course, I have made that somewhat clear in talking about a few examples that weren't great. Essentially how this trading strategy works is you want everything to be in alignment. And first off, you want to start with the overall trend, right? The overall trend is down. And then you want to see where are you in relation to the EMA. That is kind of like the medium trend. And then the setup we have, that is kind of our smaller trend. And then the signal bar is our mini trend. That kind of shows us where we are right now. And then resistance and support, that's just kind of to keep you out of hairy situations. And so always be thinking about that with this trading strategy. Where are we overall? Where are we kind of in the middle? And then where are we right now? And so all of those should be in alignment. If you have it like this, where there's 2 in alignment and then 1 is the opposite, that can cause you to have a trade that is not going to go in the right direction.
Hey guys, thanks for checking out my course, Penny Stock Trading, Analyzing the Most Profitable Stocks. Now, this is just a little preview of the course, and I'm going to go through a little bit of the curriculum, but basically, if you're trying to get into penny stock trading and you want to make real money, and I'm talking about 4, 5, 6 figures with penny stock trading, then this is the course for you. Alright? I'm sure everyone has either a friend or a family member who has dabbled in penny stock trading, whether or not they've done it themselves or did it on a tip of another individual. You probably know someone directly who has either made a lot of money penny stock trading or made a little bit or even lost money. But I think what you'll notice is that for the most part, some people treat penny stocks as almost like lottery tickets, and they go off of a hot penny stock tip or just off of some news that they read online, and they try to just throw their money in. Okay, that's not how you're gonna get rich. Okay, it's not a get rich overnight scheme. You can double your money in a single trade, and you can triple your money in a single trade. And in these courses, I'm going to show you how you do that. But it doesn't just happen out of luck. Alright, and that's what I'm going to teach you. Okay, I'm going to go over what actual profitable, the top ranked traders in the world, the methods that they use in order to make money trading penny stocks. I don't think I need to tell you how much money people on Wall Street make, okay? 7 and 8 figures salaries and compensation is on the low end in Wall Street, and because of the fact that they make so much money trading. All right, so what I do is I help you take those strategies and bring them down to the penny stock trading world, which is more affordable for the average trader like you and I. All right, so let's just go over a few of the courses. All right, in this course we're going to be going over the basics. All right, going over how to understand support and resistance points. Okay, now don't worry, it might seem overwhelming right now, but as you watch the videos, you're going to understand everything. I break it down for you step by step, and I give you the entire A to Z for it. All right, anyone can take this course. All right, you don't need to even have a high school degree. All right, that's how simple I make it for you guys. Okay, because it's just very intuitive. All right, I'm going to show you. I'm going to give you all the resources you need. I'm going to give you all the information you need, all the patterns that are used. Okay, and by watching my course and by understanding it, you'll be able to have all the tools you need in order to forecast penny stock prices and in general stock trading. So you'll have a much better understanding of the stock market and how to make money off of it. And to be honest, now is the best time to get in, because if you go on to Yahoo Finance, if you go on check any financial newspaper, you'll see that the stock market is on fire right now, and it is the best time in world history to make money with the stock market. So I hope you guys like the course. Definitely check it out. Oh, and as an added bonus for watching this, if you use the coupon code VIP50, you'll get 50% off right away. All you do is go to the screen, click on redeem a coupon, put in the code, and you'll get 50% off. So I'll see you guys inside. Hey guys, this is a continuation of the technical and fundamental analysis module. And in this video and this series of videos, I'm going to be going over more concepts related to technical analysis. Okay, so now as a recap, technical analysis when it comes to penny stock trading always refers to the charts. Okay, so no matter what resource you use or what software you use, a very important tool that you must have access to and that you must utilize while trading are the charts of the historical prices of a stock price, because based on these charts and based on their historical patterns, you will be able to know the future trends. Okay, and it's a very important tool. It's called technical analysis. So whenever you hear that term on the forums or the chat rooms or anything, if I ever mention it, always think charts. And this is an example of one. Right now I'm using Yahoo Finance, and this is a chart of Fannie Mae, FNMA, but it doesn't really matter. It's just any chart you can use, because on every single chart, and as I discuss in my How to Research a Stock in 5 Minutes or Less module series, it's very important that you find the points of support and resistance, so that when you're trading and when you're looking at a stock and seeing whether or not you should enter it and whether or not you can make profit off of it, it's a very good tool. All right, and it's a very good tool to analyze whether or not you should put that stock on your watch list, and whether or not you can determine at what points that you should buy or sell the stock. Alright, so it sounds a little confusing, but let me get right into it. Alright, we're going to start at the very basics, which are two concepts known as support and resistance. Okay, support and resistance. So support is basically the lowest point that the stock will go before it bounces back. Alright, so if you're looking at this video, right here, these are the points where it's pretty much the valley, alright, the lowest point where the stock goes and then it bounces back up. So you can see right here, whenever it gets this low, it seems to bounce back up, and that's known as the support point. Alright, now the reason that's important is because that, as a trader, nothing is guaranteed, but you have to use the tools at your disposal to be able to understand when are the best points to enter a trade. Okay, so for example, for those of you who engage in dip buying or swing trading, what that involves is waiting for the stock to get to its lowest normal point, so the point of support, and then you trade it because the stock price is going to go back up. All right. The psychology behind these points is that this is the point where people have their bids placed in. So and again, they place, it's all about the self-fulfilling prophecy. Sorry, self-fulfilling prophecy that I mentioned before, okay? Traders trade based off of what they think is going to happen in the market because that's what influences the price, you know? The price is based off of the moves that the market makes and the supply and demand of the market. So when people see that, all right, Fannie Mae doesn't get lower than this point, it seems like around 3.76 or 3.8, right? The stock price won't break below that. So they know that that's a safe place to buy, because if you look at historical prices, you can see that this is a safe place to buy. Now, it's important to realize that technical analysis can be done on any indicator of time, or any range of time, any range of time. So as you can see here, right now I'm looking at the 3-month chart, all right? But you could even go and look at the 1 month, all right? And you'll see support, you know, right here. As soon as it hits here, it goes up. As soon as it hits here, it goes up. As soon as it hits here, it goes up. And that's what support is. That's where you can kind of feel confident. And again, nothing is guaranteed. But that's where you can feel confident that this is the point where the stock isn't going to go below. Right? But understanding that rule of support and that concept of support is vital to understanding how huge movements in stock prices occur. All right? So as an example, let's go back and look at the 3-month, right? What happens here, the reason for these huge dips, right, is when a stock breaks the support, all right? When a stock breaks the support, people lose confidence in that stock, because even though because that certain price was supposed to be where the stock is safe. So if I believe that the support point is 3.7, all right, $3.70, and that the stock is never going to go below $3.70, then that's my support point. And if the stock price goes below that, then I lose confidence in the stock because, you know, it just broke its support point. Now I don't know if I can trust the stock or not. And what happens is everyone feels that way. Everyone loses trust in the stock and they start to sell it. And the price plunges, as you can see here. And that's what we call a breakdown. Okay? So in the same way, there's also concepts known as resistance. All right, like I said, support and resistance. Now, resistance is basically the exact opposite of that. Resistance is the highest point that a stock gets to before it goes down lower. And think about it, resistance. The price wants to go up, but it faces like a wall of resistance, and it can't pass it. It can't break through that point. All right. And so that's why we call it resistance. And again, it all depends upon the range of time at which you look at the stock price. So when you're trying to determine points of support and resistance, you want to look at a variety of different time ranges. So that's why Yahoo Finance is a really good resource, because you can look at the 3-month range, 1-month range. You can even go back to a year. All right. Technically, that's the furthest back I'll go is 1 year. Especially with penny stocks, you don't need to go. So if we look at the previous day, right, you can see that there is resistance at 4.3. Every time the stock goes or tries to go to 4.3, it doesn't pass it. That's the resistance. It can't break through 4.3. And here's a key element and a tip or a technique or a strategy that you guys should memorize, is that the more a stock hits that point of support or resistance, the more you can be certain that it is truly a place of support or resistance. All right, so let me give you a perfect example right here. If you kind of look right here, I'll move my mouse, but you can look. The stock price gets stopped and faces a point of resistance at 4.3 several times, right? 1, 2, 3, right? At that point, I can be very confident, because it hit $4.30 3 times, that is definitely a place of resistance. Now, what does that mean to me? Now I know that if that stock is to break and go past the stock price of 4.3, that is what we call a breakout. And that is a catalyst, as mentioned in my double catalyst rule, and that is a very good indication that the price stock is going to surge up higher. All right, that's at these points. Usually, when a stock breaks a point of resistance, that's when the stock price jumps up, and there's a high volatility and a large amount of price change that occurs. So, if I was to be trading Fannie Mae, right, I can see that on Friday, right, it didn't break 4.3. It kept hitting 4.3. But I would have set an alert every time it went for 4.3. And the second it hits $4.31, I would buy it. Because usually that means that gives confidence to the stock, right? People trust the stock and see, oh, it just broke through its resistance. It's a strong stock. It's going to go up. So as soon as it breaks through $4.30 and hits 4.31, that's when I personally would buy it. I would buy it at 4.31 and usually ride the wave, okay? Usually the stock is going to spike up higher. All right, that's a good way. That's what I talk about when I refer to breakouts, and that's a very key basic understanding of technical analysis, but it's extremely important, and it's simple, you know. It doesn't, a lot of people think penny stock trading gets very advanced and very complicated, and there's traders that use all different types of indicators, but this is a very simple one that you can get from just looking at a chart. You know, you don't have to run any equations or algorithms, and you can make a lot of money just off this rule. And this is what I use. I don't, you know, I'm going to discuss in future videos all the different technical indicators if you're one of those people. And you can see right here, Yahoo has a whole bunch of different technical indicators that people use, all right? EMA and B-bands and money flow and MACD. Those aren't required. You can use simple support and resistance, and if you understand those, you can make profit off of penny stocks, all right? So definitely rewatch these videos until you understand what support and resistance are. If you have any more questions, obviously contact me at admin@inpennystock.com. I'm going to be making more videos that cover different chart patterns and technical analysis because it's definitely key for penny stock trading. So I hope that helps, and I'll see you guys in the next video. Hey guys, in this video I'm going to cover a topic that I believe all traders need to know, and it's definitely something very important. It's relatively basic or intermediate, but I've found that some traders don't exactly know the difference between these two concepts. And of course I'm referring to fundamental analysis versus technical analysis. So in this video I'm going to cover what exactly those are, how they're used in stock trading, and why they're important. And you know, I'm going to kind of integrate it into the strategy that I use on in my conservative winning techniques, and how I use these two types of analysis. Okay, so first let's cover technical analysis. Okay, technical analysis is the concept of analyzing charts and chart patterns and looking at the graph. Okay, whenever someone is talking about technical analysis, they're talking about analyzing historical prices and basically right here, how to read the charts, how to read the graphs. And that's something I go over a lot. I have a whole module on and a whole series of videos on chart patterns and basic, intermediate, advanced chart patterns, how to understand them, how to read them, what they mean. Because interestingly enough, a lot of traders trade on technical analysis, and again, the reason it works is because it's almost, I know Timothy Sykes says this a lot, it's almost a self-fulfilling prophecy. So because of the fact that, again, the stock price is all dependent upon the buys and sells that people do, upon the market. So because of the idea that the market believes in technical analysis and believes in how to read chart patterns, that's the reason why technical analysis works so well. So with my double catalyst rule, for example, or my breakout rule, if a stock breaks out a new high, the reason it shoots up higher is because everyone who follows technical analysis believes that it breaks out higher, and so they buy into the stock expecting a breakout like what happened here. Okay, so when you're talking about technical analysis, there's concept like support, resistance. So you can see there was resistance right here at 57 cents, 60 cents, and then as soon as it breaks out, which is a technical analysis term, the stock runs up, and that's basically how you use technical analysis. Okay, and sometimes I just use simple resistance and support and breakouts and breakdowns. There's a lot of different terms, and different traders use some of these terms. There's RSI, relative strength, EMA, exponential moving average, and these are very, some traders use these, and some are successful with it, others are not. I found that you don't need to go that in depth. It's not. That's why I've made these videos, because you don't have to be a financial expert or a statistical expert. You don't need your degree you don't even need to have gone to college. Okay, people started trading in high school, and I have students who are high schoolers, and one middle schooler who I don't know whether or not to believe or not, but in general, these guys, it's not technical analysis is basic. It's just reading a chart, and that's all that you need. Okay, now let's go on to the topic of fundamental analysis. Okay, fundamental analysis has to do with, in this one you need a bit more understanding of finance. Nothing too complicated, but this is where you go into the news, you go into the headlines. I have a whole video on how to read these news. There's a lot of headlines, and you might see several a day, and you need to be able to understand why they affect the stock price, how they affect it, and what it means, because news is a huge indicator of what the stock price and how the price action is going to occur, and the volume that's traded. I have a whole video on that, the intraday trading strategy of intraday news trading strategy, which is literally making gains, which is one of the most conservative and profitable methods of trading, by just knowing how to analyze headlines and keeping your eye on the news. Okay, but fundamental analysis goes a bit deeper into it. Okay, and this is Yahoo Finance. I love this website because it allows for easy research of stocks. Okay, so fundamental analysis goes into understanding what the company does, how they're doing. So whenever someone talks about fundamental analysis, they're going more in depth into the company, and they're looking at more of the financial highlights, or the the financials of the company. So these are all different aspects, and I'm gonna have a video, or I'm gonna come out with more detailed videos of how to analyze these financial statements, how to analyze SEC filings, which you can see right here, and this is all included in fundamental analysis. So they're both very important, though. Okay, so this is the income statement, an example of financial, but this is fundamental analysis. But now, taking this back to the whole trading strategy and what I do a little of both. Okay, with these penny stocks, again, you have to remember, we're not investing long term, we're just trading. Okay, you buy it and you sell it based on predicted price action, based on historical knowledge of how the market works. That is basically the essence of the entire trading strategy. You know that when a double catalyst occurs, the stock is going to go higher, so you buy it and sell it when it goes higher. And that's basically how it works. So what I do is, I always look at the chart first. Okay, so I start off with technical analysis, and then I go into fundamental analysis if I want to kind of trade the stock. So watch the video on aim to not trade, where I discuss the winning trade psychology. And in that video I discuss that, okay, I look at the chart first, but I look for every reason not to trade the stock. Okay, and again, if you don't understand why, watch the video. I go into every reason why not to trade it, and then if I can't find any reason not to trade it, I know that, okay, this is a great trade, I need to put it on my watch list. And then stocks that I put on my watch list, I go over the financials and I go into the summary just to get a bit more understanding of what the stock is and their company and how they're doing, just in case. And I'll go into videos I have videos that go more specific into the important aspects of fundamental analysis and SEC filings, and how to read news and headlines. So definitely watch those. You want to have a mix of both, and that's how you're going to be the most successful and the most profitable, and that's what we aim to be. So yeah, I hope that helped, and in the next video I'll be going into more about how you should look at news and how you should analyze it and how to determine these headlines here. these headlines and press releases, how to determine which ones you should keep an eye out on and which ones are important. So I'll see you there.
Hey guys, this video is a long time coming, and I know a lot of you guys constantly ask me and the IPS team about it, so I'm just going to make a quick video about how to track the current pump and dumps that are going on. Alright, pump and dumps, obviously, as we discussed a lot before, they're the penny stocks that are currently being promoted through, email blasts or separate promotion companies that basically just focus on hyping up the stock so that the stock, they tell people either through their emails or texts or any notification, even calling. Back in the day, that's what the boiler room concept used to be about. They would basically get people to buy a penny stock off of some hot tip, say that it's going to rise for whatever reason, and because so many people are buying that stock, it ends up shooting up. So there's this website.
Hey guys, and welcome to the introductory video for basic chart patterns. In these videos I'm going to be going over technical analysis, chart patterns, and different types of patterns and what they mean. Okay, when you look at the stock price and the stock history and graphs like this, there's certain things that the way the chart looks immediately lets you know, and it gives you a lot of information actually. Picture's worth 1,000 words, and for stocks, a picture could be worth $1,000 or $10,000 because I trade, and there's thousands, if not hundreds of thousands of traders that trade based off of technical analysis and charts and reading charts and analyzing charts. So in this video I'm going to cover the concepts of uptrending and downtrending and what that means. So we're going to start off basic, but definitely, for you veteran traders out there, this is just a good refresher, and we're gonna slowly get more advanced as we go on. But for now, this is a chart pattern of PHOT, FOT, it's a weed company, and just like all weed companies at the moment, it is uptrending. And what that means is that, this is simple, you can tell that the stock price is gradually going up. Okay, for the most part, again, you have to look at for the main story that a stock is telling. Okay, that's what technical analysis is all about, and that's what all these chart patterns focus on. Okay, it's not going to be one straight line that goes upwards. Okay, it's not going to be exact slope upwards, but you can tell, generally speaking, that this is an uptrending stock. And what that means is that what information this gives us is that the stock price is going up. Okay, this is a stock that is going higher in value over time. It is a nice stock. It is a bull stock. It is, if you were to hold it long term, barring all other information, it's probably going to go up. Of course, you don't just trade on that, because the other aspect of this and the other basics of technical analysis is that the chart looks different based on the time range. Okay, so we were looking at 1 year, and we can see over the course of a year the stock tends to be uptrending. But if we move to 1 month, you can see that the stock tells a different story. Okay, this is actually showing a different type of stock pattern. This is actually doing a head and shoulders, but let's not get too ahead of ourselves. Sorry, that's a bad pun. That's another chart pattern. That's an intermediate chart pattern that we're going to cover in the future. But generally speaking, you can see this is slightly uptrending, but again, you can't give this a complete definition. And you can tell by, I just want to show you guys that by looking at different time ranges, this is completely choppy. This is not giving any story to you whatsoever. So much volatility here. You can't tell if it's uptrending or downtrending. But I just want you guys to be aware that when you look at a stock, and this pattern tells you a lot about the future of the stock. Okay, past performance is indicative of future, performance and future returns, I guess. And it's something that Timothy Sykes might copyright that phrase. I don't think he's allowed to, but he, it's something that he says, and it's true about the stock market. It's true. Technical analysis is things that thousands, tens of thousands of people use. And by looking at a chart, you can analyze it by the way it looks, and you can gain a lot of information about that chart. So let's look at another stock now. Let's look at, I'm just going to think of a random ticker. This This stock just recently got listed onto the NASDAQ, but let's just take a look at it. Let's look at the, I don't know, 2-month. Okay, so just one little tip right here. If you ever see, for some reason, you put in a time range and the stock is just at a weird, it just starts like halfway through, what that means is that that's when the stock went public. So this stock actually just recently went public, you know? So that's why it only starts right at that date. It doesn't go further back. But you can tell this chart on the 2-month timeline, it's downtrending, clearly downtrending. You know, you could slide right down here, it's downtrending. That means that this stock is probably going to go down more. That's the assumption, and that's the analysis that you do, okay? I'm not telling you to make trades based off of this information when you look at the general trend, but when you're wanting to learn the story of the stock and when you're researching the stock, this is how you do it, okay? Let's go further in, because again, this, when you go further out, okay, the longer the time range you're looking at, the longer type of trade or investment you're doing, okay? So we trade within the same day or within the same week, or, you know, I trade sometimes within the same hour, okay? So we want to go closer. So you want to go into the 5-day chart or even the 2-day chart, okay? You know, when you look at the 2-day chart, you can see that this is a downtrend, okay? The stock is going down. You know, when you look at the 5-day chart, you can see that the stock is a little choppy and everything. And, you know, this is a cup and handle almost. Not really, just a cup. There's no handle. But that's an advance. Sorry for getting ahead of myself. I just want to give you guys a little insight into what you're going to see in the future. And, you know, the fact that, yeah, this is obvious stuff. You know, when you look at this, you can tell it's downtrending. But analyzing chart patterns gets a little bit more advanced, but don't worry, you know, that's why I'm here for. That's why my videos are up. You can rewatch them as many times as you need. They'll always be up for you, you know, as long as you remain a good member in standing. But that is, you know, the basic chart patterns, uptrending and downtrending. I'm going to do a few more basic videos before we get into the more intermediate and then the advanced chart patterns. So definitely, you know, watch these videos, understand them. You know, you need to know technical analysis in order to be a successful trader, because the chart patterns tell the stories of the stocks. And based on the chart pattern, you are able to gain the information and garner enough of a hypothesis of as to whether or not you should trade this stock. So I'll see you guys in the next video. Hey guys, welcome to another video of the technical analysis module. In this one, I'm going to be covering the head and shoulders pattern and why it's something you must avoid if you're a penny stock trader that goes long. If you're a penny stock trader that enjoys shorting, then this is definitely one that you want to keep in your arsenal or your toolkit when you're analyzing stocks, because it's a very good point and it's a very good chart indicator that lets you know when a stock price is going to plummet. Alright, so let's get right into it. Again, I'm using Yahoo Finance because it allows you to see a range of stocks. A range of price ranges and time ranges. And the stock that I'm looking at is RLOC, RLOC, but again, it doesn't matter. I'm just showing you a chart, and I'm just sitting with you guys and analyzing a chart so you can understand what I mean by head and shoulders and why it's something you need to avoid. Okay? Now, it's one of the very prominent chart patterns that traders discuss. So if you hear of it or if you haven't heard of it before, definitely make sure that you understand this video, because it's important, and it's something that if you decide to become a penny stock trader, which I definitely advise, and you know, which if you're watching this video, I'm sure that's what your motivation is to do, it's a chart pattern you need to keep an eye out for, because you'll see it time and time again. Alright, so in this chart that we're looking at, the head and shoulders is right here, right in this range. Okay, now the reason it's called the head and shoulders is pretty simple. This is the head and these are the shoulders. Alright, and as I stated before, you know, and even the title of this video, why you must avoid head and shoulders. Alright, because, you know, I'm a trader that goes long in penny stock. This is what we this is all the videos, and my trading strategy is one that goes long. So if you're a trader that tries to buy low and sell high, then this is if you ever see this chart pattern, make sure you never trade that penny stock. If you're someone that goes short, this is what you should be looking out for, because this is a good indicator that the stock price is weak and it's going to plummet, and it worked out perfectly here. And let me explain the psychology behind it, because I don't want you guys to just sit here and memorize these patterns. You know, this isn't school. I'm not trying to have you guys take down notes and memorize patterns. I'm trying to give you guys the understanding behind it, because that's what will make you independent, profitable, successful traders. So, the head and shoulders. Let me explain why it's a huge sign of weakness for a penny stock. All right, this is the motivation, and this is the psychology behind it. The stock price has a shoulder, right? It's left shoulder. It's a more historical price. And what happens is it breaks through one of its points of resistance, as we talked about in a previous module of the support and resistance video. It breaks through resistance and shoots up and hits a peak. All right, this one is a bit more rounded, but it can also be, you know, very pointy, like you see right here. All right, and that's the head, that's the top. Then what happens is it goes down, and it still kind of stays a little bit. All right, it goes back down pretty much to the previous point. All right, and that's the second shoulder. Now, essentially what this is showing you is it's telling you that the stock has pretty much run out of juice. All right, it's pretty much run out of volume, and it's almost an indicator of weakness because of the fact that the stock is losing its momentum. It's not being able to be strong. And the reason I say this is because after the head, after the top point, the stock is not going to shoot up again. All right, or again, as I always say in technical analysis, nothing is guaranteed, but what we're working with is percentages and analysis. And analysis and historical data show us that this stock has already run its course. If you were here beforehand and you caught this breakout and then you made your profit, you should have sold at the top and then get out, and you're done with this stock and you don't look at it again. But if you come across this stock and see that, oh, it has a shoulder and it's already hit its peak and now it's down, forget about that stock, because it's just going to go down. It already had its huge breakout, and it's very rare that a stock has another breakout like that. So you should just forget about it and move on, because there's so many better trading setups, as I mentioned in my other videos. Now, if you're someone who goes short, this should be a good stock for you, because you can see that, all right, the stock already had its course. It already ran up, and right here it's just hesitating. It's just barely, it's struggling to reach the historical point that it had before on its left shoulder. And it's a good indicator that you want to keep your eye on it. Keep your eye on the point of support, because as soon as it breaks through the support, it's going to plummet, as happens right here. And if we can zoom in right here, I'm sure we can see that that happens again. Alright, this one is too narrow to really call it a head or shoulders, but in general, what you can see though, and what I want you guys to see from here, is that after a head and shoulders, the stock price is a goner. Again, right here, it's failing to kind of go anywhere. You can see that it hits support a lot, and then as soon as it breaks support, it plummets. You know, and that's typical of penny stocks. You're going to see this time and time again. Alright, so that's why I'd say avoid the head and shoulders if you're a trader that goes long. It's a huge sign of weakness for a penny stock, so stay away from those. Alright, so hope this helps. It's a little confusing, but if you watch the other videos on technical analysis, you'll get more of an understanding. And again, as you do more virtual trading, as you see more charts, as you actually spend more time trading, you'll understand this, and you'll see that this pattern and this example of weakness that the head and shoulders exemplifies stays true time and time again. So hope that helps you guys. I do these videos so that you don't have to take the time in and pick up on this trend, okay? This is pretty much through years of trading and knowledge and researching that I've done, so I give you guys pretty much the spark notes of what to keep an eye out for, and I pretty much save you guys time, you know? Yeah, you could pick this up information and trend up on your own if after months and months of trading, but now that you guys know this, you don't have to worry. If you see in head and shoulders, you don't have to experiment with it. You already know that it's an indication that the stock price is going to go down. So, hope that helps you guys. See you in the next video. Hey guys, in this video I'm going to go over the green to red momentum shift and what I mean by it. Sometimes I refer to it in my videos and I've gotten people who ask me what I mean by it, so I want to analyze what exactly it is and what it means. Okay, so the green to red, when I talk about that, I'm talking about the stock price and whether or not it opens with a gain, closes with a gain or a loss. Okay, and specifically it means when you're looking at candlesticks. Okay, so candlesticks are a type of tool or way to look at charts, and candlesticks, what they do is they tell you the stock price, and if they're green, that means the stock went up during the day, and if it's red, that means it went down. So the green to red is a stock indicator. It's a chart indicator that usually means the stock is about to plummet. Okay, and it's something that a lot of shorters use to set up their shorts. Okay, I know that this is almost, Timothy Sykes has said it many times in a lot of interviews and a lot of his videos, that this is the main strategy that he uses when he shorts. Okay, when you have a stock that's been running up for a few days, okay, green a lot of the days, constantly closing higher day after day after day, and if you go back a couple of days, you can see that this stock has been running for about 4 or 5 days. Okay, the day that it closes red or opens red, meaning it opens at a lower price and it's trading at a loss than the previous day. Okay, so whenever the stock price is red or the candle is red, usually that means that it's about to go down and the stock price is about to plummet. Okay, and usually, with this, I'm talking about pump and dumps, I'm talking about, chart patterns, I'm talking about people who use technical analysis. Okay, and this is slightly more advanced, it's an advanced chart pattern, and usually when you see a lot of greens and then you see a single red day, that means the stock is about to go down, and that's when shorts reserve their shares and they start shorting the stock, and usually that's when the stock price plummets, because now investors or traders are, it's a sign of weakness in the stock, and because the stock is showing weakness, people don't want to trade it and they're all just selling their shares. Okay, they got the run, the stock is done, it's done running up, and now people are trying to sell and they're trying to get out of their position before the stock dips lower. Okay, so that's just something I want you guys to keep an eye out for. It's called the green to red. I call it a momentum shift. I guess I just got used to that terminology. It's the green to red shift. As soon as the stock goes from being a runner, constantly closing at a higher price than the day before, which are shown by these green candles, and so that happens a whole bunch, 3, 4, 5 days, maybe sometimes even a few weeks, and then the one day that it closes on a red, meaning closes lower than it opened at, that means that, or closes lower than the previous day's close, that means that the share is going to plummet. Okay, and again, nothing is guaranteed, you still have to follow price action, but it's a very reliable trading strategy. Again, 85, 90, I would say 90% of the time, after several green days, on the first red day, the next day the stock is going to plummet. Barring exceptional news or hype or pump and dumps, where they try to send out another pump, that's usually a good indicator that the stock is going to fall. So keep an eye out for that. Okay, when you guys are about to get into a trade or about to look at a chart, make sure you go. What I like doing is like looking at the 5-day past, and I change it to 1 day. And again, if you don't know the tool I'm using, it's Equity Feed. Go look it up on, it's my ultimate stock screening tool. I have several videos about how to use Equity Feed. It's an amazing tool, so make sure you use it. But what I do is I change it to 5 days. I look at it on a single day basis, and I change the chart into a candle chart, so I can identify the greens and I can see, okay, here's the red. So if I was looking at this on the 25th and I saw, the last several days were greens and then it just closed on the red, I would definitely not go long the next day. Okay, you don't want to get in that trade. Even if there's good news, I still wouldn't get in that trade. That's not a good trade setup. It means when you see a green to red momentum shift, it means the stock is usually going to go down. So stay out of those trades. And if you're a shorter, that's when you want to start paying attention to shorting that stock, because you're probably going to make money on the short. And I advise you guys to look into shorting. Practice on a virtual trading account with ShareTrader or one of these platforms that allow for virtual trading, or paper trading, I think is the official term for it. And definitely try to experiment with shorting, because the green to red, this is a very, very good sign that the stocks are going to plummet. A lot of successful shorters use this technique. I know Tim Gratani, Tim Sykes, I know they talk about this technique, and it's a very reliable one for making money and predicting how the stock pattern and how the price of the stock is going to go. Hey guys, in this video I'm going to cover a very important concept, but one that some people have a little bit of trouble understanding, so I'm going to cover it in this video. Okay, today I'm going to be talking about low floats and what is a float and how does it relate to stocks and penny stocks. Okay, so to understand what float is, you have to understand basically how the public markets work and how IPOs work. Okay, when a company goes public, and every company that you see here, any company that we trade, or any company that has a ticker, which is these symbols here, that means that they are a publicly traded company, and so that means they have issued shares. And shares are basically small percentages of the company, ownership of the company. That's what they're supposed to stand for. Okay, now the thing is, a certain amount of the shares are held by the management, the people who created the company and who did the IPO. So there's a certain amount of shares that they're called restricted shares, and those shares are not traded in the open market. Those aren't bought and sold, through your E-Trade account. Only the outstanding shares, or not, sorry, only the shares available for trading are the ones that we can use. Okay, so the formula for float, or calculating a low float, is pretty much you take the total amount of shares and you subtract, I don't want to get too technical or mathematical in this, you just subtract the amount of restricted shares, and that's the amount of shares that you have available to trade for. So say there's a penny stock comes out and they have 1 million shares. Okay, they have 1 million shares. However, the management and the shareholders are holding 75% of it. They are holding 750,000 shares. Okay, that means that only 25% of their total shares are available for trade. Okay, they have a low float. Okay, float is the amount of the amount of shares that are actually available to be traded on the markets, that are bought and sold through our retail brokerage accounts, E-Trade, Thinkorswim, ShareTrader, whichever one you use. Okay, so a low float stock is a stock that has a low amount of shares available based upon their total amount of shares. So the way you identify low float shares is through a whole bunch of different ways, but one of my reliable resources is lowfloat.com, and that's what I'm on right now, and they go over stocks that are having a low float. And basically the reason low float stocks are so good is because they're so volatile. Okay, for those of you who have traded, okay, you might have noticed that for some reason some stocks, when they break out, they go crazy and they shoot up. Okay, they jump, they go from 201, 202, 207, 215, 217, they jump up. Okay, whereas some stocks, they go very slow when they go up or down. It takes a lot of time, and that has to do with the float. So those stocks with low float are the ones that are volatile, are the ones that during breakouts they shoot up, and that's the ones that are the runners and the breakouts. And Superman has one time said, I've never met a low float that I didn't love. Okay, and basically the reason they're so good is because they're so volatile, and they're able to go high very quickly. But that also means you need to remember your rules and understand your stop losses, because that if they can go high quickly, they can also come down very quickly. But as traders, we make our money in the volatility. We make our money by the price range going up or down, and that's how we make our profits. So that's why low float stocks are very good, and something you just might want to keep your eye out for, so that you know that, okay, this stock is a good stock that'll, if it has good news, or if it's if it gets a lot of demand, it shoots up. Okay, and so let me explain. I don't want to go so much into the theory. So if you don't really understand economics too well, don't worry, you don't need to. I'm just going to go into it quickly. It has to do with the principle of supply and demand, okay? Because there's a low supply of available shares, it creates almost an artificial imbalance. And that artificial imbalance allows for the demand to greatly affect the stock or the value of a price, of a share. So, I just wanted to inform you guys on what a low float stock is, okay? Whenever you hear that phrase or term, now you guys will know what it means. It means that relative to the amount of total outstanding shares, there's a low amount of public shares available for trading, and that's called the float. So in this case, you can see there's 250,000, let's round, shares in the float and 1 million outstanding. So that means there's about a 25%. So it's relatively low. It's a low percentage. Here's another 25%. Low float. Okay, this is 50% and not too low. This is pretty low. This is almost 10%. This is like a 15% float. Okay, ignore this percentage. This is short interest, which I'll go into in another video. But whenever there's a low float, and if there's any stock that you see on lowfloat.com, or you hear people talking about it's a low float, you can see it based upon the amount of shares that are on the float versus the outstanding. And if the amount of float is very low compared to the amount of outstanding, then you know that it's a low float stock. And so, keep your eyes out for them. They're very volatile, so keep that in mind. Hey guys, I wanted to make this video as a type of attachment to my intraday news strategy video, because I definitely want to discuss and make sure that you guys know how to read and how to analyze headlines. Okay, so when you trade, you definitely need to make sure you're using Equity Feed's live news ticker, and that you're keeping Yahoo Finance open, or if you found a better source of it, and I might even have better tools for it, a better headline news service, basically, because stocks, especially penny stocks, they react a lot and very quickly to news, usually, or the news is able to spike or drop them very quickly. So you want to make sure that you understand how to analyze headlines and press releases and events or SEC filings, so that you can tell how to react, and whether or not it's important or not, because not all of these headlines are important. Some of them are just BS. And so I'm going to go through kind of a few examples with you, so that you can get an idea of being more aware of what to look out for while you're trading, and which headlines and press releases and news headlines are actually important. Okay, so this is a stock, TRTC. So I'm just using this as an example. This is Yahoo Finance. I'm just using this as an example of different headlines, and I'm going to go through with you so that you can see which ones are influential or not. Okay, so let's start off with this one. Why TerraTech is well positioned for coming explosive demand. Okay, right off the bat, you need to be able to tell whether or not it's positive or negative news, or neutral news. Okay, but you can tell that this is definitely a pro TRTC stock. Okay, it's well positioned for coming explosive demand. Now, not only is the news headline important, but the news source itself is also a very important tool, and you need to have knowledge of all the possible sources that Yahoo or all these websites pull their information from, so that you know whether or not it's reliable. Okay, at the current moment, it's March 26, 2014, for the last year, and I can imagine for the next year and for a while, Seeking Alpha is a very important website that has a very strong control and influence over the price of stocks. Okay, when Seeking Alpha discusses a stock, the stock is most likely going to move. Okay, and this is because a lot of people are on Seeking Alpha. A lot of traders use Seeking Alpha, and they have good credibility. They almost have too much power over it, because you can see that today that this is going to have a large effect on the stock. Okay, it's probably a very positive. Okay, the news came out and the stock is up 10%. That's pretty good. If you caught the news, you traded the stock, and boom, you made your money. Okay, now you have to know that the Seeking Alpha is one of those. It's basically a site where people can post articles about stocks, and so yeah, it's pretty. There can be a lot of manipulation involved, and they select and edit and screen their articles, but this website at the moment has a lot of power and influence over the market. Okay, another website like this is called TheStreet.com. Okay, TheStreet.com is another website that has a lot of articles relating to penny stocks, and they deliver news and headlines related to penny stocks. They're not as powerful in terms of influencing a stock from what I've seen as Seeking Alpha, but they're definitely up there, and you need to keep an eye out for them. And the third one is Motley Fool. Okay, some of you guys may have heard of it, some of you haven't, but again, Motley Fool, world's greatest investing community. There's a whole bunch of traders on here. These guys again are more long-term traders, but they still produce headlines and articles about penny stocks, and you need to keep an eye out for them because their articles, again, not as strong as The Street, or definitely not as influential as Seeking Alpha, but still an important site. Okay, so you need to pay attention whenever there's headlines. You need to pay attention to not only the headline itself, and whether or not it's a positive or negative or neutral, but you have to take a look at the source and see whether or not it's real, in terms of it's a real article or not. Okay, and so those are the three: Seeking Alpha, The Street, and Motley Fool. Okay, now the other ones that you need to look out for are the ones that you've already heard of. Okay, and that is, for example, you can see here: Seeking Alpha, The Street. The other one you need to keep an eye out for is Bloomberg. Okay, Bloomberg, Wall Street Journal, New York Times. These guys have the attention of hedge funds and private equity. No, that doesn't matter. But hedge funds and traders and banks and portfolio managers. So these websites have the attention of the big people. People who have a lot of money and who can buy a lot of a certain stock. So again, you can expect. And hold on, let me pause right here and let you guys know. Don't just think that because an article comes out, the stock's going to shoot up. Is it likely? Yes. But you have to still follow all the other rules. Good news is just another catalyst, and we don't trade unless there's a double catalyst. And if you don't understand why, go and watch the double catalyst rule. It's a short video, but it's why I am able to, when I stick to my rules, which is the hardest part of trading, sticking to your rules, but I advise you guys to be better than I am. If you stick to your rules and do the double catalyst rule, you'll win about 95% of the time, or enter profitable trades about 95% of the time. So you need to know that when an article comes out, that's just a single catalyst, and then you have to see whether or not it breaks an intraday high, or whether or not it breaks an all-time high, or whether or not the market even reacts to that news. Okay, because a lot of articles come out, and people have their attention all over the place. You might have seen this and thought it was important, but everyone might be trading a different stock or not have even picked up on this. So you have to watch out for that. Don't just blindly enter trades because they had a good news article. Make sure that you still follow your rules, but just know that this is a good catalyst, and now you keep it on your watch list and are watching it actively. Okay, so those are the news sites: Seeking Alpha, Motley Fool, of course Bloomberg, The Street. Those are the news ones. Okay, now this is kind of called like an aggregate service or a PR service, and what that means is that they kind of just pull news and they pull headlines and pull press releases. So these are usually affiliated with the website itself. So this redirects you to another Yahoo page. Okay, and whenever you see PR, that means it's usually from the company's investor relations department, which is the department of a public company that's responsible for kind of marketing the company and keeping the outside and the public aware of what's going on with the company. So a lot of the times you'll notice, or from what I've noticed, that PR Newswire, Globe Newswire, these types of headlines are not very important. Again, read the headline, and first, that's your first thing. Energetics appoints Mark Wallace, MD, as member of Medical Scientific Advisory Board for development of CBD-based nutritional supplements. Okay, that's not so amazing. Okay, so that is not really. Again, it's very possible that the stock gains attention because of something like this, but I wouldn't necessarily make this an active watch. I would still treat it like any other stock because this is aggregate news. It's not too important. Traders don't really give too much attention to it. It's just something to keep you updated, but definitely don't think that the stock is gonna go. That's like a catalyst, but it's almost like half a catalyst. So definitely still pay attention to the headlines because the headline matters. If this headline said Energetics signs a contract with Apple or with Google, then yeah, it doesn't matter about the news source. This is going to shoot up. So just make sure you give equal weighting to both the headline and the news source when you trade. So I hope that was just a very quick video on how to read and analyze headlines. Remember that analyze both the headline and the news source, and I just wanted to make you guys aware of some specific news sites that very strongly influence penny stocks, especially recently. Seeking Alpha is one of them. When you combine a nice headline with a Seeking Alpha article, usually you get very productive results, especially recently. So keep an eye out for that. Still follow all the rules as I go over in the other videos, the required mandatory rules. But this was just a quick, hopefully insightful video on how to read and analyze news headlines. Hey guys, in this video I'm going to show you how penny stocks are made. Okay, I wasn't planning on doing this video because it doesn't really, this is just a bonus video to kind of increase your knowledge. But I was going through this 10K just on the side, and I noted something that is just so ridiculous. And the funny thing though is that it happens with all penny stocks, but it's just something that's been on my mind recently. The whole concept of reverse mergers, and I just want to show you guys, if you've ever thought, or if the thought has ever crossed your mind, how are these penny stocks made in general? Why are they such awful and crappy companies? And let me show you exactly what I mean by that. So this is a company, TRTC. This is Terra Tech Corp. Okay, this is a hot stock right now. It's almost like a weed stock. It's has a lot of peaks. I've made a lot of money with it. A lot of people have made good money with it. It has been being pumped and dumped, or in general, it's been hyped. But they just released their 10K. Okay, the 10K is the annual report that a public company is required to file with the SEC once a year, and it's called the 10K. So I was going through it, and the first part of the 10K is always where they discuss their business. So that requires them to disclose, what exactly their business is. What do they do? So in this, they also go over a little bit about their history. So let me just show you this. Okay, so they initially were called private. Oh, sorry. Go back down. They were initially called private. Sorry about that. All right, I'm not gonna click. They were initially called Private Secretary Inc. Okay, and they were formed in 2008, and they were initially created to develop a software program that would allow for automatic call processing through VoIP. Alright, VoIP technology is voice over IP. That's like a phone thing, those corporate phone systems you guys have at the office to, call each other and to call out. That's what they were pretty much developing a software for. And then what they went through is something called a reverse acquisition. And it's a very complicated process, but it's a lot cheaper than an IPO. Okay, it's a reverse acquisition transaction through a reverse triangular merger. It has to do with a lot of accounting, a lot of finance, a lot of shares exchange contracts. But I just want to show you guys that these companies, the transaction happens in literally a month or two. And sometimes these companies have nothing to do with the reverse merger. And that's a good indicator that you know that the company is probably just is going to be hyped and sold for shares. Okay, the shareholders. I don't know if it's true. I could be wrong, but it doesn't seem like the management of this company had any interest in their new field. Now what they do is they engage in the design, marketing, and sale of hydroponic equipment with proprietary technology to create sustainable solutions for indoor agriculture. Okay, so they went from a software for phones, and then they did the reverse merger to become a penny stock, and now they're in indoor agriculture. Okay, to be honest, for me, that's really tough for it to be seen as a legitimate company. Of course, I don't know anything, but it's just something I wanted to point out to you guys in terms of how penny stocks are made. Okay, in future videos, I'm going to be going through how to analyze SEC filings, and I'm going to create a whole series as to what are the important parts of SEC filings. As you can see, they're huge, and they have everything. They have photos. They show the products at the grocery store. But basically, the 10K is a report for the investors to know everything about the company. So if you ever want to know something about a company, all you have to do pretty much is read its annual report. And they literally tell you everything. Like, they're required to disclose the amount of money they spend and who they do business with and what their strategies are. So it's just interesting to sometimes go through these 10Ks. I don't ever read all of them, but I was just going to go through this to see whether or not it would be a good stock to trade. In the next video, I'm going to be covering the important aspects of financials, meaning the income statement, balance sheet, and what parts of those statements and what data you should take out from that to know how the company is doing. So you can kind of get an understanding. Again, most of these companies won't be doing well at all, but it gives you a good understanding of how earnings should be. So if a stock is about to come out with earnings and you want to try to get a little understanding about the company, it's always good to go through the SEC filings or the financial statements to see whether or not, is this company going to show good earnings, or is it probably going to be a waste of time. So I'll see you guys in the next video. Hey guys, a lot of people ask me, what information I pull from financial statements, or what information do I believe is the most necessary and most influential for the price of a penny stock. So I decided to make this video it's kind of like a beginner video to discuss what's important in a financial statement and what to look at. Now it's important to remember that when we're dealing with penny stocks, most of these companies are going to just have awful financial statements. And I guess by going through these financial statements, you'll be able to see exactly how awful they are and why you would never invest in them in the long term. But I just feel it's still necessary. You should have an understanding of how you're trading. Technical analysis is very important, but you should have some general basis for a fundamental analysis. And being able to kind of look at a financial statement, like the income statement or the balance sheet, and be able to just quickly scan it and know how to read it so you can kind of come to an informed decision about what is going to happen to the stock. So the only time this is really important is when a stock is about to have earnings, right? They're about to announce earnings, quarterly earnings or annual earnings, and you want to try to, you're just looking at the stock and it looks like a good chart, and you want to just kind of get a bit more information about whether or not you should put it on your watch list. So you go into the financial statements to see, do they have a chance of reporting good earnings, which would possibly throw it into the double catalyst rule, which is probably the best and easiest way to just sit back and make money in the penny stock market. So let me do a quick video using Yahoo Finance. I love this site. A lot of my videos are done on it. A lot of the popular penny stock traders use this site because it's so simple, and along the side it has everything that you need all in one place. So let's just get started. So in order to see the financials of a penny stock, you'll see it right here on the side. It's the last category, and it's called financials, and they have an income statement, a balance sheet, and a cash flow. Now, some people again do more in-depth analysis, but I've found it's not necessary. You only have to look at a few critical things. So let's go through that real quick. let's start with the income statement. Now the income statement tells you how much revenue and expenses the company had. So, in basic terms, it tells you how much money the company made and how much they lost. So the important thing to realize, and this is one thing that even people who, I'm an accountant and a CPA, it's sometimes even accountants forget this. The figures don't really mean anything. None of these numbers mean anything unless you compare them to last year. Okay? Everything about accounting and financial information is all about comparisons. Are we doing better or are we doing worse? And that's how you tell the trend of a company, because even though people say, past performance is not indicative of future returns, you have to remember that, even when you think about human beings, when you trust someone or their credibility, that all has to do with their past. And you're judging someone based off of their past. So why can't you do that with penny stocks? But, alright, sorry for the tangent. Let's just go into the important numbers. Alright, so one important number is revenue in general, okay? If the penny stock is making revenue, that's kind of a good sign, because you'll see, this is a NASDAQ company, but it's Plug. It's a NASDAQ company. But a lot of like OTC, BB, and Pink Sheet companies don't even make revenue. But in general, if it's making revenue, it's just a little plus for the company. But in general, the important number is net income. That's what people care about. Net income. Alright, if it's in parentheses, that means it's a negative. Alright, and this is 2012 and this is 2011. So when we scroll down, we can see that this year they had a $31 million loss. Whereas last year they only had a 20. Oh, and remember, all of these numbers are in thousands. Okay? So you add another 3 zeros. Whenever you're looking at Yahoo Finance and most financials, they're in zeros. So this is actually a $31 million loss compared to a $27 million loss. And what that means is that the company has a bigger loss. So it's being less profitable. So if this company was about to report earnings, I really wouldn't have much faith in it, because, again, it doesn't have good, income. It has a bad trend, Things can change, but again, I'm just talking about a quick scan. This is an introductory video on how to tell whether or not you should invest in it. Alright, and then the other thing I go to, some people go into the balance sheet. I used to go into the balance sheet. Let me just tell you how it looks like. But, in general, the balance sheet, what I've noticed is that companies are able to manipulate it, especially these penny stock companies. I know that because I'm an accountant, so the income statement, it's a lot harder to lie in than the balance sheet. But anyways, the other thing you want to look at is the amount of total cash. Okay? Cash is always good. If it has a lot of cash, that's good. Some companies only have a few thousand cash. But, that, again, you have to be able to compare it. So one thing that might be good on a balance sheet is to compare the cash to last year. That would be the only reason I would go to a balance sheet. And then finally, you have, after you click on key statistics, you have this information, which allows you to kind of see the float. And if you guys don't know what float is, watch my previous video to understand float and why low float stocks are amazing and can make you the most amount of money. So you can see here that it has 103 million shares outstanding, only but 89 million float, so that is not a low float, that's a pretty high float. So in general, again, let me just do a quick recap so you guys don't, if you just need a quick reminder. To determine whether it's a high float or a low float, you see the amount of shares in the float compared to the amount of shares outstanding. So if the number is similar, that means it's a high float. The larger the float, the higher it is, duh. But high float basically means that the stock is it's gonna move slower because there's so much more supply, the price moves slower. But low float stocks, because there's less of a supply, the stock moves a lot faster and it's a lot more volatile. But yeah, that's pretty much my introductory video into, financial statements and financial information regarding penny stocks. I hope that helped. I'm going to get obviously a bit more intermediate and a bit more advanced, but that's just the basis that you need, and that in general can help you very much. Alright, well, that's the full course. I really hope you guys enjoyed it. And like I said, this is going to be a living course. So if you have ever have any questions or comments, simply leave a post in the discussion and I'll get back to you, and I'll either come up with a comprehensive video answer, or if it's a quick question, I'll just give you the answer right then. But I'm constantly staying updated with the discussions, and I really hope that you guys get a lot out of it, and the course is going to be available for you forever, so you can always go back and rewatch as many videos as you want and really get a fundamental understanding of the techniques and strategies we use in order to start making a lot of money with penny stock trading. Alright? If you put in the work and the effort, I can guarantee that you will make money. So if you liked this course, then I just wanted to give you guys a little insight into my Udemy profile. Alright? It depends on when you're watching this, but I'm hopefully going to have a lot more students and a lot more courses and reviews in the future. But currently my most popular courses are as below. Make Money Online Trading, Penny Stocks. That's going to give you your introductory course to kind of teach you all the fundamentals of penny stock trading. Then we have Advanced Strategies, where you'll be able to get everything that you need on a high level. So once you understand penny stock trading and you're doing it, you've done virtual trading, which you'll learn from my other courses, as you can see here, then these are the courses that'll really take your trading to the next level. But you should take my other courses before that. And then I also have my VIP secrets. Alright, these are all the observations and lessons that I've accumulated, not only for myself becoming a successful penny stock trader, but in general from my colleagues who are also very good penny stock traders. So we've kind of collaborated and come up with the best courses. Now again, as another kind of exclusive coupon that I'm giving you guys, if you guys go to any of these courses and you're looking into purchasing them, if you use the coupon code VIP50, alright, VIP50, you'll be able to get 50% off. Alright, so there's only a limited number of coupons, so definitely as soon as you check this out, go and check and purchase it right away, because the prices of these courses are only going up and up as more people demand them. Thankfully I get a lot of feedback from my students and they enjoy the videos, and I work really hard to give you guys the best content. So and I see the love coming back from the reviews and the amount of students that come day in and day out and give referrals, so I'm really thankful for that. Also, if you want to see more, I'm also the founder of inpennystock.com, which is basically a membership site for penny stock trading, and it has a huge library of videos. Right now all you got was a taste, but this is the VIP section, and it's the VIP membership service, and it's a whole video library of tons of stocks and tons of videos that teach you exactly what you need to become a successful penny stock trader. So definitely come and check this out too. And I hope I see you guys soon. Take care. Hey guys, I hope you enjoyed the videos and the courses and you learned a lot, okay? Now what you have to do is you're going to have lifetime access to the course, so you'll be able to rewatch any parts that you would like to watch to be able to gain a strong understanding of the material, alright? Because especially in this industry, knowledge is not only power, but it's money, alright? And having a direct advantage from learning all these tips and secrets that I've covered in this course will put you ahead of 95% of other penny stock traders, alright? So you're going to be going in with a huge advantage, and you're going to be going in as a pro. Alright, but the time is now to take action, okay? You went through the course, you watched the videos, now you have to actually apply it. That's where you're going to make the money. Alright? So again, if you have any questions, you can put it in the discussion board, or feel free to reach out to me. I'm the founder, as I'm sure I mentioned earlier, of inpennystock.com, which you can see here. And this is where I put everything up, and you can learn as much as you want from here. And this is really, if you want to go to the next level and take things seriously, this is, the way to go. And I definitely recommend you checking it out, because I'm actually having an amazing 50% sale until midnight.
on the VIP access, which gives you access to all my video courses, all my content, and everything. And if you want to get jump started right away, all right, if you really feel like you relate to the material and this is something that you can do, and this is something that you're interested in, then I definitely recommend the VIP executive coaching. All right, now this is only a very limited program that I have running, and it's a one-time coaching program, and it gives you access to everything, all the content, everything as you can see here. And it's, I think though that there's only one spot remaining actually. Yeah, and you actually get access to an additional VIP account. So you get, it's basically buy one get one free. So if you have a friend or a family member, a spouse who wants to do it with you, who wants to learn with you and trade with you, and in general just go on this journey to financial freedom with you, then this is a program for you. So thanks for checking it out. Like I said, it's inpennystock.com. If you want to even get discounts or coupons, definitely check out the site, sign up. And yeah, I hope I helped. And if you have any further questions, you know where to reach me, either through the discussion board or in pennystock.com through the contact form, or you can email me at admin, which is ADMIN, at inpennystock.com. So I hope I hear from you guys soon. Take care.
Hey guys, so I had some time today and I thought I would just, instead of typing up a recap of what I saw while I was looking at charts, I would just make a quick video on it. So initially I came in around 8:30ish, so kind of when the market was doing this. And initially what I did when I first looked is, I looked at the overnight lows and kind of what was happening first throughout the day. And so mainly what I saw was pretty much we had made a high over here overnight and came down here and made a low, and then we had bounced off of it here. So initially I'm thinking, okay, this is not going to be a trend day. This is going to be kind of a sideways action day. And so I'm going to be looking for kind of more choppy action and not really directional based trading all the time. I'm going to be looking for prices to potentially be failing up here and potentially looking to bounce off the lows here, and kind of ping pong between these two levels in some regards. So I think initially when you first see stuff like that, that's a really big thing to have your mindset right for kind of how aggressive you want to trade in a day like this, just because if you don't have that initial idea of what the market's going to possibly be doing throughout the day, it's going to cause you some issues. And so first thing I saw is the market had, just topped here and then it started bouncing. And so I had drawn a channel here. We kind of had a support line here. And so this first trade right here, I'll just remove this channel for now, was bounce off the highs and then a pretty solid two-legged pullback with a nice signal bar here, and then off of this trend line. And so I thought that was a good enough spot for a scalp. I just went for 2 points. These lines right here are 2 points, so I was kind of looking for 2-point scalp today. And I'm actually also trading, I'm just trying out what the MES actually feels like, and it looks like the MES is really nice on a 1000 tick chart. I wouldn't use a 2000 tick chart just because the volume is lower, and so you need to change it to 1000 ticks to deal with that decrease in volume so the chart moves a bit quicker. And so 1000 ticks, I kind of compared two charts side by side, and 1000 tick on the MES seemed very, very similar to 2000 tick on the ES. And so this is the first trade I took. It scalped and then it looked like it broke this support line. And so from there, I was kind of just sitting and waiting to see, okay, what's this going to do now? Because it looks like, assuming that it's probably going to fail off of this high and we might start to shoot down to the bottom. And then from there, we just broke out of this channel here and then started trending down. And I did walk away from my computer for some of this because I didn't think there'd be a trade in here just because it's so far from the EMA. And so that's not, that's a trade I don't want to take. And then down here, what we have right here is this is a two-legged pullback because it reset right here off of the highs. And then this is a really nice bullish bar, and it's really far away from the EMA. I mean, because these are 2 points, this is basically 5 points away from the EMA. So I thought it was pretty dang likely we were going to have at least enough room here to get a scalp. It is counter trend. And so I, again, wouldn't suggest taking this all the time because it is a very aggressive setup. You can see you can't just take a bullish bar like this and get a scalp when it's far away from the EMA. Because if you look at this guy right here, this is a great bullish bar, and you would have lost a trade right there. So definitely careful on those kind of setups. And one thing as well is it was really close to the lows here. This bottom right here, I actually kind of drew a line off of this guy, and I think it did match up. If we just, I'll just copy this horizontal line. So here, this low kind of matched up with this low. And so I was like, okay, that's another signal that we might bounce here and get a scalp. And so that was, I thought, was a pretty high probability spot. And then bouncing off of there, we had a 2-legged pullback here, and then it kind of looked like it was going to trap people. And I'm thinking, okay, we're at the lows, we might bounce to go back up. And so I thought this was a great spot for a scalp, got 2 points. And then the market actually did decide to keep going down. And from here, another thing that helped with this trade right here was this little support line. So every time the market changes directions, I like drawing a support line for something like this where it's pretty minimal, or once you start to see a swing back and forth, that's when you can start putting in a channel. And so here for this trade, drew a channel here, and then I didn't really like this. This is a 2-legged pullback here that's pretty good. It was an inside bar and I wasn't feeling great about it. And so I ended up waiting for this lower high, and then there's a nice scalp there. And there is technically a 2-legged pullback here as well to the long side that ends up failing. But this was a little too far away from the EMA and close to this kind of low here. And so I skipped out on that, but I was perfectly happy with taking this trade right here. And that worked out great. And then the bottom of this just falls out and we actually test those lows here. And so you don't know that it's going to bounce up here and go all the way back up. So you're not going to just buy blindly, right? You're going to still wait for a setup, but you're going to have that idea that, okay, we could be bouncing here and going back higher. So here was a 2-legged pullback. It was a outside bar that was a little aggressive, and just off of bouncing off the lows, I'm not going to want to take that. I'm going to assume that things might fail and go to the upside. And there was kind of a really big trap right here, but there wasn't really a great setup for that. And then from here, you can see the market does start to kind of break up from there. And initially to draw this channel right here, I saw it off the high. So you can see here, after about here, you can see, okay, there's probably some kind of channel here. Obviously, there's not enough data on the bottom to draw it off of. And so I just drew it off the top. And so I just went from here, drew it like this, and then matched it to what would probably be down here, assuming that maybe it's bouncing off the midline. And it looks like it was. And then so I just drew that further. Let me just redraw that again. And so that kind of helped me out with this trade here. And so I'm not going to take any of these. So this is technically a 2-legged pullback to the short side, which did fail here. And you could get a scalp there, but right, you're against the top of the channel. You're far away from the EMA. That's just not a good setup I want to take. And so here I'm going to probably wait for a 2-legged pullback or something at the bottom of the channel or closer to the EMA, right? And so here that exactly happens. You have a 2-legged pullback. This is a nice signal bar right here, and it tests the bottom of this channel here, and it's right at the EMA. So I went for a scalp right there that worked perfectly. And here, actually, I started closing up after that because I was like, I'll just be done for the day. And here was actually a higher low. This wasn't a great signal bar, but that you could have taken a trade right there as well. And then you can see from there, it did take off. And now it looks like it broke the channel here. It might retest. And then so I'm not sure where it could go for the rest of the day. It could start to just chop here. It looks like we are potentially butting into this resistance right here. And so maybe we'll just chop at the lower of this channel. Maybe this is some midpoint here from this channel, but we might go up to the top too. And so that's all I got for the day. Hope this was helpful, and have a good rest of your day. So today had some really good lessons in it, and so I wanted to do a quick chart review for it. And so I came in around 8 o'clock to look at the charts right in this area. And initially, of course, what you want to do first thing of the day is kind of look at where the overnight lows and the highs are, right? And so here, I'm just gonna, this is the overnight high, because here's the open right here. And so I'm gonna look at a high, and so that's the overnight high there. And then I like to just change this to be a different color. And then I just moved that down to kind of this level here. I had already seen this bottom here, but if you started it earlier than 6:30, you would have seen that, okay, there's a low here. You could have just put it there, and then you would want to be kind of cognizant of the previous action from the day before, but kind of this is what you want to be looking at. So here, this is a price range, right? And so what you want to do is you want to be aware that it's going to have trouble breaking out of it, and if it does, it might signal a trend day. And so going forwards in the market kind of came 6:30, sold off, and then bounced right off the bottom and just ejected right out the top of it. And from there, you just want to be drawing your general channels. And so one thing I saw happening right as I came into the market was we kind of started to have, what looks like a little downtrend right here. You could even draw a channel. It didn't really fit very well. There's kind of a channel here, right? And so coming into this, you could think, oh, we broke out of the highs, and then now we're starting to trend back down, and maybe we'll go back down. But the big thing here is having this huge sell up here, kind of a flag out and then break up. And so what you're going to want to be aware of is that we might come back down to this level and just bounce right off of it. And so when I came into trading, I saw this is how you can stay out of something like a two-legged pullback right here that might not work very well. Or what happened was also a lower high here happened, and the market reversed on you. Now, there could have been room to scalp out if you were scalping small enough, but this is kind of how you stay out of those bad trades that seem to line up in every way and then turn against you. And so this is one of those big things was, well, we had just came down and bounced off the overnight highs. And from there, you can expect, or with reasonable chance, that we're probably going to keep going up from there, seen as if we zoom out again, the overall trend is up. And so that's where you want to stay out or be aware of things. And so another thing here is quite often this channel we have right here will turn into a midline, and you'll have kind of the top of the channel up here. And so what we can do is we can actually draw a channel line off of here. And then this is only once you kind of have the data, but then match it up here at these highs, and you can see that it can kind of start to form a midline, right? And so it's a little wonky, but here's the channel, and then here's that midline, and we bounced off that midline as well. So you don't necessarily need to do that, but this is one way to kind of get a price target as it breaks out of here. You would know that, okay, this could be just half of the channel, and so maybe we'll move up another half of that. And you can see we did pretty much make that without having that channel knowledge beforehand. And then the market did decide to just break out from there. And so this can be this was really hard to trade, because for me, after it had bounced off of this, there was really no solid channel to draw or trade off of. It kind of started to make a channel here, and then it eventually broke out the top. So this was kind of the channel I had. And then we see we have an overshoot. And then here is our two-legged pullback, but there was a bad bar there. From here, you did kind of go up, but none of the trades in here were really good. And so that just happens. Sometimes you're not going to get a solid entry. What we want is a solid two-legged pullback here. And if it doesn't happen, we kind of just have to miss out on things. And that's just how it goes. And so from here, drawing back, another thing I actually saw was, I believe I drew a ray off of right here. And so you won't always have a kind of a really good trend. But this kind of, we actually look at how it did for the rest of the day, it kind of kept the market under wraps for a little while. And so from here though, it kind of showed as it broke out of this, it kind of broke here out of the ray and then came back. And this was a trade I did take today. After breaking out of this, it kind of did a two-legged pullback. We have a nice bar here. This is a good signal bar because it does, even though it's red, it does show that reversal pattern of opening here, selling off, and then closing here. That still makes a red bar that looks like this. I guess previously it breaks up here and then sells down to make this little wick here, but that's still a good signal bar. And then so this gives you a scalp. We're at the EMA, trend is up, even though we did kind of break out and make a new high here. Because I felt that we broke out of this, we're going to expect it to come back, retest, and try and make a new extreme. I was using the overshoot rules at that point. And then from there, the market decided to just kind of go into chop mode. We're not going to take a two-legged pullback to the short side here because the trend is really strong today. Pretty much on a day like this, you're going to want to look for longs. You're going to get in trouble if you try and take traps to the short side or try and short anywhere, because a lot of the time those are actually just not going to work on you and they're going to end up going long, even though it seems like it was really close to working out in your favor. And then so here, once you start to see this, just start to draw some horizontal lines and try and see just where the support is, where the resistance is, to see where you should be trading in this kind of range. And so if we look through this, nothing really gave a solid two-legged pullback. Here's a two-legged pullback, but this right here is a really bad signal bar, and it's not really at the lows. And so we're going to want to try and buy off the lows right here, right? And so this bar right here, this wasn't a two-legged pullback because we hadn't had a reset off the high. So this was more like a 5-leg. And then down here, this was a two-legged pullback again, but again, the signal bar wasn't great. And then the market kind of broke out here. And so from here, one trap that happens to a lot of people is at this point, it looks like, oh, maybe we're breaking out and we're going to keep this trend continuing up. And so here was actually we failed to break out. And so this can be a point where you can short because the breakout started to fail, but because on such a strong trend day today, it's not a smart thing to do that. Just because the market can suddenly decide to reverse on you just because the trend is so strong. Again, we always want to be trading with the trend. And then along here, you can kind of just extend these lines out to see what the market does at these levels. Just because you don't know if it's going to continue holding this support level. The market looks like it was going to make a failure here too. Sometimes the market likes to make a channel here, fail out this side, and then come and fail out this side, and then continue up. And that seems like that's what happened today. And so off of these levels down here, when you kind of see that happening, you're going to want to wait for a two-legged pullback trap. And so here, this is that two-legged pullback trap to the short side, but because it went all the way down here and then reversed, it didn't end up being a trap. And so the trade didn't end up working out there either. And so a day like this can be very frustrating when things get so close. You see a good area to buy and the signals just don't perfectly line up. And then you see, half an hour later, it kind of went the direction you knew. That's just how trading goes. Today, the market was very slow and choppy and a lot less volume than the past couple of weeks have been. And that can happen. And so for me, when I saw that happen and when it started getting this area and this trade didn't work out, I decided that I'm just going to close up shop today because I can tell that the market is just being very slow and sluggish. And so a trade is probably not going to show up for me in the next half an hour that I have to trade, just because it was 11:30, and at 12, because I'm on Pacific time, there's only 1 hour left in the trading day at that point. And at the last hour, that's kind of our rules. At the last hour, last half an hour, you don't really want to be trading anymore, just because things can get a little crazy. And so I ended up just calling it, because I knew at that point I was getting antsy. I had only taken one trade for the day. And at that point, you're going to say, my goal is to get 2 to 3 trades a day, and I only have half an hour left. I'm going to have to try and force a trade. You don't want to put yourself in a situation where you feel like you have to force a trade, because then it's going to affect your decision making, and you're going to make a bad decision and probably end up making a losing trade. And even though I only made one trade today, it's still one trade that you win. You're still 1-0 for the day. It's still a positive day. It's better than going 1-1 for the day, right? Even if I could maybe go 2-0 for the day, I would rather make sure I stayed going 1-0 for the day with the fact that there wasn't much time left in the day. And then you can see right here, if you look at the timestamps, the market, this was half an hour in the market. And so the market started to go really slow towards the end. And then once we started to get to that 12 o'clock time, the market did start doing crazy things. And so this is why we don't really like to always trade at the end of the day, is even though there is kind of right when this rocket started, this is the last 10 minutes of the trading day. The market did a lot in the last couple minutes of the day. Like right here to here is the last 10 or 12 minutes, and over here this is 40 minutes, right? This is half an hour, 40 minutes. And you can see the market sped up a lot, but that's not what we're looking for, right? That's not predictable, methodical movement that we can't consistently understand what's going on. This is when, come the end of the day, there's a lot of people either buying at the end of the day, there's a lot of shorts closing out at the end of the day. There's a lot of stuff going on that's happening that's affecting the market in very volatile ways, and we want to avoid that if possible. And so today I thought the big takeaways was understanding this overnight level really came into play today, especially if you wanted to look to short here. I think knowing this overnight level and that we were breaking above it and that it's probably, we might come and bounce off it, that's a really strong way of showing you that we're on a trend day that's probably going to keep going up. And then as well, once we kind of got into this chop, understanding that we are in chop, and you got to be very careful of when you take an entry, because even though this channel here, my horizontal lines are 2 points right now. This is 16 to 22, 24. This is an 8-10 point channel. There's definitely space in here to trade, but you have to be waiting and trading, trying to buy off the lows and sell off the highs, because that's where you're going to have that higher probability setup. And if that doesn't happen, then you just got to call it quits. And if you get towards the end of the day and you haven't got as many trades as you want, I would call it quits sooner than you think as well, just to maintain that clear level headedness and understanding that your itchiness to get as many trades as possible throughout the day might force you into a bad decision. Hey everybody, so today I thought was another really good learning day to do a recap video on. And so today, the market today was an uptrend day, but it definitely had kind of middle of the day was some chop. And so it was really good day to figure out how to switch between trading in an upward, a really strong upward trend, to figuring out how to trade in a sideways trend. And then we did continue that upwards trend kind of into the end of the day. So first things first, as usual, whenever you start trading or coming into the day, is looking at where the overnight highs and overnight lows are. So that's what these yellow lines are here. And so these are just key areas that I think are going to be resistance into the day. And so what we did was I came in around 8 o'clock, but the market did open up around here. So at 6:30, that pretty much put in the overnight high. The overnight high was essentially at the open. And you could potentially have had it down here a little bit, but it kind of did the same thing. But again, resistance lines are a lot like zones. And so if you have it in the general area, that's good enough. And then the market sold off. and then started in this strong uptrend. And then, so this is kind of where I came into the market today. And I don't really like to talk about the market before I came into it, just because that's just looking at a chart previously, and I don't really know what the market felt like while it was actually live. And so I feel like I can do a better job at explaining to you what I actually was seeing during the actual market. And so first off, when we came up to hit this high right here, keep in mind that this is an overnight high level, potential strong resistance. And so we want to be careful of taking trades off this. And so we only want to be waiting for really strong setups. And so the first kind of one here was this setup I saw here was just drawing. We had a pretty solid channel off the lows here. And so this channel actually traded for a while, which was really nice. And so if we just zoom in on this, this is a two-legged pullback right here. And so what we're looking at is, here's a new high. This higher is one tick higher than this one. And so this counts as our new high right here. And then so we're just going to count off the highs, one leg down, two leg down. And so here is our two-legged pullback. And then here's our signal bar. We have a really strong signal bar. We're pretty close to the bottom of this channel here. We can't super confirm it just off the lows, but having these matching highs is pretty good confirmation for this channel. And then of course, breaking below here and then trading right at the EMA is a really solid bar. And so going long right there and scalping out is a perfect setup here. And so I am still trading for 2 points here, just because the market is pretty volatile and we can't really just go for that 1 point, because our candle here, this is more 3 or 4 point candle. And so you got to adjust your profit loss for the stop you're taking. And then from there, the market kind of just went up. And when you kind of get up here, I'm not really looking for trades that much, because you're just far from the EMA. And when the market does a move like this, your chances of going into a sideways chop back to the EMA or having some kind of sell-off like this to the EMA is likely, right? And so what we want to do is we want to wait for either to come to the bottom of the channel or come back to the EMA. And of course, we want to be looking for that two-legged pullback. And so here we can see we're butting up against the top of the channel. And then here, this is a new high. And so we've reset the count right here. And so we have one leg down, two legs down. And then here's our signal bar. We bounce off the EMA. We have room to the top of the channel to scalp out. And so this is another really solid setup. And so this is a good point to scalp out as well. And then from there, the market just takes off and we actually break out of the channel. And so when we see an overshoot, we're going to look for the trend to potentially change and the market to potentially come back and test the bottom of this channel. And so here the market did break out and then start to go here. And we actually made a double top here too, which is a pretty strong resistance level. So we're actually going to draw a resistance line here. And so I like to take away the drawings that I had previously, just so I can kind of show you guys in real time of looking at the chart. And then also down here, you can kind of draw I think this actually turned into a tiny little channel right here. And so that's another, you can start seeing, okay, we're in a down channel. I'm not going to try and take a long into this resistance. I'm going to kind of wait to see what the market does and where it breaks out potentially. And so right here, you did have a two-legged pullback to the short side, but the signal bar wasn't amazing. And with the fact that we are in a really strong uptrend, you're not going to want to start shorting really yet, because we might just break here and then start going up and continuing the upwards trend, or we might start to go into a sideways chop. And so when the market started to bounce here, you could start saying, okay, maybe we can start looking for longs, but we also want to be aware of this resistance up here, right? And so the market started to slow down a lot as well. And so feeling that speed, you can start to understand that the market is getting a little choppier too. And so here the market just started chopping around. You can see that it sold off right here from this high, and then it actually bounced and broke above it. And so from there, this can kind of look like a breakout. And so this is one reason why we don't trade breakout strategies, is because this is a really strong resistance level, and you can see it did break out above it, but right after it sold off back into here pretty quickly. And so that's why we don't be taking trades like that. And so from here, the market still started to get really choppy. I think here is one leg, two-legged pullback, but the signal bar was really bearish, and so we're not going to want to take that one either. This actually turned into an inside bar as well, so that was a trade we wanted to skip out on. Plus it was below the EMA, and seeing as we just broke about above this and failed, we might actually start going down. And so at this point, the trend is looking really choppy, and we want to be very careful on what trades we're looking at. We need to be shifting our mindset from what it was over here. When you're in this really strong uptrend, you can be more aggressive with taking pretty much any two-legged pullback you see that hits the trade entry guidelines. But once you see the market starting to look like this, when it starts going into, chopping down below the EMA, chopping above the EMA, breaking above resistance, and then failing back below it, then you can see, okay, the market is not trending in a direction very strong, and you can start to look for trading off the highs and then trading off the lows. And so at this point, we can draw a potential channel here off of these highs and look for stuff to come up here and sell off of this. So that's what I did for this trade right here. This is kind of our midline here, this channel. We're just drawing this bottom of this channel down here because we want to see if the market does come and touch there. We don't know that, but we're at least using this upwards resistance line to start to gauge that. And we can see it bouncing off the midline here. And so for this trade, you can see the market bouncing off of here, and then what it does here is it makes a two-legged pullback. And so why I would be looking out for this trade, and why I was looking out for this trade, is because we have had this resistance up here and we failed up there twice already, and we're starting to look very choppy. And so what this is we're far from the EMA. We can get a scalp here. We're not super far, but we are far enough. And then the fact that there's a two-legged pullback to the short side right here, that allows us to have that two-legged pullback entry. And then the idea is we're not exactly with the trend, but the trend is essentially chop in the center. And so that's why we're expecting that the market is going to go back to that center or that EMA area. And so this is definitely a more advanced kind of trading. And so if you're a beginner, I wouldn't suggest taking trades like this. They're very hard to spot and very hard to understand, but it is something that you can be looking out for. Now, another thing is you can see right here, these two adjacent bars, they made a double top exactly. And so that is a really good sign as well. The market, if we look at these two bars, the market essentially opened on one, went up, closed, and then the other one opened, went up, and closed. So you have a double top there just with those adjacent candles. And then from there, the market just sold straight off and into this. If I can draw this channel a bit or extend it just so we can see it a little better, we started to push really far into the bottom. And then what we have is this is a really strong downtrend, and then a one-legged pullback, and then a two-legged pullback. So this right here is a two-legged pullback to the bottom of the channel. Now this is a pretty good signal bar here. We have room to scalp out because we're far away from the EMA, but because this is a really aggressive trade, we want to be very aware of this and understand that we don't need to go for that full 2 points that I've been going for recently. You can kind of adjust because this candle is pretty much just 2 points. You can just go for 1 point here. Now, the reason why we can take this, and this isn't necessarily counter trend, is I'm assuming that we are in an overall choppy trend here, and that this is just buying a two-legged pullback at the lows of the channel. Now you can see here that scalp did work out, but then it did start to chop. And so at that point, I kind of just want to stay away from things and wait to see what it's going to do, right? It might then break out here and then trade up, or trade up from there, or it might break the bottom of the channel, right? And so from here, it started to look like it was going to break back into the trading range, which is really good. But the market did decide to sell off again and make another two-legged pullback here. And so this was another essentially choppy trade, or a sideways trend trade, with a two-legged pullback off the lows of the channel. And so this was a good reversal bar. It is red, but again, still opens here and then trades down and then closes here. So that's still saying it's reversing. And then it's a two-legged pullback with decent room from the EMA. And so here again, you can just go for that 1 point scalp basically, because this signal bar is on the smaller side. And then from there, the market ran up and it started to just push higher here. And so here, you can just draw a line off of these, and you're just going to kind of wait for it to get to the top of the channel again and see if it makes another setup to short off of from the highs, right? And so here, with this channel line drawn here, you're not going to want to take anything in the middle of the range, just because that's where you're usually going to find support and resistance. And so it's not a good spot to take a trade. So even though here was a trap, a two-legged pullback to the downside, with this being the first leg and then the second leg technically off of this, right? It's just too risky to take it in here just because it's very choppy. So at this point, you're kind of just wanting to sit on your hands and knees and waiting for the higher probability areas to take a trade. And then once we get up here, we do make a reddish bar right off the highs, but we want to be waiting for that setup, right? In terms of over here, we had that two-legged pullback right at the highs. That is what we want to wait for. But here, we didn't actually have a two-legged pullback to the highs. We had something like this was a third-legged pullback from the highs right here. And so that's a trade you're going to want to skip at, because we did just break the bottom of the channel. We can expect that we might break out the top of the channel now. And so that's also another reason to not aggressively take any red candle you see at the bottom of this channel we have. And so from here, you can see the market then did decide to rocket up and then go up from there. And then we did start to resume that previous trend we had. And then you can start to draw channels off of either down here, see if those match up. And so here's a channel initially, and you can see then we had a trend break here. And so this is when you're going to look for it to make a two-legged pullback, because it's breaking the channel. You want to look for a two-legged pullback and then to continue with the trend potentially, or at least give you an area to scalp out before it starts to change direction, right? And so what we had here, this was a two-legged pullback, but the problem is this ended up being our signal bar, and because this one didn't quite break lower, and so this was technically a bad signal bar right here for a two-legged pullback. And so you just have to skip out on that trade, which is very frustrating, because essentially everything here lined up perfectly. It's at the EMA. We just broke, so we're going to expect it to make another trend push higher. And then you just have this signal bar barely miss out. And so that's something that is very frustrating, especially when you don't take a trade through this whole move up and then see this happen. You're waiting for it, and then it doesn't work out in your favor, and you just have to skip on it. And dealing with that FOMO and controlling that can be really hard. But again, that's what's going to keep you on the right side of the trade most of the time. Is even though it worked this time, sometimes this will get you in trouble, and maybe this would fail and it would actually trap people and it wouldn't work out. And so that's how you avoid getting trapped, is taking ones like this that don't have a good signal bar, because they don't hit our checklist right. And if they don't hit our checklist right, they might fail more often. And so that's what that is there for you. And that's why don't take these kind of setups, because it's more likely you're going to get trapped. And then from here, this was kind of the 12 o'clock hour or the last hour of the trading day. So I kind of stopped from there. And the market kind of just started to do a volatile thing towards the end of the day. And so that's kind of why I like to avoid that, is because trading in this kind of crazy whipsaw motion, it's very hard to predict. And then the end of the day, actually the market just essentially is just closing. But that's why we don't really trade in the last hour, last half an hour, is because things start to get very inconsistent and not easy to predict. So this is kind of what the overall day looked like, though. We went up and then chopped and then went up again, and then the end of the day kind of did its thing. And so that's what happens a lot of time. And this is a strong trend day. You're not always very rarely you're gonna have a strong trend like this, and then it just keeps going up the whole day. This right here is just essentially consolidation in the middle of the day, essentially a larger time frame pullback, and expect that to happen. And taking a counter trend trade and taking a short trend trade like this is still aggressive on a larger uptrend day, but definitely trying to buy the bottoms right here is a little bit better, just because that overall upwards trend.
Hey guys, welcome back to Start Trading. My name is Quinn. Today we're going to be getting into our day trade strategy PDF, showing you guys how to execute our day trade strategy so that you guys can become highly profitable traders yourself using our back-tested system that's supported by data. Alright, so first let's get into our table of contents. We have chapters 1 through 5. Next to each chapter we have our page numbers listed so you can review at any time. Next, chapter 1, Trading Certainties and Volatility. So in this chapter we'll be going over our equity curve model of our day trading strategy over 1,000 trades, roughly 2 years, and our trading strategy statistics, and how knowing these statistics for your strategy can help you become a better trader. All right, let's get into our account statistics and variables for our actual equity curve model. So for this equity curve model, we are starting out with $1,000 capital. So what that means is that at zero trades, we are starting off at $1,000. We are assuming an average of 2 trades per day, 44 trades per month, and 504 trades per year. We are assuming this average based on the average number of trades you can expect to see on a daily to monthly to yearly basis. And we are assuming perfect execution for all these values. I'll get into what perfect execution looks like in chapter 2, but essentially it is just following our entry and exit rules. Next is our equity curve. So we have 1,000 trades, roughly over a time span of 2 years. Down here on our x-axis, you can see 0 through 1,000. This is going to be the number of trades this equity curve model goes through. All right, next we have 100 simulations. Each one of these lines is going to be an equity curve simulation that calculates our win rate, risk to reward, and our risk per trade. All right, and what you guys will notice right off the bat is that no matter what equity curve simulation you are, you still have a highly profitable system. All right, so all you guys have to do is follow our entry and exit rules and you have a highly profitable system. You will be one of these equity curve lines. I cannot tell you exactly which one because it depends on market variance and trading variance. But in the end, this is a highly profitable strategy. All right, now let's get into our trading strategy statistics for our actual strategy. So your win probability or your win rate with this day trading strategy will be around 60 to 70%. What that means is 60 to 70% of the time you will have a winning trade. Next is our average win to loss relation, which will hover around 1.3 to 1 or 1 to 1. What that means, risking $100, you stand to make about $100 to $130, and you will win 60 to 70% of the time. Next is your risk per trade. We only risk 1% for good conditions and 0.5% for bad conditions or after a string of losses. So typically most of the time you'll be risking 1%, and during a large string of losses, we recommend to size down to 0.5% until you get back onto a normal win rate. Never risk more than 2%. All right, next is going to be our minimum equity, this equity curve model experience. $915. This is the minimum equity of the simulation. If you executed perfectly, you would have lost around 9% right off the start until the system regained those losses. So you can see down here, $914. This is the lowest price out of 100 simulations an equity curve model reached. So that means right off the bat, drew down 9% to $915 from $1,000, regained those losses, and continued higher. All right, and our maximum equity, the $112,980. This is your maximum equity over a 2-year period of executing perfectly. So over 0 to 1,000 trades, the maximum equity of this simulation was $112,000. Remember guys, this is starting off with a $1,000 account, roughly over 2 years. Next is your average max drawdown, which is 8.9% is your average max drawdown if executing perfectly. It's perfectly normal to lose 9% of your account over time during drawdowns. A 9% drawdown is a pretty light drawdown and easily manageable. All you have to do is keep executing the strategy and following the rules. Your strategy will regain those losses and continue higher. All right, next is our biggest max drawdown, which is 16.8%. Your average max drawdown if executing perfectly. It's normal to lose 16.8% of your account over time, but usually rare. So one tip is that when you get to the statistical outlier of 16 to 17% drawdown, or even before that, around 12%, anything over 9% of your average drawdown, size down. Only risk 0.5% per trade until you get back on track. Next is our average performance, which is 4,480%. This is your average performance over 1,000 trades. This is not compound annual growth rate. The compound annual growth rate, which is what I prefer to look at because it tells you how the strategy performs on a yearly to yearly basis, which is around 200% after fees, mistakes, and slippage. Remember, there'll be small variance between live trading and our back test. Next is our maximum consecutive winners. So with this strategy, using a 60 to 70% win rate, on average, the maximum consecutive winners you will experience is 20 consecutive wins in a row. Next is your maximum consecutive loser, which is 11 trades is your maximum consecutive losses with this strategy. Now, again, this is another important statistical outlier that will be able to help you with your trading. So if you lose 11 trades in a row and you know you're at these statistical outliers, size down, risk 0.5% until you get back on track. It's important to know these statistics for your system because how else would you know if you're doing good or if you're on track or not? All right, guys, that pretty much sums up chapter 1. Thank you guys for listening. I hope that helped you guys out. Have a great day. Hey guys, welcome back to Start Trading. My name is Quinn. Today we're going to be going over chapter 2, trading setup, showing you guys how to execute this strategy. All right, so let's go over why this strategy works and how to find the setup, entry, stop loss, and take profits. This strategy aims to identify pivotal points using 2 standard deviation indicators such as Bollinger Bands and Keltner channels. These are going to be the 2 indicators that we use for the strategy. All right, 70% of the time markets are mean reverting and 30% of the time they are trending. How can we exploit this? With a mean reversion strategy. Here are some facts on mean reversion strategies. First of all, they have high win rates, upwards of 60 to 70 plus, but usually no more than 80%. They usually make just as much as they risk per trade. If you risk $50, you will make $50 on average, so a 1-to-1 risk to reward ratio. Mean reversion strategies are some of the best day trading strategies due to the fact that markets are usually mean reverting intraday and trending over higher time frames, as well as the fact that they mean revert or are in a range nearly 70% of the time. So this is what we're trying to take advantage of. All right, the strategy has a mid to high trade setup frequency and short to mid-term hold times. This somewhat depends on what time frame you're using the strategy. Again, the strategy works on all time frames. So if you're trading this strategy on a 5-minute time frame, your hold times are going to be much less than if you're trading the strategy on an hourly time frame. Next, it works on equities, futures, Forex, crypto, and options. It works best in a ranging market. So when the market is trending either up or down, it is best to either sit out or take mean reversion day trade setups that is going in the same direction as the market. So if the market's trending up, it is okay to take mean reversion setups that are on the long side. Next, it is best used in combination with our swing strategy when the 10 MA crosses the 20 downwards to allow yourself to still be able to take setups. But what we're saying here is this strategy is really helpful during bad market conditions. So when we are in a bear market or a decent correction and we're not in a period of easy money making on the swing side, you can use this day trade strategy to still stay profitable every single day. All right, for equities and futures, it is only recommended to take it from market open to about 2 hours. In backtests, show P&L and win rate drops as market time develops due to lower volatility. Best times for profits are in the morning. So basically, using our backtests and collecting data, we found that the first 2 hours of market open is going to be the best time to use the strategy due to the volatility in the first 2 hours and liquidity. So basically what we're saying is we only recommend trading during the first 2 hours. After the first 2 hours of market open, pretty much stop trading because the win rate drops. It is still a decent win rate, however, it drops close to like 60%, whereas in the morning, it's closer to 70, sometimes higher win rate. So we only recommend trading the first 2 hours. Now, for 24-hour markets such as crypto, Forex, feel free to trade the strategy anytime on any ticker that is liquid. But most importantly, you have to double check that it's liquid, and liquid on the time frame that you choose to trade it. So for example, Bitcoin will most likely be liquid on the hourly and lower time frames. However, it might not be liquid enough to be able to trade this on the 1 minute charts or 5 minute charts, and definitely not for any other crypto that's not heavily traded. So you got to keep in mind, you want to make sure that it's liquid on the time frame that you're trading. All right, it is recommended to trade the strategy on the index or blue chip big cap names due to the higher rate of mean reversion. So Apple, Tesla, SPY, QQQ, etc. So you want to be trading, again, names that are heavily traded. You want to be in super liquid names because they are more likely to have follow through on these mean reversion setups. If you notice a strong trend on the daily chart, it is recommended to sit on your hands and switch to our swing strategy instead. Basically what we're saying here is if the market is trending up, switch to our swing strategy instead because it's going to be a good period for swing strategy. However, it is definitely still okay to be taking day trades on the long side. However, we do not recommend taking day trades on the short side if the market's trending up. Same thing as day trades on the long side if the market's trending down. All right, it is recommended to use a strategy on the 5 or 3 minute time frame for day trading. We found that the 5 and 3 minute time frame has enough setup frequency and hold times be just about right for day trading. All right, below we have what our trading setup sequence looks like. Each step to our trading setup that is required is labeled 1 through 7. All right, so when you guys set up your guys' chart to be able to trade the strategy, you'll have these two indicators. These two blue lines in the middle black line is going to be your Bollinger Band indicators, all right? This black line is basically just a 20 moving average. Next, you see these two red lines. These two red lines is going to be our Keltner channel indicator, all right? But first, step number 1 of our sequence, market opens. Trading during market open hours is required as volatility is high and liquidity is high. Next, the second step is that the Bollinger Band blue line must contract inside the Keltner channel red lines. What this tells us is that the volatility is low and a break is about to happen in either direction. So you see here, the Bollinger Bands on each side are outside the Keltner channel. Yes, outside the Keltner channel. The Keltner channel is inside the Bollinger Bands. And then you see here, the Bollinger Bands contract and go inside the Keltner channels. Now the Keltner channels are outside the Bollinger Band. So this is what you're looking for. This is your very first sequence besides market open. The Bollinger Bands move in either on both sides or on one of the sides, move inside the Keltner channels and contract inside the Keltner channels. You'll see this on all of these setups. It moves inside just like that. Next, number 3, the third step is to wait for a break in either direction. In this example above, the candlestick closes above both the Bollinger Band and Keltner channel, showing us it will possibly make a short setup. So we'll run through this again. Market opens, Bollinger Bands move inside the Keltner channels. Then we get a candle, an extension candle that closes above both the Bollinger Band and Keltner channel. And then we get this inside candle right here, which brings us to number 4. The fourth step is you must wait for an inside candle. The inside candle means that the body of the candle is inside the candle that closed outside both the Bollinger Band and the Keltner channel. Wicks can be ignored for inside candles. So basically what we're saying is this is an inside candle right here, another extension candle closes outside, and this is another inside candle right here, a candle that can fit inside the previous candle. All right, number 5. Once an inside candle has been formed, we now have our entry point. In this specific case of it being a short setup, it is the low of this inside candle. When the next candle breaks a low, we short. So let's run from the top. Market opens, Bollinger Bands move inside Keltner channel. We get an extension candle, closes outside both the Bollinger Band and Keltner channel. Then we get an inside candle, then we continue higher, then we get another extension candle that closes again above the Bollinger Band and Keltner channel. Then we get another inside candle, and then what's different here is that the low of this inside candle is taken out. You see here, however, this was an inside candle, but the low was not taken out. So the inside candle we use for our entry. So you wait for an extension, close, then you wait for an inside candle. Once the inside candle is closed and it moves to the next candle, you take the trade as soon as the next candle breaks the low of the inside candle on the long side, or I'm sorry, on the short side, and then you set your stop loss at the high of the inside candle, which brings us to 6. Our 6th step is to set a stop loss to manage our risk. For the specific case as a short trade, it is set at the high of the inside candle. On a long trade, it would be set at the low of the inside candle. Next, our 7th step is the easiest and also the hardest. You wait until the trade either stops you out or price hits the 20 moving average on the Bollinger Bands, the black line. Once price hits the middle line, take all your profits and the trade has been completed. All right, so let's run from the top again. Market opens, Bollinger Bands move inside the Keltner channel, your first signal. Then you get an extension candle that closes outside the Bollinger Band and Keltner channel, second signal. Then you get an inside candle, third signal. And then the fourth signal would be a break of the low of the inside candle. This one, it continued higher, did not break the lows. Then we got another extension candle, closes outside both the Keltner and Bollinger Bands. Then we get another inside candle. And then on the next candle, you can see here, the low is broken of the inside candle. The second the low is broken of this inside candle, we enter our short position and set our stop loss at the highs. And then from there, we wait. Either the stock reverses and stops us out at the highs of the inside candle, or we stay short and we take profits at the middle line, the black line. It's as simple as that, guys. Take profits when the price hits the 20 moving average. Enter your trades when it breaks the low of the inside candle on the short side. Set your stop loss at the high. All right. In this specific trade example, let's assume one has a $10,000 account. They take this trade risking 1%. They would have made 1R, 1 times their risk, or $100 in less than an hour on one trade. This is the power of trading. Let's take a look at some more examples. In these cases, we will have our entry, stop loss, and take profits shown in green and red boxes, example below. So this is an indicator that we have on TradingView that tells you exactly how many contracts using futures that you can purchase using the entry and stop loss. So basically, you set this middle line at the entry of your inside candle, and then you set this one at the stop loss of your inside candle. So this would be for a long trade, right? So the high of the inside candle would be right here, and the low of the inside candle would be right here. On a short trade, the high of the inside candle will be the stop loss, and the low of the inside candle will be the entry. And then the green, you extend the green down to the middle line where you take profits. Here we have some more short trades on the index resulting in 1.5R for the day. All right, so you see here, Bollinger Band moves inside the Keltner channel. Extension candle that closes outside both the Keltner and Bollinger Bands. Then we get an inside candle. Then the low of the inside candle is broken, and it falls through to the black line, and you take profits. You can see here how the stop loss is set up. High, low for entry, profits. And then again, it sets back up. Bollinger Band moves inside the Keltner channels. Then it goes above it. Then we get an extension candle that closes outside both the Bollinger Band and the Keltner channel. Then we get one inside candle. The low is not broken. Then we get another inside candle. The low is not broken. Then we get another inside candle and the low is broken. The second the low is broken on the inside candle, we enter our trade and we take profits at the middle line or stopped out at the high of the inside candle. As simple as that, guys. Now we'll go through a bunch more examples. All right, so we've got Bollinger Bands inside Keltner channel. Extension to above the close, above the Bollinger Band and Keltner channel. Then we get an inside candle right here. Then we would plan to take our entry the second the low is taken out, stop loss at the high. Low is taken out of the inside candle. Enter our trade. Looks like the trade's going well. Looks like it's showing some strength. You might get scared, but no matter what, follow the rules. Follow the rules. Ends up rolling back over and you take profits at the middle line. Again, this is a trade to the long side. So you see here, Bollinger Bands inside the Keltner channels. Extension candles to the downside. This is going to be your candle that closes below the Bollinger Band and the Keltner channel. Then you have your inside candle. Stop loss would be at the low. Your entry would be at the high. It takes out the high of the inside candle. You set your stop loss at the low and you take profits at the middle line. Now let's take a look at the long trade. The long trade is the same exact thing as the short trade, but in reverse. The candle closes below both the Keltner channel and the Bollinger Band. This is the long trade. Alright, 1. The candle closes below the Keltner channel and Bollinger Bands. An inside candle is printed, open and close the inside candle nested within the high and low of the previous candle. A break of the high of the inside candle happens, triggering a long entry. Once entered, place stop loss at the low of the inside candle and take profits at 20 moving average, black middle line. Let's look at some more trades. Alright, so this is going to be a short trade. Bollinger Band, you see here how it dips inside the Keltner channel. This is what you want. You want to see it pinch and contract inside the Keltner channel before you get a candle that closes above both these indicators. So the Bollinger Band pinches or contracts inside the Keltner channel. Then we get an extension candle, closes above both indicators. Then we get an inside candle. Then the low of the inside candle is broken. A stop loss is set at the highs. We take our profits at the middle line. Again, short trade. Bollinger Bands inside the Keltner channel. Bollinger Bands inside the Keltner channel. Right here and here. Extension candle. Inside candle. Low of the inside candle is broken, which is our entry. Stop loss at the high. Profits at the middle line. Here is another trade. This one's not even marked, but this is another trade. Bollinger Bands inside the Keltner channels. Move to the downside. Closes below both the Bollinger Band and Keltner channel. Then we get an inside candle. Then the high is taken out of the inside candle. We take our profits at the middle line. And here it is a little bit more close up. Extension candle closing outside, inside candle, low of the inside candle is broken, stop loss at the high, take profits at the middle black line. Again, extension candle closing outside both indicators. Then we get an inside candle. Stop loss at the high of the inside candle, entry at the low, profits at the middle line. Again, Bollinger Band inside the Keltner channel. Extension candle, inside candle, break above the highs of the inside candle, profits at the middle line. Again, extension candle to the downside. This can be a long trade. Then we get an inside candle. High of the inside candle is broken. So you'd enter on this candle the second the high is broken, and your stop loss would be at the low. Next, we have another extension candle, inside candle, low is broken, stop loss at the high, and profits taken. This one you can actually see the entries and exit of this trade. This was actually traded live. So look, extension, inside candle, and you can see right here the red mark is where we shorted it, right here at the lows. We had our stop loss up here and we took our profits right there. Alright, again, extension candle to the downside. You see right here, you'd be looking for a trade setup. You see it starting to set up, you get an inside candle, you're waiting for a break above the highs. It never breaks the high, so you never enter the trade. Continues lower, then we get this extension candle, then we get this inside candle, then it breaks the high of the inside candle and you enter your trade, stop loss at the low, take profits at the middle line. Now that we have a good understanding of our winning trades, let's look at some losing trades. This is what our losing trades look like. Ready? Extension candle. Well, first Bollinger Bands inside the Keltner channel. Then we get an extension candle. Then we get an inside candle. Then the low of the inside candle is broken, so we enter the trade. And our stop loss is right here at the high of the inside candle. And we are stopped out on the next candle. That is a losing trade. That's what a losing trade looks like. And make sure you guys set your stop losses. Do not have mental stop losses because it forces you to get out of the trade. Alright, some quick notes on the trading setup. The inside bar does not need to be outside of the channels. So basically what it's saying is that this inside bar, see how it closes outside both the Bollinger and Keltner channel? It does not need to close outside the Bollinger and Keltner channel. For example, in the example that we had up here that had multiple inside candles. So for the setup that we had right here that has multiple candles, look, you see extension candle that closes inside the Bollinger Band, another inside candle that closes inside the Bollinger Band and follow through. So no, you do not need the inside candle to be inside the indicators. All right, at least one of the Bollinger Bands need to be inside the Keltner channel, not both, prior to the trade. So what that is saying is, let's find an example. The Bollinger Bands need to be inside the Keltner channels. Again, I've explained it to you guys. So for example, if this Bollinger Band did not go inside the Keltner channel, I would still take this trade because the one on the bottom side did. However, I recommend waiting for good opportunities where the Bollinger Bands pinch on both sides of the Keltner channel, but it's still a valid trade if it only goes inside the Keltner channel on one side. Set a stop 1 cent above or below the high of the inside bar. So we say set the stop at the high of the inside bar. However, you do not want to set your stop exactly at the high of the inside bar just because the price will sometimes go exactly to that high and then end up following through. So what we do is set our stop like 1, 2, or 3 cents above the inside high, the inside candle's high. That way, in the scenario of the price going up exactly to the high and then continuing lower and falling through won't happen. So we just set our stops 1 to 3 cents above our our stop loss. As you guys can see, every criteria was met from A to Z, but when we entered the next candle, took out the high of our stop loss. This will happen about 30 to 40% of the time on each trade you make, so do not be discouraged. We're talking about this trade right here. 30 to 40% of the time, you will enter a trade, get an entry trigger, you'll be stopped out. Do not be discouraged because this strategy is highly profitable over time. You just need to follow the rules and execute the strategy. Alright guys, that pretty much sums up chapter 2. Thank you guys for listening. I hope this helped you guys. If you guys have any questions, feel free to message me or any one of the SAR staff members and we'll be able to answer those. Thank you guys. Have a great day. Hey guys, welcome back to SAR Trading. My name is Quinn. Today we're going to be going over Chapter 3, Risk Management Rules, and showing you guys how to manage your risk using our day trade strategy. For quick and easy position size, we recommend you to use TradingView position size calculator labeled as long or short position under prediction and measurement tools. Over here on the left hand side panel, you've got this tool, click long or short position, and you can adjust those to your risk size. This will allow you to simply click the long or short position and place it on the chart, then edit to where your entry and stop loss would be. It will then give you an automatic position size for your shares. If you would like to day trade options with this strategy, please use no more than 2 to 4% of your account for the total option value. Example, a 10K account should not buy an option more than $400. That way, if you lose 50% of your option value when you get stopped out, your loss is a max loss of 2% of your total account value. With this day trading, we highly recommend to set a daily max loss limit of 3 trades per day using the strategy. If you get stopped out 3 times, stop trading for the day. This means with 1% risk, your total max drawdown on the day will be 3%, highly protecting your account value and capital for bad days. So basically, this is your cutoff for string of losses. If you get stopped out 3 times in a row, you'll just be cut off. So for example, if you have a $10,000 account, you'll set your daily loss limit to $300. So if you're risking $100 per trade. You will not be able to be stopped out more than 3 times. And this will basically cut your string of losses short, and you'll be good for the next day. Protecting your account value, which is most important. So as you guys can see in this example above, we use our TradingView position calculator and modify it to our entries and exit. This automatically gives you our position size when you're hovering over it. This highly improves execution speed and gives you confidence when you're executing and managing your risk correctly. I'll pull up my TradingView so that you guys can see it. Alright, so you come over here on the left hand corner and you click this button. Oh, I'm sorry. Right there, and you just click on the screen, and this is going to be your short position. So for example, I've got mine saved up here. So if I hover over here to my short position, I can left click it, click where I want on the screen, and I can place this wherever I want. And then to adjust my risk sizing, what I would do, hey, let's put this over example. Look at this, a winning trade right here. They're easy to find, guys. All right, so we've got our stop loss at the high, got our entry at the low, the inside candle. Let's zoom in on this a little. We've got our take profits at the middle line. All right, you see right here, it tells me exactly how many contracts I can buy with my account value. I could buy 5 contracts with this. And to be able to adjust your risk and account value, all you have to do is click on it, go to settings, you type in your account size, keep your lot size at 1, your risk percentage. So right now I'm only risking 1%, and that's it. And you click OK, and then you can size this to however much you want. And you see here how it adjusts the quantity of contracts I should buy. And then right below that, it tells you your risk to reward ratio. So for this trade, it had a risk to reward of 1.9 to 1, and I could buy 5 contracts with a $30,000 account, risking only 1%. All right, that's pretty much it for chapter 3, guys. Thank you very much for listening. I hope this helped you guys out so you guys can start managing your risk precisely. If you guys have any questions, feel free to message me or any one of the SAR staff members, and we'll get those answered for you guys. Hey guys, welcome back to SAR Trading. My name is Quinn. Today we're going to be going over Chapter 4, Charting Software, Brokerages, and Process Flow. The first thing you should decide is if you want to trade this strategy with shares, options, on futures, or crypto. With shares, your account must be above PDT rule, so 30K or more, so that you guys can day trade, not have to wait for your trades to settle. Unless you are using this strategy on a higher time frame, such as like the monthly. If you're using on a higher time frame, such as the monthly, you might be better off going with options. With options, your account can be any value. However, we do not recommend having contract sizes larger than 2 to 4% of your account. So if you have a 10K account, no larger than $400. That way, if your option expires worthless, you will still only be risking 2 to 4% of your account. With futures, your account is recommended to be a minimum of $1,000 USD to survive drawdowns right off the bat. If you are trading futures on a small account, only trade RTY as it moves the least of all major contracts, allowing easier risk management. With Forex, your account can be any value. With crypto, your account can be any value, but to trade short and long, you must be outside the USA. Now that you have decided what you want to trade, let's give some brokers for each trading vehicle. For shares, any major broker will work if you are above PDT, Guardian, Webull, TD Ameritrade, etc. For options, we recommend a Webull cash account as there is no commissions and next day settlements. For futures, we recommend Tradeovate.com, can be directly integrated with TradingView. Tradeovate.com and TradingView is what I personally use to trade this strategy. I especially like to be able to use TradingView because it has the indicator to find my entry, exit, and stop loss, calculate the number of shares, risk, and all of that. Makes it super easy and saves a lot of time. Gets my entries super tight. For Forex, we recommend Forex.com, can be directly integrated with TradingView. For crypto, we recommend Binance.com, not Binance.us. If you are in the USA, do not try to trade the strategy on crypto. If you do, you'll only be able to take long trades. Let's now move on to the process flow of trading this strategy. The first thing you want to do is open your chart and add the indicator Bollinger Band, 20 with 2 deviation, Keltner channel, 20 with a 1.5 deviation. First, you go to your indicators, find this Bollinger Band indicator. It will look like this. Next, you'll have your Bollinger Band on the chart. On the top left of your TradingView chart, click the Edit the Bollinger Band indicator under this wheel. Go to Style, select Basis, Upper, Lower, and then make sure the basis is a different color from the upper and lower because the basis is going to be your take profit line. And you can change this whatever colors you like them. I'll show you guys my chart and what it looks like at the end. Next, let's add our Keltner channels. You go again to Indicators, look up Keltner channels. It's going to be this indicator right here. Then your chart will look something like this. This is very messy and confusing, so let's clean this up. So go to the Style Edit screen of Keltner channel the same way you did with the Bollinger Band. Now that you're at the Keltner style, remove, uncheck the basis line as we do not need the basis line for the Keltner channel. Remove and uncheck the background for the Keltner channel. You only want the background on the Bollinger Bands. Change the upper and lower to contrast with the Bollinger Band. In this case, I will use red as it contrasts with blue. Then edit the lines to be a different shape for the upper and lower. I prefer the step line. And it will look something like this in your settings. So you have the upper, this is for your Keltner channel, upper, lower, red lines, and you're using the steps. Now that you have something that looks like this, and the chart should look like this, much more cleaner. So your Keltner channels are the red lines, and the blue lines with the middle black line is going to be your Bollinger Bands. Much cleaner and easier to differentiate now than before, right? All right, now I'll show you guys exactly what my trading view looks like and how I've set up my chart. So I've got the dark theme on, right? My Bollinger Bands are in blue. I'll show you guys what they look like. So I've got my basis, upper, lower, all blue, regular lines, and my background selected as a light blue with a 20% opacity. My inputs are 20 length, 2 standard deviation. Now let's go to our Keltner channel. Keltner channel, input, length 20, deviation 1.5. My style for my upper is purple with the step type of line. I have my basis selected for my Keltner channel. You guys do not need your basis selected. Ignore this. Next, I have my lower selected as purple with my step lines, and there is no background on this. And your chart should look like this. As you see, the Bollinger Bands. I have the Bollinger Bands background lightly colored in, so it lets me see when we contract inside the Keltner channels a little bit better. And I really like when the Keltner channels are on the step pattern rather than just being a regular line. And right here, you guys can see a setup right here. It's going to be a long trade. Bollinger Band goes inside the Keltner channel. Then we get an extension candle to this downside after market open. Then we get an inside candle and a break of the high. The second I see this inside candle form, or almost form right before it's about to close and finish off as an inside candle, I get my helpful position sizer tool, set my stop loss at the low, my entry at the high of the inside candle, and my take profits at the middle line right there. This is what it would have looked like. All right, chapter 5, wrap up. You have now learned how to enter short and long, how to place your stop loss, and when to take profits on both long and short trades. You have also learned how to calculate your position size for all markets using TradingView's built-in risk calculator, as well as how to set up the indicators in an easily readable way to use the day trading strategy. Remember, the strategy works on all time frames. We recommend the 5 or 3 minute chart for day trading. The 1 hour chart works very well for 24-hour markets as well. Really, you're going to have to experiment and figure out what you enjoy best. We have shown you your win rate and average risk to reward with the strategy, as well as potential equity curves and average max drawdowns you will experience. This strategy works extremely well in combination with our swing strategy, as it takes advantage of market conditions that you would not be able to trade otherwise if you are only running one. Happy trading, guys. I hope this strategy is going to help you guys out, become a profitable trader. All you guys have to do is follow the rules, and follow the rules. Make sure you guys really have a good understanding of what a proper setup looks like. Bollinger Bands pinch inside the Keltner channels, extension candle, inside candle, stop loss at the low or the high depending if it's a short or long trade, and entry when either the low or the high is broken on the inside candle depending on short or long trade. Take profits always at the middle line. That's pretty much it, guys. I hope you guys really enjoyed this strategy. The strategy is really cool. It's super simple to follow. All you guys have to do is execute it and follow the rules.